Welcome back, everyone. We are just absolutely delighted to have you to our last day, our finale, if one will, of DC FinTech Week, where we're going to have the opportunity to canvass some of the hot button issues of the day, especially as we focus to our last and final theme, our first being obviously that of innovation, and then focusing and bearing down on questions of inclusion. And then yesterday, digging into issues of integrity. Today, we're going to talk about how do you price risks and opportunities that are developing in the FinTech ecosystem. Now, I can't think of anyone better to at least help us kick off the day than Robert Lee with PitchBook, who will be offering some up-to-date insider information or professional information, that is, at least, on FinTech and FinTech investing. Robert, thanks so much for joining us.
Yes, hi, Chris. Thank you for having me.
Yeah, I guess I'll just turn it off to you. I know that you have some slides and some really interesting data, and maybe you can help to share it with us and our little global community watching.
Yeah, sure, absolutely. Hi, everyone. Good morning. I'm Robert Lay, an analyst here at PitchBook, a financial data and research provider. I'd like to kick off the discussion with a presentation of some of the capital raising trends in FinTech, and then I'll dive a little deeper into trends within the crypto space, as that has been top of mind for many people interested in FinTech. So first, we'll dive into venture capital funding into FinTech companies globally. The thing that jumps out to us here is that 2021 has been an absolute banner year for FinTech companies. There's been almost $88 billion invested this year, with about a little bit of a quarter left for the year. 4 FinTech companies raised over $1 billion in a single venture round. So Robinhood, Klarna, Nubank, and Chime are those 4 companies. We saw another 20 rounds were raised for more than $500 million. So part of the investor enthusiasm here has been a number of outsized venture exits that have occurred so far this year, which we'll dive a little bit more into the next slide. But more importantly, there's been an accelerated shift of financial services to digital and mobile platforms over the past 18 months due to the pandemic. FinTech companies has benefited from this shift, with many companies across most FinTech segments experiencing explosive growth during this time. And as I mentioned, VC exits have been enormous this year. This chart really looks like the power law distributions that you would expect in venture capital returns. And some of the largest exits this year were via traditional IPOs and direct listings, with Coinbase, Robinhood, Marqeta, Wise, and Affirm grabbing the most value in the public markets. There were also some notable exits via acquisitions as well, including the $2.7 billion acquisition of Japanese buy now, pay later Payday by PayPal, and the $2.5 billion acquisition of business expense management provider Divvy by Bill.com. SPACs has also been another source of venture exits within FinTech. We have seen 21 SPAC mergers since the beginning of 2020, with the majority of these being from venture exits. Some of the notable VC exits via SPAC, including neobanks, SoFi, and MoneyLion, payments company Payoneer, and real estate platform Opendoor. And then I'm going to switch gears a little bit, and I want to highlight the participation of traditional private equity firms in this space as well. The data shows that leveraged buyouts have bounced back this year after a down year last year, as PE firms struggle to find fintech companies to buy during the pandemic. But for this year, we've seen some notable fintech buyouts already, including Adenza, by Thoma Bravo, InvestCloud by Motive Partners and others, and for Nergo by Bridgepoint. And on the M&A side, we have seen acquisitions of fintech company has remained pretty strong, with over $100 billion in deals occurring during the last 3 years, and 2021 has just eclipsed that mark as well. I mentioned earlier the acquisitions of Paydi and Divvy, but some other notable acquisitions we saw this year include the crypto research and development platform BTC.com, which was acquired by 500.com for $1.3 billion. And then JP Morgan acquired Nutmeg for almost $1 billion. And Nutmeg is a retirement and pensions platform. And then, as I mentioned, we're going to dive a little bit into the crypto space, which has seen a frenzy of activity this year. We see that venture capital investors has poured $16.8 billion in 2021 so far, which is more than the previous 5 years combined. Companies that are categorized under the crypto segment include not only centralized cryptocurrency services like exchanges, such as Coinbase, or custodians such as Anchorage, but we also track decentralized finance, or DeFi. So some of the protocols like Solana, which is a smart contracts platform and a competitor of Ethereum, or DYDX, which is a decentralized exchange for derivatives. And this is the last slide. If we double click into DeFi, I want to showcase another data point here, which is total value locked. Right now, users can buy and trade tokens for most DeFi protocols. And these tokens to us are akin to an equity share of a private startup. So total value locked is a common metric in DeFi, and it represents the amount of crypto committed to DeFi protocols and platforms. And we view this as a proxy to the amount of demand there is for DeFi services. So total value locked has increased to over $200 billion from just under $9 billion 12 months ago. And we estimate that total value locked will likely exceed $500 billion by 2024, especially if Ethereum, which is the leading DeFi platform right now, successfully rolls out its Ethereum 2.0.
Great. This is it's just pitch perfect data coming from us from PitchBook. Super interesting stuff. I guess I'll just start off with just a very basic question that I know that some of my students will probably be interested in, and also some of the folks in far-flung places. The data that you have here and your sourcing, it's really interesting. Where do you actually or how exactly do you source your data for these kinds of presentations?
Yeah, multiple ways. We have tens of thousands of web crawlers that go through the web and look at a bunch of different financial sources, news sources, government filings to pull in all that data at the top end. And then we have a pretty large primary research team that comes in and verifies that data, and also a team that goes out and talks to LPs, investors, and companies. So all that data we put together to really gather, some of the funding trends, company financials, company funding, and all that.
Interesting. Okay, so a high-tech way to do a little bit of research into the fintech space. So I think I'll just maybe focus on that one, at least kick things off with that one global VC cryptocurrency deal flow slide that you have. You had mentioned a little bit that there are different kinds of actors in that VC deal flow, and you had mentioned, I think, exchanges and custodians and DeFi. This is just more of a question. A lot of that VC funding is probably also going into tokens, I would imagine. Is that also showing up in this slide? Token related VC deal flow?
Yeah, so that's a great question, Chris, and actually it does not. So this slide here actually only tracks VC deals into crypto companies or DeFi protocols only for equity. So I'll give you an example. Solana raised really two deals this year. They raised a 40-something million dollar deal, VC deal for equity, and they raised a $314 million token round. So this only tracks that former round. It does not track the token rounds. And that's something we're building out capabilities to track. So you can imagine the $16.8 million really doesn't capture
Yeah.
all the outflow of venture capital dollars.
That is remarkable. I mean, I think that's what that insight that you just brought there really does bring into relief just how much money is flowing into this particular sector. And I just want to also just make sure that we have the categories, because I think it's useful for the audience when they are looking at this slide and some of these other slides. So we're talking about the exchanges, custodians, and the DeFi sector. It may not, it's not really broken out, but as between those sectors, are there, when you were gathering your data, what was any one of those particularly eye-opening?
Yeah, we're seeing the most funding going into the exchanges and kind of like the prime brokers. I think partly because Coinbase had this massive direct listing this year, right? So investors typically kind of follow what's going on in the public markets. So a lot of capital is going into that space, and then a lot of capital is going into funding DeFi platforms. So what I mean is the smart contracts platform that are similar to Ethereum. There are a lot of prominent ones out there now. I mentioned Solana earlier. There's Cardano, there's Polkadot. So these platforms are trying to compete with Ethereum to become the main platform where developers come onto and develop these decentralized financial applications on. Obviously, Ethereum is going to roll out their 2.0 platform. So it's going to be something that the entire crypto community is really watching and seeing how that's going to roll out.
Yeah, we actually had Joe Lubin on Monday, and we talked a little bit about that. So you've shown us a lot of these global aggregates, but are there any countries that you're seeing, or at least where you're seeing the most investment? Do you have a sense, again, when you're just compiling your data, as to where maybe the U.S. stacks up against international peers, especially in maybe some of the more recent quarters?
Yeah, on the crypto side, the one thing that I'm really excited about, just DeFi in general and crypto, is because typically in tech, you see development really concentrated in some of the tech hubs, right? San Francisco, New York, Shenzhen, right? But really with DeFi, it's really distributed across globally everywhere. Major projects or protocols you see developed in Mexico or in Africa. So that's a really exciting aspect of it. And so funding really follows those trends as well. The funding is really going everywhere. It's not really concentrated in the tech hub as it is traditionally with FinTech and other tech sectors.
Yeah. Could you bring up that SPAC slide? We will have a session on SPACs with my very good friend Robert Jackson a little bit later on in the day. So we're looking at this SPACapalooza here. You have any sense as to what's explaining the surge, just from a sort of data analytics perspective?
Yeah, I mean, there's just been a lot of SPACs out there, right? And SPACs need to find deals to companies to acquire. And FinTech has just been an attractive target just because there are a lot of mature FinTech companies out there with revenues, with traction, with good market share. So I think that, it's very natural. And I've talked to a lot of these SPAC sponsors, and, one of the first sectors when they want to look at acquiring a company is FinTech. FinTech has been a very attractive sector. So that's where you see really that surge in the amount of SPACs that's happened this year.
Great. Super interesting. Joe, you can bring us back to the two box here, because I think these slides are super interesting. But do you see, just also looking at the slides, because there was a that there may be different cycles, right? Taking place between FinTech and crypto. What I think was particularly useful on or in this conversation and in your deck is that you certainly see common trends, but you don't see the same arc in terms of acceleration. Although obviously in this last quarter or so, you've seen a spike. Is there any kind of moderation that you may be seeing in the fintech space and maybe VC, PE, and M&A, at least as compared to crypto? Like, is there a shift or any kind of possible cyclical shift from interest in one sort of flowing to the other, or is it just a question of maturing cycles? And that, again, the fintech cycle started a little bit earlier than the crypto cycle, so you'd expect sort of the rise and moderation to happen at different points in time.
You know what? Probably before the pandemic, I would say, yeah, the cycle is pretty mature. And, fintech is at that point, it's been around for about a decade now. But things have really taken off in the last 18 months. So a lot of, even some of the neobank space, for instance, these are digital banks, mobile only. We thought that they were pretty mature. They have millions of customers. But really in the last 18 months, we saw that explosive growth in the number of accounts that are being opened online because people were not walking into branches to open bank accounts. It's much easier to be at home and opening a bank account online. So it's really hard to say, but right now we're starting to see funding really kind of follow where the explosive growth is, and it's really occurring across all fintech segments, and crypto is one of them.
Yeah. I guess then the obvious question then is when you look at this kind of acceleration in this last couple of weeks, have we reached a stage of peak fintech investing? Or for that matter, crypto investing? Like, when you see this kind of acceleration or deceleration, do you get a sense that we're reaching some kind of bubble?
I wouldn't say that we're there yet. If you look at the opportunity that fintech companies are going after, right? The financial services market or the insurance market, these are massive markets, right? So I think we're still a far ways off from that. If you look at the amount of the values of fintech companies or the revenues of fintech companies relative to the broader market that they're going after, it's still a small percentage of it. So I think we are not. I wouldn't say we're in a bubble. I think there's still a lot of opportunities across different areas of financial services that still needs innovation. I mean, a lot of different areas of financial services is still paper-based. So I think there's still room for digitization, and there's also still room for automation as well. So I don't think we're there yet.
That is such an interesting sort of observation in and of itself, right? And I think it's going to be useful because a lot of times when people think about either fintech, look, all these are kind of terms of art, which is why it was really good for and extraordinarily useful for you to kind of walk us through, what exactly are we talking about? But ultimately, whether or not you're talking about financial sort of fintech, qua neobanking, or crypto, where you're talking about, are we talking about infrastructure for tokens, or are we talking about infrastructure in a kind of new web design feature or attempts to further automate financial services? It's harder to get a sense as to if it's hard. The space itself is growing, so therefore it's harder to identify at what point you would have peak anything, because the sector itself is kind of seeping into other allied sectors. Just in the last minute or two, when you do think about bubbles and pricing of opportunities, but also pricing of risks, when you look at data like this, where do you come out as to sort of where in the cycle we may be, either in fintech or crypto? Is this late stage, early stage, or something else?
Yeah, I think when we talk about fintech, it's very easy to talk about it as a whole, right? But there's different areas of fintech that are a lot more mature than others, right? So for instance, I think the lending area is a little bit more mature. It's been around for longer. But then we talk about DeFi, it's very nascent. There's still a lot of room for growth there. You just mentioned infrastructure, right? I know when people talk about infrastructure, we think of roads and bridges. When I think of infrastructure, I think of financial infrastructure. So the underlying pipings and rails, payment rails, and banking, core banking systems. So I think there is a lot of room for growth in different areas of financial services. But yeah, some areas are more mature than others.
Right. Well, this is just really fascinating, extremely helpful. As I said, this conference is a little bit of a global potluck with everyone sort of pitching in where they can, and PitchBook has done just that. Thank you so much for joining us, Robert. And we look forward to seeing more of the data and hearing from you as the market evolves.
All right. Thank you so much, Chris, for having me.
Great.
Bye-bye.
So we have a real treat again. We're having and really have been very fortunate to have many of the world leaders who are at the leading edge of financial regulation join us throughout the week. And now we have the opportunity to talk to yet another one of the really consequential figures in financial regulation, Chairman Gary Gensler, who has taken time out of his very busy schedule to join us today over at DC FinTech Week to get his perspective on issues of pricing, risk, and opportunities. Chairman, thank you so very much for taking the time to join us, and welcome to our week-long program.
Well, good morning to all the listeners. Good morning, of course, to you, Chris, and it's good to be here at DC FinTech Week. And I want to thank the organizers and, of course, Chris, for inviting me here. As is customary, I'd like to note that these comments are my own. I'm not speaking on behalf of the Commission or SEC staff. So as I got that out of the way, let me just try, before your questions, I wanted to set the stage a bit about how I think about financial technology, or FinTech. Finance and technology have coexisted in a symbiotic relationship since antiquity. Just think about it. Money, accounting, and ledgers, which we take for granted in some way now, were technologies that changed the face of finance thousands of years ago. Other technologies over the century that we also now take for granted didn't exist in earlier times, whether it's like present value formulas, joint stock companies, derivatives, telephones, securitizations. So while some may not consider those to be financial technologies, and even your prior speaker from PitchBook would have said, well, those are just in the technology stack already. I think of FinTech in the context of how the Financial Stability Board defined it. This was a few years ago, as technologies that may have material effect on how finance is delivered. Again, technologies that may have a material effect on how finance is delivered, focused on the technologies. Putting it in this broader context, I think, is important for policymakers. It's not only the startups, the disruptors, so to speak, what Robert and others might call FinTech. I think it's also about traditional business models of finance. It's also about financial incumbents themselves, how they're reacting, and yes, how big tech is reacting. So it's all three components: disruptors, financial incumbents, and big tech, looking at their business models, looking at their product offerings, and yes, it sort of then spurs things for those of us in the official sector. Every 5 or 10 years, major new financial technologies come along, changing the business models. One thing that I've come to believe is that technology can bring greater access, efficiency, innovation in our capital markets, as well as economic growth. But our central question is this: when new technologies come along and change the face of finance, how do we continue to achieve our core public policy goals? The internet, mobile phones, and the cloud are already largely embedded in the financial technology stack. But before they came along, think about the policy choices that had to be made as internet, cloud, mobile phones came along. So what are the challenges for the 2020s from a technology slice? Your focus is on pricing. Others will figure out how it gets priced into the offerings. But I think while there are many, I just like to focus on two and turn it back to you that aren't fully embedded in what I call finance technology stack. I'm sure you'll want me to focus on crypto, but I'll also start with artificial intelligence and predictive data analytics. Currently, I believe machine learning, artificial intelligence are changing decision makings and the models behind the decision making more dramatically than, in fact, crypto. Predictive data analytics, including machine learning, are increasingly adopted in finance, from trading to asset management, to risk management. And though we're still in the early stages of the developments, I think that transformation we're living through could be every bit as big as the internet was in the 1990s. Now, these new tools are transforming user experiences, allowing companies to manage risk, increasing financial inclusion. Heck, Chris, it may well be that the machines are listening to your whole FinTech week, to this conversation right here, through a process called sentiment analysis and analyzing it and how it reflects on pricing around the globe. While these developments can increase access and choice, they also raise important public policy considerations, including conflicts of interest, bias, systemic risk. First, application of digital analytics raises new questions about conflicts. Are the platforms solely optimizing for our returns as investors, or are they also optimizing on other factors like their revenues? And therein, there may be a conflict. What do we do from a public policy perspective? Second, how can we ensure that new developments in analytics don't actually reinforce societal inequities that may be embedded in the data? Further, how does one explain increasingly complex, nonlinear, hyperdimensional correlations that we're seeing in modern algorithms? Now, these debates are not new. The Equal Credit Opportunity Act, passed 47 years ago this month, ensures for fair and unbiased access to credit. Technologies that came along in the 50s and 60s, namely credit cards, consumer credit scores, and led to the passage of the Fair Credit Reporting Act, also in October 51 years ago. So if someone's denied a law, this law says basically they need to know why. Well, similarly, I think in the 2020s, in the face of predictive data analytics, we ought to consider our policies to guard against bias and facilitate explainability. And third, how do we guard against herding, interconnectedness, concentration in the data sets, the providers, investments that could lead to systemic risk? Okay, I know everybody wants to say something about Satoshi Nakamoto's innovation 13 years ago, not just Bitcoin, but what it's led to in crypto. It's been a catalyst for change. It's challenging all sorts of earlier technologies. Money and ledgers that I talked about earlier, that was at the heart of Nakamoto-san's innovation. But it's also challenging some incumbent business models and challenging, frankly, the official sector. Nakamoto's work and the subsequent emergence of crypto assets has spurred a number of other innovations beyond what is money, what is a ledger, a shared ledger. For example, the public for centuries accessed stock exchanges through brokers, a member of the New York Stock Exchange or London Stock Exchange, for instance. But by contrast, crypto trading and lending platforms allow millions of individuals who choose to do so to gain access via open application program interfaces, direct. Another innovation within the crypto space is what Robert talked about, so-called decentralized finance. It may not be so decentralized when I listen to Robert talk about the funding of DeFi, but while primarily it's still within the crypto space, DeFi is also challenging current business models in trading, lending, other aspects of finance. If $200 billion is locked, so to speak, inside. And then the last innovation I know you're going to ask about is stable coins, $130 billion of crypto stable coins. So I'm technology neutral. I'm anything but public policy neutral. And as these new technologies come along and change business and finance, I think we need to continue to work towards public policy goals. That was true when the television and the internet and the cloud came along. I think it's true now and will be true in the 2030s and 40. How do we continue to protect investors? How do we maintain fair and orderly and efficient markets? Obviously, how do we guard against illicit activity? How do we ensure for financial inclusion? How do we promote financial stability? I hand it back to you, Chris.
Yeah, that was really, really, really useful and extremely in depth. I mean, in fact, over the course of the FinTech Week, just so that you know, we've had Yelena McWilliams and Michael Su together, and we talked about artificial intelligence. And I'm on the board of Fannie Mae, and we had Kimberly Johnson as well talking about retail sort of mortgage lending and what does it mean for alternative data to get rental scores for credit scoring. But I want to take that conversation and take that observation that you just made, and put it in the definition, or really to think about what these innovations have meant, before we even get into crypto, or at least maybe touching upon crypto, but only in part, into this rise of retail investing. I mean, the charts that we saw before from PitchBook largely focused on venture capital, but really I think what's many people are saying, and certainly what you've observed, is this very significant re-entry of retail investors into the market through varying means. And this raises, I think, a lot of very interesting questions, getting to your earlier observations that you started us on. A lot of these investors are people of color. They are in many instances first-time investors. They're people who are observing that there's a lot of activity happening in the market, and they want to figure out a way to frankly bend a long-standing historical curve in the country as to getting access to different kinds of investments. How do you view, first of all, the rise of retail investing? I mean, do you think of this as a good positive signal? And then secondly, how does that impact the way in which you judge the risk and the opportunities of regulation itself, to the extent to which you want to protect people, but also you want to enable folks to get investments and to access opportunities from across the spectrum, from across America, that haven't always been available to them?
I think it's a good question, Chris. I think that retail investing, which has ebbed and flowed over the decades, we've seen this rise in the last number of years, and it's significantly about the user interfaces and the technology of mobile and cloud, but also the competitiveness inside of our capital markets as well. The question I have is that we still want to stay true to our core values of investor protection, and around brokerage apps and investment management apps, there's still these concepts of best interest, best execution, duty of care, duty of loyalty, and that we still achieve those goals. And for your students and so forth, it really means that a brokerage app is looking out for us and getting the best execution when we put an order. And I'm not so sure right now that our capital markets are up to date to the 2020s. They were last revised in 2005. Does our order, a retail order, compete with other orders, order by order, for instance? Or the digital engagement practices. Some people call it the gamification of the capital markets. There's always risk. Investors get to choose what risks they take. But are we being steered through behavioral prompts on the platforms? Either an investment advisor who steers you into maybe a higher margin product, or a brokerage app that steers you into more towards day trading and hourly trading. And I think we need to look at that and see what public policies we put in place for the 2020s to update the protections.
Yeah, it's. I think that job and your job, and the care that you bring, it's really important. And when one looks at gamification, and when you look at the new participants in these retail markets, there is a lot of conversation about whether or not, when you're talking about whether or not crypto and Bitcoin ETFs or the trading apps, what does investor protection mean, and what those costs and what those opportunities are. When you get to crypto is, as you've mentioned, it's a bit of a lightning rod in the country, and it's a bit of a lightning rod in terms of the public policy conversation. Why do you think that is? Both, from the standpoint of supporters of crypto, and there are many different kinds of cryptocurrencies, but also detractors. What's been your sense of this particular debate and its evolution? I mean, you were a professor teaching on these issues. You seem to be a little bit more interested in these. Have you seen some things that have worried you more since you've come to the SEC? And again, why do you think this issue has such salience?
A great set of questions. I guess I had a different job at MIT. I found the technology of interest, what Satoshi Nakamoto laid out on money and ledgers, but also the innovations, frankly, subsequent. I named 3 or 4 of them in my opening comments. Those innovations are challenging current business models. And that disruptor, that FinTech sort of disruptor side of this, I think is not only interesting once when I was a faculty member and even now in the public policy space, but it also challenges this basic concept. Are we still protecting consumers and investors? And so many of these projects have also tried to arbitrage our public policy framework. I mean, lending is lending. If you're lending a security, or if you're lending cash, it comes under various regimes. Lending securities, the SEC, a bank lending and deposits, the OCC and the Fed and FDIC and the like. So we have regimes to protect the investing and saving public there. I think our public policy needs to be here too, whether it's crypto lending or frankly, crypto trading. Many of these projects, Robert mentioned to you, they're raising money and they're tokens. And you asked him about the tokens, and I was fascinated when he said, yeah, they're like equity. I mean, Robert might not have been talking as a securities lawyer, but that's the same concept, that these are investment contracts, and it all depends on the facts and circumstances, but many of them are investment contracts. They should come in, figure out how to register, and particularly the platforms, the services, whether they're trading or lending, come in and work with an agency like the SEC and the CFTC and come inside the public policy framework.
Do you get a sense, coming from the academy, then back into the sort of regulatory a foray, that part of the response, we both, I'm certainly an academic, I'm sort of working through these issues, has to do with how the technology maps onto the sort of the facts and circumstances, as you mentioned. There have been, before you started, there have been various attempts to create or to streamline ways to think through and to identify crypto assets, to figure out, okay, what bucket they should fall into. Sometimes they have been very voluminous streams of just sort of data points, but not necessarily prioritizing them. I mean, do you get a sense that part of the frustration and or energy in the sector comes from the natural governmental attempts to try to grapple with something that's new, and that even when brought into the regulatory foray, requires a considerable amount of thought in terms of how do you adapt rules, disclosure that's premised upon a board of directors and a manager and a CEO, to a new set of circumstances where you're talking about, node operators and, blockchain ecosystems. I mean, do you think that that's part of it, or do you think that there's something else?
I think it's a large part of it, but it's not everything. I do think as technologies come along, the public writ large, through Congress and through the official sector, because we work for the public, grapples with this. The internet came along, and my predecessors at the SEC had to grapple, well, what does it mean if you have a bulletin board upon which you can buy and sell securities? Is that a stock exchange? Is it not? And under our predecessor, Arthur Levitt, he thought, well, we'll do something called alternative trading system. And they used some exemptive authority to find that. Today, we're going to have the same challenge in machine learning and predictive data analytics. I don't think we've had enough public debate about how we can embed society's inequities and inequalities in the data. If you're picking up people's driving data and Fitbit data and data from the internet, and you're sort of soaking that all up and then finding correlations on who's a good credit, to who do you give a credit card, or who do you promote a different product on a brokerage app? What if we're embedding society's already known historical biases, and we've got to guard against that in this new technology. So crypto has that, but I think crypto also has another thing. That look at its genesis story, its foundational story. Satoshi Nakamoto, who 13 years later, Halloween night, by the way, you can celebrate 13 years from when Satoshi wrote that original 8-page paper. We still don't know who she was, who she or he was, right? And so there was a bit of an off-the-grid cryptographers approach in the middle of the financial crisis to say, we'll do something not just as a traditional disruptor within the system, but a disruptor outside of the system. And so I think there's also that sort of spirit that's embedded in some of this innovation.
You know, I really appreciate some of the attention and your comments on the machine learning aspects and the questions of bias, and because it doesn't really pop up. And we're going to get to because I know as you said, people want to hear about stablecoins and the like, and we'll get to that shortly. But I did want to ask one final question, because there is so much work going on from, you know, everything from questions about private investing and who has access to, say, 144A markets, or, you know, a reform of the public markets, you know, in order to make them more attractive, or to allow normal people to be able to participate earlier, or whether or not you get into crypto. It all gets to this question of financial inclusion. You know, where does financial inclusion fit for you into the SEC? I mean, it's not a formal mandate, but it does seem that's something that's becoming increasingly relevant. Again, not just when you look at just the inequality, sort of just larger income and wealth inequality, but the sense that the retail investors, that a new generation of investors really is that they're looking to get more involved and active in the marketplace. And how do you?
I think it's a very core piece, and I actually think it's in our remit. We have a 3-part mission: investor protection, facilitating capital formation, and in the middle, fair, orderly, and efficient market. So whether you read it into investor protection or the word fair, I think it's part of our remit. And it's really why over the decades we've looked at best execution, best interest, things like that, the fiduciary duty over in the investment management space, that people have access, and there are certain duties of those people in the financial sector when they're working with the investing and saving public.
All right. Thank you so much on that. Okay. Stable coins. All right. So, you know, there's a lot of interest and a lot of energy in this question of stable coins. So the question of crypto, again, you know, tends to be this issue where, you've heard them before, this question of clarity, of regulatory clarity, the question we'll have Garlinghouse later, the question of enforcement, and how do you create either ex ante or ex post sort of guide rails for different kinds of crypto assets. Stablecoins are front and center right now in the U.S. government in terms of how they should be regulated. There's a word. The word on the street is that stablecoins, should be falling largely under the remit of many of our banking regulators, and our banking regulators are certainly taking a really stern look at it. If this does become primarily the province of our friends over with the banking regulators, or for that matter, even the CFTC, as we saw with their fines on Tether, what do you see as the likely role of the SEC in this larger stablecoin conversation?
So just a little bit of the facts on the ground. Stablecoins today, about $130 billion, primarily around 3 of the big ones, but there's 7 or 10 others. This $130 billion of stablecoins is dominantly intertwined in the crypto to crypto trading and lending space. They came about in 2013, 2014 to facilitate the trading on these trading platforms, in part for efficiency, but in part, frankly, because it was a way to do trading without using the fiat banking system. So around the globe, many jurisdictions, this was outside of the anti-money laundering or tax compliance sort of perimeter guarding against illicit activity. And then it took off. 80% 80% of the current trading and lending on these platforms is versus, quote, a stable coin. And why might that be? Well, a bit for efficiency, but also it's outside of the perimeters of anti-money laundering and the like. To your question, it's really about the facts and circumstances, but stable coins are so intertwined right now. And we don't have many stable coins in euro, in yen, in sterling. They're in dollars. They're basically intertwined into this system. And so how does that facilitate investing? Is that an investment scheme and the like? Of course, depends on the facts and circumstances, and we're taking a look. But there's three key principles as well that all of our regulators are looking at together, is that are they going to be like banks, or are they going to be one-to-one? And what backs them? What's their reserves? Are their reserves just cash? Or are their reserves, more like an investment fund and investing broadly? And thirdly, and importantly, is it inside the anti-money laundering, what I'll call perimeter, or is it outside? And many of these for years have sort of lived on the outside and promoted that crypto to crypto space. I hope that's helpful.
No, it really is, and I guess a part of the interesting work that the SEC is going to be involved in, from what I'm sort of listening in that conversation, is figuring out which of those arrangements sort of are look a lot like money market funds, and then which ones I suppose look more like a classic sort of bank deposit scenario. Sometimes it's hard to tell, even for the law professors out there to be able to figure out.
And can I throw one else at you, Chris? Is most of the stable coins aren't actually owned by the public. They're primarily owned, meaning the control of what's called the private key. They're primarily owned actually by the platforms themselves. And then we, the public, I don't trade this, of course, but the broad public only has a credit relationship or a custodial credit relationship with the exchange. If the exchange loses the private key, your relationships with that exchange. So they're actually, the ownership of these coins are highly concentrated on a handful of platforms. So it's another interesting piece of the ecosystem to consider for financial stability, investor protection. And we're not even yet talking about what happens if these become general payment tokens. What happens if people are actually, which we don't see now, but what happens if these or a new one becomes something used in the general day-to-day commerce?
Yeah, can I ask, because you brought up the point that with really the international point, right? With stable coins that there are certain kinds of questions obviously about where money is being kept and what is the level and the degree of legal obligation, and whether or not people are living up to the obligations and that they're making to certain kinds of customers. But when you go about your job, I have been listening, and I've been in DC for a while, and there have been for a long time conversations on international competitiveness, right, and the international competitiveness of the United States, vis-a-vis other parts of the world, and as the world has undertaken this sort of digital transformation, and where maybe crypto is maybe the latest flashpoint, there's increasingly this idea that, if we get things right, whether or not be in crypto, whether or not it be in other sort of key aspects of our trading infrastructure, it could impact deal flow outside the United States and basically the innovative posture of the United States. Do you think that those arguments have more credence as nowadays, just because of digitalization, or do you just think this is just a continuation of just a conversation that's always been around? Like how high of does that, in your mandate for fairness and for efficiency, how high or how often does that sort of come to mind?
So we've lived in a digital age for a few decades now. So I just want to say that the internet and the rapid decline in the cost of communications, global communications and domestic communications, has changed the face of finance. And it's why we can facilitate so many of these disruptors on our phones. And somebody who's somebody in sub-Saharan Africa can look on their mobile and see where the corn or wheat futures are trading in Chicago. Like that's actually ties us all more together. I think these new technologies, we should think of the competitiveness of the U.S. financial system. We've got the best financial system, but we can't take that for granted. Technology comes along, whether it's AI and machine learning or crypto or open API or other technologies that will come along in 5 and 10 years, they will challenge the basic premise. And I think those of us in the official sector, I really do believe we should be technology neutral, not public policy neutral, but then enhance and update our rules for the 2020s and the 2030s. And that's what makes part of these jobs interesting.
Chairman, thank you so very much again for joining us. We're actually going to jump now into a stablecoin conversation at the conference, but we really do appreciate you taking the time and sharing your views. Thank you so much again.
Thank you, Chris.
So now we have more stablecoins. I know that everybody was very interested in stablecoins. We're getting lots and lots of questions about that from all over the world. And we are delighted to have a panel of some of the world's foremost experts on specifically that issue. I'm just delighted to continue the conversation with Caitlin Long from Avanti Bank, and really a thought leader in the space of both stablecoins and crypto banking. Peter Kirstens from the European Commission, Tamika Tillman from A16Z, and Emma Butterworth from the Bank of England. I have an all-star cast today to talk about these issues and to hopefully get both some insight responses, obviously, to the chairman's conversation, and also to help walk our audience through some of the core issues relating to stablecoins. Thank you so much to all of you for joining us. I guess I'll start off with you, Caitlin, just to maybe continue the conversation. Are you there?
I am.
Okay, great, wonderful.
Good afternoon,
Good
wherever
morning.
you are.
Good morning. We're going to have a very leisurely, non-controversial morning, but you know, as we kick things off, you know, either both listening to the chairman's conversation and also just given your enormous sort of experience in the stablecoin area, you know, is there any one particular area of concern that, in your mind, should dominate the minds of regulators, or maybe? Actually, I'm going to turn this around. Do you hear from regulators a dominant concern, and when discussing stablecoins? And in your opinion, is that the right one?
The dominant concern is the level of disclosure of risk. And yes, that is one of the right ones. It's not the only one. But the other one, taking a US-centric focus here, because 98% of the stablecoins outstanding are US dollar based. The other one is how do these fit within the regulatory umbrella? Are they securities, or are they some new form of banking or shadow banking? And if so, how should they be regulated? And to throw an academic bent, giving a head nod to Dr. Manmohan Singh of the IMF, with whom I've done a lot of work, he pointed out this is just another manifestation of the check clearing issue in the pre-Fed era, where you had lots of private check clearing networks. And the issue was none of those checks cleared at par because somebody had to pay the cost. And it wasn't until the Fed was created and then guaranteed payment at par to its member banks in central bank money that you had a truly nationwide network. We're seeing just another manifestation of that. And that raises the question whether central banks should get involved to guarantee payment at par and give stablecoin issuers access to central bank payment systems.
Yeah, I mean, you know, you've been very vocal, and I just want to stick with this just so that the audience sort of has a little bit of perspective and context here. I mean, you know, when you think about a stable coin, at least is falling along this kind of continuum, right? Between, on the one hand, you have like Bitcoin and sort of, let's call it self-referential crypto on the one hand, and then you have CBDCs on the other hand, right? They're issued by and backed by the state. And then you have this thing in between, issued by private actors, but making promises in effect to redeem or to create something that tracks other kinds of assets. In the range of regulatory responses, at least globally, we're seeing signs of things, at least in the pure cryptocurrency space, along things like even capital charges for pure crypto. Along with in the United States, as we're hearing from the chairman, this kind of disclosure question, not just there, but really even just this week from the CFTC in the United States. But when you think about that capital charges question, do you think that that's also a part or will be a part of any kind of conversation for stablecoins?
Oh, most definitely, and it should be. If it goes the direction of the securities route, there are excess assets in the money market fund structure, but there are a lot more excess assets in the bank regulatory structure. And to give you some background for that, especially banks that have direct access to central bank payment systems, the biggest risk that central banks run is actually not monetary policy. It's running those payment systems to ensure there's no default upon them, because they're guaranteeing payment at par to their member banks in central bank money. And in the U.S., really because of Basel III generally, but because of the way the Tier 1 leverage ratio works, the minimum amount of capital that a bank that has access to central bank payment systems is going to be 8%. So even if the stablecoin issuer held all of its cash on deposit at the central bank, it would still have to hold 108 cents for every 100 cents in stablecoin obligations, even if there's no interest rate or credit risk in the asset portfolio. And I think that's actually the right answer, because the default risk on the payment system is really what that capital is designed to guard against. And so if the stablecoin issuers are granted access to central bank clearing, I agree with the banks who've been I'm on all their dartboards, but in this case, I actually agree with them that stablecoin issuers should not be granted special capital concessions in order to get access to central bank payment systems, because it's all about default risk. It's not really about the interest rate and credit risk in the asset portfolios.
That is, you're really an interesting person, Caitlin. You have answers that are I think a little bit surprising. I think at times given where you're coming from in the Bitcoin space. Emma, I'd love to sort of pick up your perspective here. The Bank of England is kind of important in the world, and I'm just a little bit curious as to see how the BOE thinks through this issue of stablecoins, maybe starting at a 10,000 foot level, but then moving to a little bit more of the granular issues, listening to what we've already discussed thus far, what's keeping you guys up at night, and does, or to what extent does the popularity and the growth of stablecoins, is that a concern? And let me just preface this by saying I actually moderated a conversation with the number 2 person over at HMT, and it was very fascinating that they were a little bit more, let's call it, sanguine about the issue of the rate of growth. From the perspective of the bank, however, it's really fascinating. How do you judge this?
Thanks, Chris. So you mentioned popularity and growth, and I think that's a good place to start with this. So I think maybe where my Treasury colleague was coming from was that I think so stablecoins still do constitute a relatively small proportion of all crypto assets, I think around 5% currently. But where I would caveat that and probably have a slightly different view to my Treasury colleague is that we have seen in the last year or so that alone that they've doubled in size. And not only that, but they have the potential to scale very quickly. And there's a number of proposals coming out now which want to partner, for example, with big tech type platforms. So they have this potential to scale, even if they're starting from a small base. And I think we need to remember that. If we sort of step back and then think about why does that matter? Well, I think unlike unbacked crypto that were also kind of mentioned prior to this session, so the likes of Bitcoin, whose value is obviously highly volatile, used largely for speculative investment, stablecoins seek to maintain stability in their price, so that they can be used for payments by the general public. And actually, from the Bank of England's perspective, that's been part of our focus on stablecoins and their potential use in payments, because the ability of individuals and businesses to transact safely and smoothly, to pay for those goods and services, is critical to financial stability and ultimately the economy. So an innovation like stablecoins really welcome and can drive improvements in payments. It's a big focus of things like the G20 cross-border roadmap. But we do need to ensure that any stablecoin that's widely used, in other words, systemic or likely to be systemic, is held to the same standards that apply to current systemic payment systems out there. And this isn't actually as easy as it sounds, because unlike existing widely used payment systems which operate in central bank or commercial bank money, stablecoin payment systems obviously have a very novel feature that we've touched on already, which is that they issue their own private money, the stablecoin. So what do we do with this private money? And one area of focus for us at the Bank of England is therefore being around ensuring that stablecoin itself, this new form of private money, is held to standards that are equivalent to other forms of private money if they are to be widely used for payments, so that people have confidence in it and they're able to use it for payments and to not impact on financial stability. The idea of private money isn't new. So we already have commercial bank money. Like in the UK, 95% of the money in circulation today is commercial bank money. And people have faith in it because they're confident that if they need to, they can convert that money in their bank accounts into central bank money. So in other words, cash. That isn't to say that we necessarily need to regulate stablecoins in exactly the same way as banks. Some people have already touched on, is it a security? Should we use a bank-like model? But I think it's important to note that the outcome, from our perspective, needs to be the same. So any stablecoin that is widely used as private money should offer the same protections to coin holders as commercial bank money. So I'm mindful of time, Chris, so I won't go into it further there, but I'm happy to pick up on later about the kind of properties that actually you'd want a stablecoin to have to give you that same confidence as commercial bank money, and what that might mean for stablecoin issuers.
This is super helpful, and I there are many times where we're getting a perspective from my colleagues and across the pond is very useful. I generally tend to try to do it when it's really late, so I can ask ridiculous questions that catch you off guard. But unfortunately, I can't here. I will ask this very briefly, and I'll also sort of ask Peter this same question, but just to get a sense of the feeling in the room, if one will. We'll talk a little bit more about the risk, but you made a really interesting observation about, hey, look, we already have something like this, right? That's out there, and it's there's a high utility to it. Do you get a sense that, hey, look, if issuers get stable coins right, they may be really interesting, from standpoints of other kinds of goals for the Bank of England, like or if not the Bank of England, at least the finance ministry, things like financial inclusion, and other kinds of properties that could be really helpful for the market.
I think so. So I don't have a crystal ball, Chris. So it's kind of hard to know where this is going to go, I'm afraid. I think the key for us is actually it's about the getting it right part, so that you are kind of protecting financial stability, you are protecting the investors, and then kind of seeing where it goes from there. But obviously, I've mentioned kind of things like the G20 cross-border roadmap, where there is this kind of role there for stablecoins and for CBDC. So I think if we manage to get it right, then I think there definitely could be benefits there. In terms of the getting it right, I think we then just need to think through things like, the nature of the claim. We need a really robust legal claim, to those underlying backing assets that Caitlin mentioned at the beginning. And then I think we just need to think through some of the other things that commercial banks are subject to, and whether for stablecoin issuers, that would make sense too, like capital and liquidity requirements and a backstop in the event of failure. So deposit insurance, essentially.
So, Peter, I'll just continue this sort of this line of thinking with you. I guess we'll first, I guess, start with a little bit of the risk-reward trade-off, since we're talking about risk and opportunities. I know you've been traveling, but you may have seen the CFTC's sort of $42 million fine of Tether. And but from the Commission's standpoint, what's the posture at this point in time when looking at stablecoins and sort of stablecoin regulation? The Commission's always been very active, in some ways even ahead of the United States in terms of carving out a regulatory regime. But when you think about stablecoins, what's coming to mind at the moment from the standpoint of the Commission?
Well, as we see stablecoins growing, we have to also think a bit about why is it that certain companies or certain groups issue stablecoins? And is there a need? Is there a market demand for it? And if we look at the valuations in the market and the size of these stablecoins, there obviously is a need for them. Some people say there's a need for them to power payment systems, and that may be the case. But so far, they're not really used in payment systems that much. They really are used in trading on all of these crypto platforms where people trade from Bitcoin into a stable coin and from a stable coin back into another old coin or crazy coin or whatever you want to call them. And it's almost like a settlement instrument. And when we look at the market, we see that the people who came up with them, who developed them, really developed them because there is no public alternative yet. There is no central bank digital currency that could take the role of tokenized public money. And so we have an understanding for this development that, yes, there is obviously a gap in the offering, and the private sector is trying to fill this. But that doesn't mean that the private sector can do just whatever it likes. They develop these stable coins with expectations, but also with expectations towards the users of those coins, that these coins will have a stable value, that they will be redeemable, that there is a reserve backing these stable coins up, and so on. But of course, we want to make sure that the issuers of these coins and the people who distribute them and who market them are good for their promises. Yeah. And that it's not just whatever they say that goes, that when you check whether there is a reserve and whether that reserve is what the issuer of the stablecoin says it is, that then the facts correspond with the claim. And to the case which you mentioned for the CFTC fine, it would appear that there the facts did not correspond with whatever the issuer of that coin claimed. And that is illegal. It is currently illegal, also in the European Union. Sort of making misrepresentations as to the product you're selling is not correct. Of course, the question then is, well, does this particular stablecoin come within the jurisdictional reach of European regulators? That depends a bit on the facts. But we don't want to sort of live in a situation where the answer is, well, it depends. That's why we're working on our regulatory framework to leave no doubt that stablecoins are regulated. If they are denominated in a currency, that they must be fully collateralized, that the collateral must be of a very, very solid basis, and that they actually have authorization and are supervised as issuers of these stable coins.
So I don't know if that was, a very gentle form of at one point in time Peter Kirstens was one of the major economic diplomats here in Washington D.C. So by using, and he spent more than enough time with law professors. So I don't know if it depends answer was a gentle dig at our facts and circumstances based regime, but I do know that Tamika has had some very interesting and really had a very unique hand behind a report that was put out recently by A16Z that's really made the rounds here in Washington to be a little bit less of the "it depends" kind of posture with our crypto regulation. Maybe to Mike, can you provide some sort of a basic overview of the principal components of that report, and are there any nuggets in that report that, in your view, provide a kind of a framework for thinking through the stablecoin issue specifically?
Absolutely. It's a great question. So at a broad level, as we're thinking about how we should approach these issues, we firmly believe, and the report that A16Z put out advocating for a path forward on internet regulation for the third generation of the internet, suggests that we need a national strategy. The countries that are getting this right are being very deliberate in how they're approaching these issues. At the moment, the United States is not. And we certainly have something to learn in that regard. The second macro point I would make is that we need to calibrate the approach we take to regulation to the level of risk that is present across specific applications. There are widely varying levels of risk across the decentralized asset landscape, depending on the use cases that are being employed. On one side of the equation, you have something like stable coins that do potentially have systemic consequences. And then on the other side, you have something like NFTs that are really art and probably don't require much of anything in the way of regulation. And then beyond that, as you drill into stable coins in particular, we think there are three key priorities that regulators should keep in mind as they approach this space. The first is equitable access. In the United States, you have millions of individuals who don't have access to the traditional banking system. Worldwide, you have billions of individuals who are on the margins of the global economy. We need to undertake a very clear set of actions with the goal of ensuring that those individuals are going to be part of whatever system emerges from this framework, and ensure that they have access to digital instruments that, frankly, have been very hard for them to access in an analog banking world. The next thing we need to keep in mind is the integrity of stablecoin issuers and reserves. And a number of the panelists today have spoken about this very effectively. But we need to do what we can to ensure a high level of transparency and accountability across those that are issuing stablecoins. And keep in mind that we have a variety of different stablecoin solutions that are being put forward. We have fiat-backed stablecoins, you have crypto collateralized stablecoins, and then you have algorithmic stablecoins. Each of these will require a slightly different regulatory approach if you want to get it right. And then finally, we need to be focused on ensuring the resilience of stablecoin networks. That will be a critical component of maintaining trust in this asset class as individuals start to pay more attention and start to use these instruments much more broadly. We need to ensure that the technical networks that underpin these solutions are up to the task of supporting payments at scale.
Yeah, I'm so very glad, and I brought that up a little bit, maybe a good deal with Chairman Gensler. This question of inclusion, because it seems like so many of the issues nowadays, touch upon the question of inclusion, sort of through the back door, right? And obviously I mentioned with gamification and trading platforms, but even in terms of interest in crypto to now, well, what if, or is there potentially sort of something interesting with stable coins? And what does that mean? I mean, in terms of how you even begin to think about financial regulation. Caitlin, I know that's a really big question, but there's been more than one time that I've called you up just to sort of bemoan the state of deep thinking and critical thinking about these kinds of things. But you're the operator. I mean, you're of a bank that has to navigate a range of different kinds of issues. When you think about something like inclusion, because we're in the business today of pricing risk and pricing opportunity, right? When you think about that one financial inclusion sort of vector that Tamika brought up, I mean, how does that, or how do you think it could inform the larger policy conversation, or should it?
Well, yes, absolutely it should. And let's be honest, one of the reasons why we have so many underbanked is that the standards for becoming banked are arguably too high. And this gets back to the whole question of how much compliance cost is appropriate to saddle the banks with, and it's an enormous amount of compliance cost. And so that does two things. One is that folks who don't have the acceptable form of ID can't open an account, and the other is that the banks really don't want to bank small accounts because their compliance cost is too high to recover their basic operating costs from such accounts. So that is definitely a big question, and that's a global question. It's tough to force inclusion when the banks would be doing it at a loss because of how high those compliance costs are. And it does get back to the whole Basel III discussion when we were talking earlier, just to pick up on a thread on risk in this industry. One of the things that's interesting to me is that some countries have real-time gross settlement systems at their central banks, like the Bank of England, whereas in the U.S., because of the antiquated nature of the payment system, there's a lot more netting that happens, and that actually has a huge impact on the capital requirements. And again, this payment system risk that I was talking about earlier. Even leaving crypto aside, we're going to much faster payments in the U.S. when FedNow comes on board. And the impact of that is going to be that there's a lot more risk, right? There was a very interesting article that just came out about fraud risk. Again, now we're back to this inclusion point. Empirically, there's been more fraud in the real-time gross settlement systems because there's less time for the banks to catch it. And that's going to happen regardless of whether crypto comes inside the regulatory umbrella or not, because it's going to happen with FedNow. And I suspect that the Bank of England has had direct experience with this. But it then gets back to this question: what is the appropriate capital charge for a company, for a bank that has access to the central bank payment system? It is 8% minimum right now. Even if that bank is back to back with the central bank, just passing through central bank credit risk and not taking interest rate and credit risk in its portfolios. And the banks are arguing against that. And I kind of agree with them, but it is the 8% now. And I don't think the stablecoin issuers are going to get a pass on that, nor should they.
So we only have a couple of minutes left, but you brought up something that's really important. I think it helps us to tether, excuse the pun, our conversation back. I couldn't help it, but it helps to tether our conversation back to the stablecoin question, and that is, for better or worse, the sort of the picadillos of the U.S. payments system itself can kind of inform, what our policy is going to look like. And Emma, coming from the Bank of England, Peter, coming from the European Commission, really briefly, and then I'll end with the question with Tamika in just a second. But Emma and Peter, do you see those picadillos potentially creating or driving policy outcome that's not necessarily conflicting with the UK or the Commission, but are there things that you kind of have to keep in mind when you're dealing with us, and particularly on this particular issue? Emma, I'll start with you.
Yeah, so I think we've been quite. So we recently published a discussion paper on a lot of this, on new forms of digital money, where we kind of put out in that some illustrative models of the kind of type of regulatory models we would want stablecoins that were widely used for payments. So in all of this, I'm talking about systemic stablecoins, and we put that out as a discussion paper. So we had 2,500 responses to that. So we're very much kind of listening to people's responses and kind of engaging in things like this as well to hear back from people. I mean, ultimately in that we set the illustrative model. Sorry, Chris.
Oh, no, you're just breaking up. I'm sorry. But the number of responses in and of itself says that this is really even in the UK, there's a lot of interest in that particular point.
I think that's right, and this is a tricky subject, Chris. I think is the thing. We're kind of very keen to hear from industry, and that's why we put out this discussion paper. And I know they've done the same in the rest of Europe as well. I think this is just something that we'll have to think about a lot more.
Yeah, I'm going to ask then Peter and Tamika, since we only have 2 minutes left before jumping on. Again, Peter, does this, does the nature of the payments infrastructure in the United States sort of inform your thinking? And then sort of in the same minute, consolidation of financial regulatory actors. There's been conversation about that, and I'll ask Tamika about that as well. To what is the appropriate level of consolidation or not? 30 seconds for Peter, 30 seconds for Tamika. I need you guys to solve all of our problems.
Well, okay, very shortly. The nature of payment systems in the US does not inspire us because we believe that there is some road to go there. We look at the US a lot with amusement and bemusement, but it matters. What the US does matters for the rest of the world. Now, are we diverging? Is the EU diverging from the US? I don't really think so. I'm a great believer in Churchill, who said that the US will always do the right thing after having tried all of the other options. So the US will eventually come on board. And my experience in international coordination, policy coordination, is that there is no copyright. Plagiarism is okay. And we do look at each other all the time for good ideas. We pick the best of the ideas that emerge in other jurisdictions. Try not to replicate the mistakes. So I am sure that if a jurisdiction, a significant jurisdiction, develops a solid legal and regulatory framework, be it for stable coins or for another crypto issue or another fintech issue, that other jurisdictions will look at that and will copy those ideas. And I'm also certain that they will give no credit. There will be no credit given for the fact that they've taken the ideas from somewhere else. But at the end of the day, that's fine. It's okay if it's good and solid regulation. It can be copied so that companies can operate across the world.
Tamika, literally 20 seconds. Can we plagiarize?
I hope so. The countries that are getting this right are delivering spectacular results. So you see Estonia recouping the equivalent of 2% of GDP annually. Kenya has lifted 2% of their population out of poverty purely on the basis of access to digital payments. We need to get this right. And ultimately, this is about much more than the dozen federal regulators that are competing for jurisdiction in the United States. This is about shaping the next generation of the internet. And this third generation of the internet, Web 3, will be much larger, frankly, than even the financial sector as a whole. We must get this right if we're going to ensure U.S. competitiveness in the global economy, and frankly, ensure that we have systems that are going to be compatible with the values of an open society going forward.
Okay, we will end with that as we transition to our next big keynote speaker. You guys have been a keynote panel. Thank you so much for joining us for this year's DC FinTech Week.
Thank you.
It is again a pleasure to have someone who has been at the forefront of many of the issues that we've been discussing all day, and in fact all week long, from with the managing director of the IMF to obviously this morning our conversation with Chairman Gensler. Dan Schulman, the CEO of PayPal. Dan has been at the forefront of not only these issues, but he's been with us very early on in the history of DC FinTech Week, and it's a special pleasure to have him on. Thank you so much for taking the time with us.
Thank you so much for having me, Chris. It's so good to see you, my friend.
All right, buddy. So, okay, PayPal is really it's in the front of many of the global conversations on innovation, and you continue to sort of be a headliner for just really a suite of new products and moves across the fintech ecosystem. Just recently, in fact, maybe you can explain a little bit as to where all of this activity and innovation is coming from in the last couple of months, and why now are we seeing this coming from PayPal?
Yeah. First of all, it's great to be with you, Chris, always. I know it's so nice to see you, and hopefully we'll do it in person sooner than later. So, look, I think there's going to be more change in the financial services industry in the next, call it 5 years, than there were in the last 30 plus years. And it's not just the financial services industry. I mean, we are leapfrogging into a digital era, and we are all living our lives much differently today than we did 2 years ago. And I think that move into digital is only accelerating. You know, how we receive our education is going to change into remote education. You know, it's going to be remote medicine going forward. How we do our fitness with fitness classes that are online now, not in person. How we pay for things is radically changing. How we shop for things, where we shop for things is radically changing. And so I think what were previously disparate parts of our economy are coming together in this connected economy right now. And I think we need to all imagine kind of what could be and not be anchored to what was, because clearly things are changing quite quickly. And I think standing still isn't an option for any of us in this room. Consumers, merchants, one industry after another are all thinking about what the future is. I mean, the digital era is it's like this digital tornado that like kind of it sits down somewhere and it spits up, reorganizes industries, business models. And so I think we all need to be quite aware of it. And I think every company today is a technology company. It's not just FinTech or banks. Every company is a tech company. And technology is moving so quickly that we all need to look ahead and imagine where the puck is going and get there.
You know, I really love talking to you and listening because, you know, you really do emphasize that any one of these moves are either taken by PayPal, but just really any company, they reflect larger secular changes in not just the economy, but just how we live. I really would like to get into one issue, and you've may have heard it in the previous panel, and certainly this has been a theme sort of all day and all week long, and that's an issue on financial inclusion.
Mm-hmm.
You know, how do you view this particular issue? I mean, it's as I mentioned to Chairman Gensler, you know, it's even seeping into aspects of the regulatory mandate, even where it's less explicit. You know, from a financial company, you know, how do you view financial inclusion as an objective? You know, do you see certain kinds of toolboxes of solutions as speaking directly to the question of financial inclusion? And how does financial inclusion relate to the business, but also larger issues of sort of financial health for customers?
Yeah, it's a great question. And it sort of kind of goes at the heart of the mission of PayPal. I mean, when I first got into financial services, I heard this saying that it's expensive to be poor. And unfortunately, that really couldn't be more true in the financial services industry. Transactions that the more affluent take for granted, cashing a check or paying a bill, sending money to a loved one, even getting credit, you know, are done rapidly. You have access to them, and the cost of those are, you know, bips or non-existent. But when you're less affluent or you're outside of the system in some way, you know, that can be extraordinarily expensive, you know, coming up into 800 basis points for a transaction. And that's crazy. It should be maybe even the other way around if we want an inclusive recovery. And you look at any stat around the world, whether it be 1.7 billion people outside the financial system. And I would say to you, Chris, I would double that number when you think about people who are well served by today's financial system. In the US alone, we've got like something like 185 million adults that struggle to make ends meet at the end of the month. And why is this so important? I mean, I think it goes beyond just is our economy, solid? Are our communities working the way they should be? Because I think the bedrock of democracy, and I don't want to get too lofty here, but the bedrock of democracy is people rising above their own self-interest. And if people feel like the system is not working for them, that there is no American dream, that their kids aren't going to do better than them, then they rail against the system. You see that in a lot of our politics today across the world. People are very dissatisfied. And so I think we really need to, as an industry, I think our moonshot as an industry is how do we drive not financial inclusion? Because I think financial inclusion is a banking term. It's how many people have bank accounts. That doesn't matter to me at all. It's really about financial health. Do people have financial health? Can they be part of a system, a digital electronic system that makes managing and moving transactions faster, easier, less expensive, so that people can create a modicum of savings, financial literacy, budgeting tools to be able to sleep at night, to not have to trade off putting food on the table or getting health care insurance. So I think this is something that is within our reach. That's the exciting and frustrating part about this at the same time, because I think that is rooted in technology. Obviously, it's got to be responsible technology that works hand in hand with regulators and the private and public sector working together on this. But there are solution sets here. And I think that is really the primary mission of PayPal.
Yeah, I got to say, and I'm sure a lot of people are going to be interested. I'll ask you questions on crypto and the future of PayPal in just a second. But just to sort of this is really important to me. And when I think about these these issues, and again many of the secular changes to the financial economy, and this is something I mentioned earlier this morning, is this issue of how does industry out in Silicon Valley, and then how do regulators out in DC sort of begin to price risk and opportunities in the way of saying, well, what's the cost and the risk and the opportunity of doing something? And then what are the costs and the risks and the opportunities of doing nothing? And then once you look at both of them, figuring out, what should you do? And I think that there is, in many ways, there are costs and risks of action, but there are also costs and risks of inaction, and some of those can seep down into democracy. So now I'll get off my soapbox, but I'll say that what you're saying, I think, is just personally, I just think it's very important.
Yeah.
Okay.
I will just say this to your point. This is not about anything but responsible innovation. When I came to PayPal, it's something like 120 people in the company doing AML, BML, looking at money laundering, compliance management. Today, we have over 4,000 people in PayPal who do that. This is about working hand in hand with regulators. It's about understanding second and third order effects of innovation. It's about doing it in a responsible way and doing it hand in hand. The integrity and stability of the system is paramount. But that doesn't mean we should not innovate. Just need to do it in a responsible way. We need to do it together.
Yeah. So I know some of the things that a lot of people are really sort of curious about with PayPal. You've made some big moves, and just even with the Pinterest announcement. But a lot of people have been focused on crypto and sort of PayPal's move into this space. Crypto is a huge issue out here in DC. How do you view crypto as part of PayPal's strategy and just overall, where does crypto fit in for you guys?
Yeah. I mean, when people say crypto is such a broad landscape, so you've got crypto, kind of the asset, and what's the price of Bitcoin, and how do we regulate that, and how do we make sure we put safeguards around that? You've got crypto as the potential of a currency, adding utility to payments through programmability. You've got stablecoins, which are a different beast. You've got obviously 80% of the world's central banks working on CBDCs, and all the questions they're wrestling with. Do they do direct to consumer? Do they work only through banks? Do they work through responsible digital wallet or consumer platform companies like a PayPal? Because there clearly is a connection between digital currency and digital wallets, obviously. And then you've got the underlying infrastructure associated with distributed ledger technology. And, how does that create efficiencies and lower costs and allow people to have access to their money in a much more real-time basis? And so, we obviously started to trading of crypto. We try to do that on platform, full KYC, hand in hand with regulators on it. But honestly, that's the least interesting thing for me. It really is about how do we utilize newer technologies to increase utility of payments, and how do we work hand in hand with the regulators to think about the next generation of rails? I mean, here's the thing that's happening for sure. And I'm just going to say 10 years from now to take time out of the equation. But form factors are clearly changing. We're not going to use plastic cards going forward. Plastic cannot compete against software. Software is going to be embedded in an application or a digital wallet or a super app on your mobile phone. And you will use that to pay or to conduct basic financial transactions, commerce, anywhere, online, in store. And you will, if you're in store, you may tap that phone on a cloud-based point of sale system that is not necessarily tied into the existing rails of today. It's just like me sending you a peer-to-peer payment. If you're a merchant, Chris, I can send you a P2M, a peer-to-merchant payment. So I think, we can do things. When I think about digital wallet to digital wallet, everything digital, you can do things at a fraction of the cost of transactions today, whether that be retail, whether that be international remittances, whether that be, no longer the ability to have to cash a check on your phone to pay for things, no longer to stand in line to pay a bill. I just think that the underlying technology, which is what we're spending the most amount of time on, and how do we work hand in hand with central banks as they think about digital currencies? How do we think about the new infrastructure that is clearly needed? The system has to modernize, and we want to help be a part of that, shape it, and work hand in hand with regulators, central banks, and public officials to go and do that.
Can I ask something? And it's really interesting. I mean, PayPal is fascinating. It's a little bit of it's interesting because it's almost like the oldest young kid or the youngest old kid. You're part. It's like a new generation company, but it's not. People know who you are, right? I mean, you've been around. You've been around, but you haven't been around for 200 years, and so when you're sort of operating in this space, and then you do have a lot of innovation, and you have lots of other kinds of companies, and I think for regulators, but also even for normal consumers, one of the challenges dealing with companies that you may not know, right? Startups and other new entrants. They may have something that's really interesting, maybe, but you don't really know how to deal with it. And then you have companies, let's call them the older old kids, who are like, just not either, may not even be native to digital technology at all, right? And then you guys, I don't know, awkward middle kid. I have no idea, but it's like you're in this position, right, where you're still able to transition. What's it like? What does that mean for your business strategy, and how you think about sort of innovation and crypto and DeFi and all these new sort of projects?
Yeah, I think, Chris, you hit the nail on the head with something that you just said, which is what do consumers, what do merchants, what do regulators look for when they look to a company? And I think that really is all about trust. And brands used to be about the promise of something, Madison Avenue, and now they're all about the experience. Brands are about your experience, because every time you touch a company or a brand, you form an opinion of it. And to me, what the most important elements of PayPal's brand revolve around this idea of trust, and trust is security. And I know you probably have talked a lot about security, because I think it is one of the most important elements of a new digital future, and it's existential. The second is privacy. I think privacy is absolutely crucial. People need to know clearly that their information is protected. It's not being sold. It's very, very important. And then the third is that it works simply and easily, and it's easily understood. It shouldn't be confusing to people to understand its costs or how it works. And that promise should be fulfilled each and every time. And then they should know that everything we do is done hand in hand with regulators. And so I think that trust is essential in the system. I don't think anybody is going to make it, even if they've got some flashy thing, if they don't have the trust of multiple constituents surrounding them. And that is something that I've worked very hard on over the last 7 years. And PayPal is consistently in almost every market ranked as one of the most trusted brands in the world.
So I'm gonna, after this, I'm gonna email you a little snippet because your answer would so fascinating. On trust, privacy, simplicity. We have had conversations on security. We had the acting head of FinCEN and the White House cyber director. But before that, we actually had MDIs and leaders of minority depository institutions talking about what it means for them to succeed. And they haven't necessarily yet made that digital transformation in all instances. But what does it mean even for community organizations to thrive? And those were exactly the same two things that you just emphasized. They said, our people trust us, and they trust us with privacy, and can you communicate with them? I mean, it was almost an identical kind of answer, and I think that that's telling. It's telling that as much as some things change, some things are still sort of essential to the business, and it's just fascinating. Thank you so much, sir, for taking the time. I know it's early, but the fact that you would help to anchor this conversation today is just invaluable.
Chris, a pleasure. I wish we had more time because there's so much we could dive into.
Absolutely. Thank you, sir. Okay.
Hi, everyone. I'm Christian Catalini, one of the co-creators of Diem, formerly known as Libra, and the chief economist of the Diem Association. I'm also the founder of the MIT Crypto Economics Lab, and it's a real pleasure to be with all of you today. I've been working in this space now for a long time, and one of the things that get economists like me excited about stablecoins and crypto in general is that, when I look at blockchain technology, what I really see is a technology that can enable stronger competition in digital platforms, and stablecoins are really just an example of that when you think about payments and financial services. But of course, there's a lot more coming in this space. When we wrote a piece on the economics of blockchain a few years ago, we really stressed what we call the cost of networking. We think this is a fundamental way to change how digital platforms operate because they don't really allow the same degree of control that typical platform architects have over an ecosystem. And this is particularly important when you think about payments in the context of stable coins. Now, what is the reduction in the cost of networking? It's really about interoperability. And what we're seeing here is a picture of the early internet. The same way the early internet and the commercial internet later was able to reshape competition in a number of verticals across the economy, we think cryptocurrencies and blockchain will be able to do within payments, finance, digital content curation and creation, social media, and much more. Interoperability, as you all know, is extremely important to ensuring competition. It allows a small player to be perfectly compatible with a larger one. And in that way, it really opens up opportunities for new entrants, new startups to enter and compete with more established incumbents. And this is not just happening within payments with stablecoins, but also in other markets like finance, with decentralized finance, or digital content curation and creation with NFTs, so non-fungible tokens and the like. Now, what's interesting is that you often hear this narrative of cryptocurrencies and blockchain being about the removal of intermediaries. It's actually much more about changing the nature of what intermediaries do. And it also raises the question that when you remove intermediaries from the picture, how do you really ensure, whether it's in DeFi or in stablecoins, in any one of these markets, that these networks, these marketplaces really reflect society's values and principles? Think about basic things like ensuring AML, CFT, and broader compliance so that networks, these new types of networks can really combat financial crime and have integrity. And so when you take kind of a step out, it's really clear that there's going to be really a big interplay here between code, software, and institutions, the legal frameworks that are really built to support and ensure that the technology can achieve its long-term potential. From an economics perspective, it is clear that this is a technology that can really reshape and improve competition and drive kind of more innovation in financial services, not only through interoperability, but also by ensuring that there are lower barriers to entry for new startups and players, and that switching costs are minimal if consumers or merchants or businesses want to switch between, for example, different payment providers. It's also a technology that has a lot of potential for privacy, and that can be combined with robust compliance controls, which brings me to the topic of stablecoins. Stablecoins and their economic design, which is the focus of the paper, I've come a long way. The market really exploded over the last year or so. And when you look at some of the statements by, for example, Governor Brainard, there are real concern around their economic design, but also the legal framework around some of these stablecoins. Governor Brainard compared stablecoins to the private monies that were issued by the wildcat banks. That was a period that definitely was not, known for consumer protection and broader stability. When again, these currencies were issued by institutions of different degrees of quality. And as we describe in the paper, the word stablecoin is really a bit of a misnomer. When you look under the hood, although all of these are considered stablecoins, there's a wide variety when it comes to the quality of the backing and how these objects would really behave, not only under stressed market conditions, but also when there are changes in expectations on how they would operate. One important relationship that we surface in our economic analysis is the relationship between the reference asset, say the US dollar, and the asset that is used to back such a stablecoin. Of course, the gold standard for a stablecoin will always be a CBDC, central bank digital currency, and I'll get back to this topic in a second. On the other extreme, you have stablecoins today that are backed with extremely volatile assets that have almost no relationship with the reference asset. And so you have designs that could be exposed to full-on debt spirals. If you ignore kind of some of the complexity here on the graph, the basic takeaway is that most of, if not all of them, when they rely on algorithmic stabilization mechanism, are actually likely to run into a full-on debt spiral and lose all of their value if expectations about the success of the ecosystem related to that stablecoin were to ever change. We have this graph that kind of summarizes the quality of different stablecoin assets on these two key dimensions. One, the volatility against the reference asset. The gold standard, of course, is a CBDC, but you can also imagine something close to that, which is a stablecoin backed only by high quality liquid assets with additional capital requirements. So very much, taking concepts like the Basel III framework and applying it to the problem of stablecoins. And on the other axis, what is the likelihood that such a stablecoin can actually enter a debt spiral? And so when you map some of the existing projects on these two axes, you realize that what people think are stablecoins are really assets with a lot of intrinsic risk. Now, what's the upside? Why should we care about these new networks? With DM, we believe that stablecoins can play a critical role in expanding access to the financial system. When you look at the United States, we have a paper that kind of describes why we believe the United States is severely lagging behind in payments and financial inclusion. On average, you have 7% of the US population that's completely unbanked. That percentage is much higher, think about 15%, when you look at the bottom 40% of the income distribution. So there's a serious inequality issue that should be addressed. Now, if you want to tackle this problem, you really need to design a stablecoin that is optimized for payments. That covers issues like robust reserve design, as I was showing on that graph, but also other issues related to compliance, right? Really ensuring that this network cannot be used to accelerate financial crime. Now, what's interesting is that as we've been very public with what we think should be good stablecoin design, there seems to be a little bit of a response by existing stablecoin players. Although we're far from, the gold standard of a reserve that's properly designed and can really withstand shocks in the market. So it's a positive development, but I think, going back to Governor Brainer's comments, I think there's a lot of room for quality standards to be lifted. Within DM, this is also the reason why we made a public commitment to phasing out the DM dollar and moving on to a digital dollar, so essentially a CBDC, if it ever becomes available. I think this is a space where for all of these projects to thrive in the long run, they will need to establish a public-private partnership. This is something that the Bank of England has reiterated in its discussion papers on the topic, really a kind of a complementarity between public sector and private sector efforts. And we've also seen, for example, Vice Chair for Supervision, Randy Quarles, stressed the point that stablecoins and CBDCs could either coexist or almost substitute for each other. Now, I only have a few seconds left, but I want to point you to one more piece that we wrote with Zaim Masari from Davis Polk. In that piece, we tried to lay the groundwork for thinking through how can you upgrade the system of money that we have today, potentially with stablecoins and also CBDCs as complements, not as competing systems. And in the piece, we describe in a lot more detail 3 potential solutions. Now, it's important to stress that these solutions are not mutually exclusive. And in fact, you could imagine governments around the globe exploring with these different solutions at the same time. The first solution is the true stablecoins, which look a lot like narrow banks or special bank charter institutions. They're essentially driving a strong medium of exchange payment tool on their networks. You can also think about deposit coins. These are much more integrated with the existing banking system. And the last solution we talk about is what we call CBDCs on multiple rails. Now, there's a lot more detail in the paper, so I'll refer you to that. But at a very high level, we believe that both public sector and private sector can play a really important role. And in fact, they have comparative advantages that can play to each other's strength in building the future of money. I'll leave you with one thought. I want you to think about CBDCs and stablecoins actually as complements. Often the narrative is about them competing with each other. But as you'll see in the details in the papers, there's actually an opportunity here for collaboration between public and private sector. Thank you.
We are now up for a really interesting and fun session. We are obviously in the business today of pricing risks and opportunities, and I have 4 of the best to help us do that in the crypto space. Nick Carter from Castle Island Ventures, Rumi Morales, a partner at Outlier Ventures, Milton Demirs from CoinShares, and Patrick Merck from Transparent Financial Systems. He's our our shadowy coder in our hoodie for today. But it's a pleasure to have you all. You've made your marks in so many different interesting ways. And hopefully we can have and take this opportunity to break down some complex ideas into some bite-sized, interesting observations in a space that can be a little bit intimidating and certainly is not without its own sort of levels of complexity. Okay, let's talk a little bit about crypto assets and about pricing crypto assets. Nick Carter, I'm sure you get this question a lot, but maybe just for our audience, when you look at a crypto asset, and there's obviously a wide variety of them, what are the most important factors, that you think people take into consideration when trying to price a crypto asset? And are there any factors that for you hold particular priority or importance?
Yeah, well, I think you have to assert a taxonomy in order to determine, what, I guess crypto assets are pretty heterogeneous in my view. And so, you first have to determine, is this something which is sort of equity-like? Does it give you, an equity-like claim on certain cash flows, in which case pricing it is much simpler and more straightforward? Is this kind of a network equity in some sort of smart contract that's generating value, spitting off value that investors have a claim on? Or is it more of a commodity? Like, in my view, Bitcoin, for instance, would be more analogous to a commodity, in which case you're just looking at the supply dynamics, which are very straightforward, and then looking at the demand side, and what are the potential drivers of demand? And so, it's interesting to think about, performing valuation or pricing, regular physical commodities. You look at sort of industrial demand and monetary premia and why people might be buying precious metals or something like that. I would argue it's very similar for the commodity style crypto assets. And so for me, the things that matter the most are the demand side variables, because of course the supply side is generally sort of fixed or predictable.
So Rumi, would you agree with that? And if so, does that mean that's just a lot easier to sort of price, let's call it, commodity crypto assets than it is other kinds of crypto assets?
I definitely agree with Nick's analysis here. I think, though, in addition, what's interesting about many token networks is you're able to price things in a much more transparent way than you might of some traditional assets. And I'm speaking specifically around IP and brand, right? So I often think of a token. Many people say, well, how can you tell one token apart from the other? For those that are developing these companies, for those that are really thinking about their token economics, you'll be surprised at just how much complexity thought there is. This is intellectual property that the companies are developing. The great thing here is that people are able to invest directly in that, right? Take their view on that IP via the token. The same thing goes for brand. We all know like Coca-Cola or the Girl Scouts, these are strong brands. But how can you take a view of that in and of itself from an investment perspective? There are thousands of crypto assets out there, and I think many people are just trading the top 10 because it's quote unquote easy. I wouldn't discount, though, the value of the brands that have been developed here amongst these tokenized assets. And so you have to take some of these intangibles now in a way that you can actually price them too. I think that's what makes this a really fascinating industry to be an investor in.
So just to follow up on that, because I would assume that if you're a large market cap kind of crypto asset, right, that just by definition, then I don't know if you'll have a better brand, but at least you'll have a more recognizable brand, right? So when it comes, to pricing, is there a kind of a sort of a snowball effect there, or that creates, frankly, higher barriers to entry that comes into your pricing decision when you have sort of, new tokens that come into market, simply because they may not be as well known, even if they have good IP?
If that's just for me, I'm happy to keep on answering. But
Yeah, no, well, yeah, I was just, yeah, it was for you. It was for you, just as a response to that.
It's one of many things that I think you can look at. For me, I just highlighted it because I think it's pretty unique in this space.
Yeah.
And certainly you can see, new like Solana, for example, it's been around, but it's only been for a while, but it's only recently that it's been elevated. And you can't say it's just because of a brand necessarily, but what they've been able to prove technologically over time. But to Nick's point as well, I think as investors, we all have to develop our own framework for analysis. And for me, brand and IP, right, or really everything that's around the token. And I guess for the brand, by brand, I really mean community, right? Community adoption and user growth. That's really what's driving a lot of this. Those are really important factors for me.
Super, super, super interesting. So again, just sort of thinking about pricing and, how you go about assessing and thinking through crypto assets. Patrick, you have the misfortune like me of also being a lawyer, but when you think about, crypto assets versus say a security, how do you think that pricing perspective and process differs when trying to compare a private security? So let's maybe something that's the security of an issuer that hasn't gone public, but like a private security to a crypto asset.
Yeah, well, thanks for outing me, Chris. I've been trying to hide the fact I'm a lawyer as best I can here.
I know.
But it's true. It's true, to my shame. So I think the biggest thing when you're comparing, say, private equity in a startup or something like that versus investing in a token from a token project, it really comes down to a few things. One is liquidity, right? Like you just get liquid faster on an investment in a token typically than you would in sort of like an equity investment in a startup. And I'm sure Meltem has like a ton of experience and can speak to like the differences there as well. The other thing is managing sort of public market sentiment from day one, right? In a private equity startup, you have a long runway. Potentially, you never go public, but for the companies that eventually go public, you have a long period of time where you're sort of dormant. You don't have to worry about public market sentiment as much. You really just have to appease a small group of shareholders and make sure that the business is on track. With some of these token projects, as soon as you launch and you're out there in the market with these tokens, you have to manage that public market sentiment in a way that you wouldn't have had to have done before. So I think that's a big difference and something to factor in when you're looking at like the value of these different things and the value of the team behind it. I think the other thing, and we see it both in the public markets and the private equities markets and in token projects, but it's really pronounced, I think, in token projects, is the power of narrative and story around pricing of different objects, right? There was this great article I was reading the other day where they did an analysis of Antiques Roadshow and how they had this one thing where you had Civil War bullets and they were worth like $1, but because the person had labeled the boxes that the bullets were in with the battlefields where they were found, they were worth thousands of dollars. They're the same bullets, but the story was different, and the power of that story in driving it. Now, obviously, we've seen that play out in the public security space to an extent, but I think it's really magnified in the token economy even more so.
Okay, you're going to get an extra star for that answer because I've had dozens of conversations on crypto assets, and Antique Roadshow ranks up there with I think when Nick once brought up like Immanuel Kant and dialectics. Those are unexpected things. So Antique Roadshow, you will get a gold star for that one.
Well, speaking of Nick, think of the narrative power around tungsten cubes, right? Like that Nick has been able to like summon into being, right?
True. So Meltem, okay. So when you think about again the same issue, and I think since we did have Chairman Gensler on a little bit earlier, I'll throw and stack on an additional question to that. But when you think about again pricing a private security, so this is something where there's been no registration statement, no public filing, but a private security, and you go and you compare how you'd make an investment there to say a crypto asset, what does that look like to you? And where do you get your information, and how do you compare and contrast the quality of the information that you would have in those two very different sort of scenarios?
Yeah, and that's a great question, Chris, and it's one we think about a lot at my firm, CoinShares, where we manage $7 billion in assets across a variety of different crypto assets and recently equities as well. I think, again, as you alluded to, the biggest issue here when investors are looking at the space is really information, right? Historically, we've relied on authoritative sources for information, and typically those are institutions who have been given specific rights by regulators to do that job. Now, the funny part is they're really not very good at doing that job, as we saw with credit rates and scores, with the financial crisis. If we look at the failures we've seen time and time again in reporting, the one thing I always say, and this is probably going to make the lawyers in the room mad, being registered, the only implication of security being registered is that they've hired lawyers and filed paperwork. There are no implications around quality. There's certain implications around data transparency, sure. But again, as we've seen, that data has been manipulated. There are a lot of questions around the accounting practices of firms. For example, Tesla, one of the largest firms in the market today, doesn't even have a chief accounting officer, right? So I think, again, there are just some fundamental questions about the way that we look at authority and information when it comes to making decisions around investments. When we look at the crypto space, one of the incredible things is these are public, open, distributed ledgers. And the ledger in and of itself is a tremendously rich source of information. So there are a number of data sources that extract information directly from the ledger. Nick could probably talk about this more because he founded one of these companies called Coinmetrics, but there's a number of others, including Flipside Crypto, including Masari, including Glassnode, and many others. And the interesting thing is the ability to manipulate data in the crypto space is greatly reduced because everyone has the ability to query data from the network. Now, the interesting component is how do you interpret this data, right? And this is a little bit of where like the juju, the magic, the witchcraft comes in. This is a very early space. I don't think we have good analogies for public company valuation metrics for the crypto space yet, although they're developing. For example, the way I view it is there's data points at the protocol level, at the network implementation level, and at the application level. We can look at the protocol level, how robust is the code, how active is the GitHub repo or the code repository, how many developers are working on it. We can look at the number of reference implementations sort of from a security perspective. When we go to the network layer, right, which is the physical instantiation of the protocol, people running the code, we can look at the number of nodes in the network, which means the number of people running that code. We can look at the amount of uptime of the network, like is the network robust? Is it highly secure? Are transactions going through on a regular basis? Has there been downtime? Have there been critical faults in the network? Have there been soft forks or hard forks, which means disagreements over code and splits in that source code. And then as we look at the application layer, right, this is really where the more traditional internet metrics start to become relevant. What are the number of wallets, right? I can't look at the number of users, but I can see what are the number of wallets? What are the number of daily transactions? What's the daily transaction volume? What are the number of smart contracts being run? What's the throughput per transaction? Are these really low value transactions? Are they high value transactions? So again, what we can start to develop, right, is a basis of knowledge and a basis sort of comparison to start to understand these things relative to one another. But I think the last point I'll make, and I think this point is really critical, is even from a classification perspective, right? Because these things are so nascent, it's really difficult to categorize these things in relative buckets. Because again, as we look at the market, right, what do we do when we look at the market? We compare investments based on their relative merits and where, what you're actually investing in. Are you buying debt? Are you buying equity? Well, a token is neither debt nor equity, right? It's a new sort of section on the balance sheet. And I come from the world of corporate finance. As I look at my balance sheet, I have assets, I have liabilities. When I issue a token, I have an asset, but I've also created an offsetting liability, right? And so the question is, well, how do I measure that? How do I evaluate where that fits in the capital structure? How do I evaluate the relationship between a project's assets, liabilities, and the value of the token? These are all questions that are really not yet well understood. And what firms like ours are trying to do is to further untangle that relationship, to find analogs to the world that we all come from, to the world of traditional securities and traditional financial instruments, so that we can start to form some relative value judgments and start to create categories that enable us to compare and contrast relative value. But again, in a way, this exercise is sort of a challenging one. And I think, again, where the conversation breaks down when, we're operating in this new world where we have these new categorizations, these new classifications, these new business models, and people are coming from a very different perspective. Maybe they've spent 30 years, thinking about Howie and orange groves. It's not always easy.
No. Howie, hey, Howie's great. As a matter of fact, I'm sure I've a class with students, and we're working through crypto assets, and they've gone through the orange groves, and it's interesting because they just listening to your answer. It was a fantastically rich tapestry of sort of different kinds of sort of inputs and considerations. I think that from someone who's teaching this class right now, I'm sure some of my students are both freaking out and saying, "Oh man, he's kind of right. Like people are thinking about these things," and then they're also freaking out by saying, "Man, there's a lot of stuff that I never really had to think about if I'm going to invest in like stocks," right? So if I want to, a lot of people when they're thinking about buying or, should I buy the shares of a car manufacturer? They're like, yeah, I really like those cars. I mean, they're going to sell 1 million of those, right? And they just kind of like buy the shares of the car.
Now, hold on, Chris. I want to make a really important point here. When you're investing in the stock of, say, Tesla, right, you are relying on the fidelity of information that's being provided by the company itself, right? And yes, there are rules and regulations in place, but frankly, there's been a ton of accounting fraud and nobody's gone to jail, right? So the amount of fraud that's happening in the security space is very high already. The very interesting thing to me about a blockchain and about cryptocurrencies, and in particular things like Bitcoin, is you as an individual do not have to rely on an entity or a company. All of the data is on the ledger, right? And that data can be queried. It cannot be faked. So from a transparency and investor protection perspective, cryptocurrencies themselves are actually much easier to audit and understand and to have fidelity of information. So in my view, it's sort of interesting that there are these claims being made around fraud when there's already so much fraud happening in the securities sector due to this triple entry accounting system and the fundamental lack of investor transparency. And so again, I think there's sort of this dichotomy.
To your point, and it's really interesting. We had the other day the acting head of FinCEN on, who actually did make a very similar point, about the fact that there's a lot more transparency. I think that the point that I was really trying to make, and this is something that Hester Purse has brought up, and I think it's a really interesting point. I had her on my podcast once to talk about it. Is this deeper question about like the informational economy, right? And like there may be more information out there, but then there's this other question about like the ability of people who are newcomers to be able to understand that in other words, their ability to take advantage of all the transparency that you're observing. You had mentioned Nick, and I'm going to return to him now, since I don't want to make your head explode, but since Meltem is like kind of called you an interesting kind of gatekeeper intermediary, like how do you look at that particular issue? You and I have talked about this many times before, but on the one hand, this transparency issue, but when you get to the pricing, and even if you can get that list of things that are really salient and that make it interesting and kind of different, when you move into things like a retail space, like how do you get from, the starting point to a point where that kind of transparency can be leveraged?
Yeah, I mean, it's enormously challenging because there's so much we don't understand about the asset class as of yet. But I was struck by the magic of public blockchains creating this abundant information that was unfortunately hard for regular folks to pass several years ago, which is why I founded a blockchain data analytics company specifically to surface that information and democratize it. Coinmetrics gives away terabytes of free information specifically in an effort to help market efficiency. That's sort of the core objective, to help regular folks that to understand the usage characteristics of blockchains so they can make better pricing decisions. And there's many other fantastic companies to do the same. And so that's the thing that is remarkable about blockchains is for the most part, a lot of the information is available on the replicated, ledger on the database that everyone who runs a node has access to that database. And it's just a matter of pulling the data out and making sense of it. Obviously, that's not trivial, much of the time, but the problem is, though, I think you're asking the right question, is what is salience? I mean, what is the information that's actually the most relevant to investors? And if I recall, you wrote a great paper about this several years ago, Chris, which, I think about a lot because we don't currently have disclosure frameworks in the crypto space, and we certainly ought to. So, with certain assets, you can have a notion of sort of real-time financials, which is like, imagine, a 10K report that's updated every 10 minutes instead of, on a quarterly or annual basis, right? So to the extent these things have cash flows associated with them, you can build a real-time financial model that pulls data from the blockchain, which is an incredible capital markets innovation, in my opinion. But for other crypto assets, it's just very hard to know, what you should be looking at, because there's abundant data, but, there's not an abundance of sort of insight, and it's not clear what the drivers are. I haven't ever really seen a great bottom-up proposal from the industry for some sort of disclosure framework that would create an analogous set of disclosures such as you might expect from public markets. I've never really seen that from the industry, and I certainly haven't seen it from our regulators either. But my view is that this is ultimately a distinct asset class and it deserves its own disclosure treatment.
Thanks for that, and I really appreciate it. And I did earlier today with the chairman. I just sort of mentioned that it's just interesting. I mean, when you think about, okay, not to be too lawyerly, but the 33 and 34 Act, New Deal companies, Ford Motor Company going public or something, and you're thinking about the governance of a, board of directors and a CEO, and then you compare that to blockchain governance, it's completely different. And so even if you got past the categorization question, identifying what then is material or what is salient seems to be something that's kind of relevant. Just to sort of keep, though, just for a moment on that, on the investment track, because we did start off with some amazingly interesting data, and it's coming from PitchBook this morning, and he took us through a couple of slides looking at sort of the money in VC, particularly in the crypto space. Rumi, just to sort of continue that line of conversation, there's been just an enormous amount of money going into crypto, just spectacular, really. Where do you see most of the growth kind of being directed towards in terms of what sort of from your perch? I mean, are we looking at it in terms of tokens, custody solutions, scaling, DeFi, carrier pigeons, something else? I mean, like, where do you see a lot of the money sort of flowing and a lot of the interest going right now?
I think it's a terrific time right now to be an investor in crypto because you have far more choices. You can express your view in many more ways than just, say, 5 years ago, when it was primarily just around financial services. So I think there's definitely, for those in the FinTech or financial services space, there are any number of views you may want to double down on or invest in, and you'll see a lot of money going towards things like custody solutions, like you mentioned, around new, market infrastructure systems or bridges between centralized finance and decentralized finance. But now as well, certainly at Outlier Ventures, which focuses on the metaverse, we're unlocking this whole new crypto world around media, art, entertainment. We've seen this with the growth of non-fungible tokens, and it's a very, very exciting time. It's really opened up completely new industries. So whether you are now, Sotheby's or Christie's or Dolce & Gabbana or the NBA or whatever, you're seeing a lot of more money in these areas too. So it's incredibly fascinating. For me, we're moving away from just people thinking that this is a financial industry technology to realizing that this is a ubiquitous technology for a new digital economy that we're going to be living in the physical and the virtual worlds. So yeah, money is sloshing around everywhere, but it's not just in finance anymore. It's really arts, entertainment, media, gaming, of course. Yeah. And then increasingly, robotics, IoT, you name it. I'm sure the others on the panels are seeing the same things, but we're seeing deals across the board.
Yeah, Dan Schulman actually was up maybe 30 minutes ago or 45 minutes ago, and he had made a very similar kind of observation. We also had a great conversation with a University of Virginia media studies professor who was making these great observations about how money itself is becoming media and media money. I mean, just when you sort of look at the evolution of community. Yeah, Melton.
If I can interject there, I think the other thing that's really interesting, just to tie this back to other things that have been happening in financial services community, I think increasingly investing is a form of entertainment, right? Like investing in and of itself is a form of entertainment. We can debate the merits of whether this is a good thing or a bad thing. Certainly, I think there are strong views on both sides. But I think, again, one of the really cool things that we're seeing across the spectrum here is, people can start to monetize things in different ways. And again, if we think about markets, right? Having started my career as a trader, like markets are the ultimate game. And I think when people were at home during the pandemic, there's only so much Netflix you can watch. They're like, wait a minute, what is the deal with the stock market? All of a sudden, everyone was talking about money and trying to understand the history of money and what a deficit is and what a budget is, right? It is really the first time in modern history where money and conversations around money and fiscal responsibility entered the national sort of consciousness, became part of the cultural zeitgeist. So I do think there's this huge shift that's happening, and we now have this really incredible infrastructure that can facilitate these new types of markets to exist. And I think a lot of people are really still trying to wrap their heads around that, because it's a pretty transformative shift. And I think it's really scary to people because they don't understand it, and it's just so different. There's no CEO of a blockchain that you can pick up and call.
So we're actually going to have like a subsequent session on the platforms and gamification and memes. I only disagree by saying that's why when you run out of things on Netflix, you have Hulu and Amazon. But those are other sort of meta debates. I did want to end on since there's only a little bit of time left, going back to our crypto lawyer, hidden guy, Patrick. Look, in this conference, we've obviously talked a lot about regulation, and that's why I wanted to have this conversation as well. But there is a lot of activity, obviously, and things coming down the pike. And as an investor, one way or the other, it could have an impact. I mean, what do you think about the impact of regulation on the sector? Do you think that any particular sort of niche in the sector may end up being more impacted than others? Does it temper your enthusiasm, or should it temper the enthusiasm of investors?
Well, it certainly, my legal answer is it depends, right? It depends on what the regulation is. But if there's like a theme from this whole conversation, I wish I could attribute the quote correctly, but it's, that like objects don't have an inherent price or value, right? It's the price is a judgment that's being made about those objects. And this is why we're talking about the information and the data and all of that. And if you look at crypto assets, it's the ultimate like DYOR kind of like asset class, right? Do your own research kind of asset, right? And so people are making that judgment. They're expressing themselves, as Rumi put it, and as Melton put it, they're entertaining themselves, but they're also like doing it in a way that they're with a focus on like, what's the future I want to see? If you look at the people who are investing in this asset class, it is based on the Twitter sample, maybe, this is a younger audience that has not really had the opportunity to participate in the wealth building that previous generations did. And this is their opportunity to build a future around what they want. To the extent that regulation supports that, right, that general narrative of like, let's be inclusive and give this next generation of investors the opportunity to build wealth and create their opportunity in their economy, then it's all for the better. Better information, better ability to actually inform that judgment you're making about the price of an object. To the extent that it starts closing in on that, you're going to get a lot of contested ground, right? And it's going to lead to a lot of conflict.
also something I brought up, and just such a critical, interesting point that the new retail investor will be following that up right in about 10 minutes. But I did want to thank Anna. You know so much from probably, I don't know, having hacked us or something. No, seriously though, guys, thank you so very much. This insight was just invaluable. I know you're very, very busy people, but I look forward to more conversations in the future. And with that, we'll be turning to our flash presentation.
Hello, my name is Chris Macheri, and I'm a second-year MBA student at Georgetown University. Last fall, I had the opportunity to write a white paper for the Center for Financial Markets and Policy at Georgetown, exploring the topic of institutionalization of digital assets. In the crypto space, 1 year could feel like 10 years, and a lot has changed since I first published this paper almost a year ago. However, much of what I talked about in this paper is still relevant and timely, and my thesis remains the same. The general thesis for my paper is that the digital asset space has matured a lot and is currently much more institutionalized than people think in its current state. But there is still a lot of work to be done before digital assets can truly reach their full potential and have the impact on society that many believe that they will. I structure my paper into two main sections. The first explores the current state of digital assets and what makes it institutionalized today. The second part, I examine what is still needed in the space to make it more accepted by institutions. In the first half of the paper, I examine things such as growth in the derivatives market as a sign of institutional adoption, growth in investable crypto products, growth in lending firms, the normalization of volatility in the crypto market, and recent guidance from regulators pointing to signs of regulatory acceptance. In the second half of the paper, I try to answer what that next level of institutionalization of digital assets will look like by discussing ETFs and what is preventing their approval, improved regulations and regulatory clarity that is still needed, custodians and prime brokers increasing their operations to bring in more institutions, more actual use cases for digital assets, and finally, more general market awareness. For the sake of not repeating many of the topics already being discussed by some of the amazing scholars and researchers here at this very conference, I thought I could hone in a bit more on the derivative space for this presentation as a microcosm for my general thesis for my paper. That is that institutionalization is already occurring at a faster rate than many realize in the derivatives market, but there are certain things that can be done that can accelerate this and bring in more institutions. As I discuss a bit in my paper, the CME Group's regulated Bitcoin futures market is a perfect way to measure institutionalization. Unlike many of the offshore exchanges that anyone can sign up an account and start trading within minutes, the regulated futures market is dominated by institutions. CME's clientele includes nearly all of the world's largest banks, hedge funds, asset managers, commercial hedgers, and high-frequency market makers. In order to open an account to trade Bitcoin futures at CME, a trader and entity must have an FCM or a futures commission merchant that is sponsoring their trade and willing to take on the risk for this trader. This process would be too difficult for many of the retail trading community that are thought to dominate the crypto market, indicating that much of CME's Bitcoin futures volume are actually already existing customers of their exchange that are likely trading Bitcoin in addition to many of the other products that they currently trade on the exchange. After launching their contract in the last few weeks of 2017, CME's Bitcoin futures market has really taken off. In 2021, CME's Bitcoin futures set records of over $80 billion in notional volume traded in the month of January and over $2.5 billion in open interest. This growth is staggering as CME averaged only about $7.5 billion worth of monthly notional volume in all of 2019. However, even in 2019, Bitcoin futures ranked as CME's 55th largest contract, which is impressive as they list over 500 contracts and the exchange is nearly 200 years old. Perhaps even more indicative of institutional adoption is the growth in long open interest holders. Long open interest holders are market participants that must register with the CFTC's Commitment of Traders report because they hold more than 25 contracts in a certain market, which in this case is equivalent to an over $5.5 million position. That is something that is a clear sign of institutional traders or money managers. In January, CME hit an all-time high of over 100 reportable commitment traders on this Commitment of Traders report and currently stands at around 75. Next, CME ranks amongst the largest venues in the world to transact US dollar to Bitcoin. CME continues to take market share from some of the more unregulated exchanges, derivatives exchanges, as can be seen in this graph, with about 13% of the total open interest market share. As one can see, the growth in CME's Bitcoin futures market is extremely impressive, and the fact that they were so successful speaks to the growing level of institutional interest in digital assets. While the growth in CME's market is extremely impressive, there's still more they can do to speed up the on-ramp for institutions that want to adopt digital assets. For example, more investment banks need to start offering custody and prime brokerage solutions to their buy-side clients that want to adopt digital assets. To this day, many of the largest investment banks still do not offer clearing of Bitcoin futures or the necessary custody or prime brokerage support needed that hedge funds or asset managers are used to in other markets that they trade. Next, current exchange requirements for Bitcoin futures are around 35%, which is extremely high for a typical derivatives contract. For example, the typical futures contract margin sits at around 2 to 5%. Higher margin for Bitcoin futures is obviously needed to the greater volatility, but too high of margin deters traders and takes away many of the leverage benefits that come along with futures. In many markets, CME also offers the ability to cross-margin products if there's a correlation with some of their other open positions. For example, cross-margining between an S&P 500 futures contract is able to do that with a NASDAQ 100 futures contract because the two indexes are so heavily correlated. There is enough data at this point to show that there is some level of correlation with Bitcoin, with the equity market, gold, or other commodities that the CME should start to allow cross-margining with some of these other asset classes. This would lower the margin requirement for traders and free up necessary capital to start trading. Next, the CME should look to list additional cryptocurrencies outside of just Bitcoin and Ethereum and start exploring some of the other popularly traded cryptos that institutions look at, such as Cardano, Solana, or Ripple. While adding more coins, CME should look to offer pair trades between Bitcoin and some of these other tokens like they do with the foreign exchange market. Finally, the CME should look to offer more appropriate contract sizes. While mini contracts have had a great success for CME across other markets and were recently introduced to Bitcoin, they're still a bit too small. The current contract sizes for CME are over $200,000 or $4,500. These are way too dispersed. There should be more manageable contract sizes being offered. Perhaps CME could even consider offering some sort of a floating contract in terms of the number of Bitcoin, but constant dollar value at, say, $50,000. Lastly, one of the major problems CME faces with its Bitcoin futures market is that the regulated derivatives market is closed over the weekends, while the rest of crypto market is always open. This leads to potential major issues because CME's Bitcoin futures tracks the price of the underlying spot Bitcoin market, and many times there are large moves over the weekend. This results in gaps between the Bitcoin futures prices and causes their market to either open limit up or limit down on occasion. The CME should consider opening its Bitcoin futures market for trading at all hours to replicate the spot market and prevent some of these gaps, which have noticeable effect on the market and their prices. While this would be quite radical, it could prevent volatile moves that result in these gaps when the CME market is closed over the weekend and could ultimately help bring in more stability to the market, which would draw in more institutions. In conclusion, my thesis for this paper that the digital asset space is more institutionalized than many realize, but there is more work to be done to draw in more institutions can be seen as a microcosm by examining the regulated derivatives market at CME Group, which I discussed in greater detail for the purpose of this presentation. I'd like to thank everyone who helped me with this paper, especially Professor Rina Agarwal, Professor Alberto Rossi, and the entire Center for Financial Markets and Policy at Georgetown, and all my former friends and colleagues at the CME Group. Lastly, I'd like to especially thank Professor Chris Brummer for giving me the opportunity to present this paper at this very prestigious conference. Thank you.
Thank you so much for that terrific presentation. And I'm delighted to welcome all of you all to our panel on gamification of the trading markets. And we have a truly, truly phenomenal panel today. On behalf of all of us, we are thrilled and delighted to have this opportunity to be at this really remarkable conference. This is the Met Gala, the Oscars, the Grammys of FinTech all in one. And our thanks to the one and only Chris Brummer, the BIS, and other sponsors for the opportunity and the honor to get to take part in this panel. This has been a truly big week, a momentous week in the world of gamification of the trading markets. And we have a remarkably eclectic panel to talk to us about the issues involved. As we heard this morning from Chair Gensler, we had the release of the SEC's report into the events of January 2021 and the meme frenzy that took off and that raised all sorts of questions about retail investors, market quality, and gamification. And of course, this week we had the launch of the Bitcoin ETF. And to talk about all of these issues, we have Raphael Auer from the BIS. He leads research into innovation and digital assets. We have Dr. Camille Bousset, who is a senior fellow at the Brookings Institution and the head of the Race, Prosperity and Inclusion Initiative there. She's also a public governor at FINRA. And we have the one and only Michelle Bond, who is our 007, Michelle Bond, who is a sort of a veteran player in the industry, a policymaker as well as in the industry itself. And today she's the CEO of ADAM, the Association for Digital Asset Markets. And we have Andrew Fishman, Dr. Andrew Fishman, who is our Dungeons and Dragons video game savant. He's a retail investor, and he is also a therapist who deals with issues surrounding addiction. Now, just a quick disclaimer on behalf of all of our panelists, the views here represent their own views and not the views of any of their organizations. So to kick us off, I wanted to ask a very broad question. What exactly do you guys see as being new here? We have had retail investment surges in the past before. What do you think is different, is unique, is interesting about this latest stock frenzy, this gamification that we're seeing in the marketplace today? Michelle, as a veteran of the industry who's seen it on all sides, would you like to just kick us off?
Absolutely. And thank you so much, Yesha, for having me here today. Thanks to Chris Brummer, BIS, Georgetown. Very excited to be here. Look, I think we can all agree that there's something new and unique happening in the market. We're seeing more retail investment than we've ever seen before. I would say more retail investment participation than anyone probably ever thought was possible. And I think it's critical that we separate this out. The idea that there are more retail investors who are taking control of their financial future in ways that prior generations could have only dreamed of. I think that's a great thing. And could you imagine 20 years ago, someone saying, I can invest in any company I want. I don't have to pay commissions and I can just use my smartphone. I mean, that's pretty remarkable. So I do want to just kind of like take a step back for framing. Look, I think there's a powerful wealth creation opportunity here. And we talk a lot in DC, at least I'm based in DC, and we talk a lot about how the cards can be stacked against the average ordinary American. And whether it's the cost of college, whether it's buying a new home, whether it's an opportunity to invest, we do talk about how the cards are stacked against. And I think the fact is that retail investors have really never had it better. In fact, Senator Ranking Member Toomey of the Senate Banking Committee talks about this a lot. And I think the ability to take a modest amount of money and transform it into wealth is a truly amazing opportunity that we should be celebrating. I do think, I'm fearful, and obviously the topic of today's discussion is gamification. I am fearful that some issues are being conflated a bit. And I think what happened in January surrounding GameStop and, AMC, the discussion of gamification, I think that should be separate and apart from just like the access to opportunity for retail investors. And I do caution against any attempts from, just federal government paternalism and a desire to control retail investors, because we're in a good spot here.
So based off of that, Camille, you look at some of the behavioral aspects. Is there something new here behaviorally that you are detecting in today's stock market trends and the gamification debate?
Well, thanks, Yasha, for that question. First, I just want to say I'm thrilled to be here. Very happy to be with my fellow panelists, and thank you to the sponsors of this program. So I would agree with Michelle that democratizing investment in the way it has been done is overall a positive thing. But like all, changes in the marketplace, where investors have an opportunity to engage with the marketplace in a slightly different way, it also requires that the investors be informed. And what we see, obviously, is that investors are not informed. In general, investors have pretty low level of information and low level of investor literacy across the US. And that has been demonstrated again and again in a variety of different sort of studies. So what happens is, in a context like this, where you have huge explosion, huge democratization, lots of different kinds of people in the market as retail investors, is you have companies who are studying how it is that you keep those folks engaged, right? And particularly people who are not do not have pretty low levels of investor literacy. So how do you keep them engaged? So what happens is, like any good marketing organization, a lot of these apps are really taking advantage of the levels of low literacy and taking advantage of what we now know about behavioral psychology and how people react to constant alerts, to understanding that they're within a context of other people investing, that they can be compared to other people like them, that there are all kinds of charts and everything else that can be put up in front of them on a regular basis, regular touch points, that allow them to constantly think of themselves as an investor and to not pull away and see themselves as having a range of options, not only in terms of the apps that they engage with, but also in terms of the kinds of investments that they have. So I think that sort of what's new here is the sort of constant touching of the investor in a way that appeals to people who are new, want something exciting, don't really understand kind of the pitfalls of being engaged in the way that they are being engaged. But I think it's, an interesting point that we're at. And I think there can be some corrections on the investor education side that would make this more of an opportunity than it is already.
So, that's completely fascinating, Camille. And I think it leads to a question to our addiction expert. Andrew, you are a user of these apps. You are someone that also is obsessed with video games, and you are into addiction therapy. So given what Camille said, can you put this all together? Like, is there something about the apps that you find particularly compelling? And is this like other addictions that you're treating in your practice?
Absolutely. Some of the most obvious ways that these apps have become game-like are pretty transparent. Robinhood, I think when you start, they give you a virtual scratch-off ticket that you actually have to scratch off with your finger on your phone, and it tells you what stock you just won. And when you invite friends, you get to do that again. Webull has a virtual roulette wheel that you spin, and it tells you, did you win another stock? Did you win our special bonus features? I got push notifications. I wrote down some of these. One-time special offer, 4,000 shares of Tesla are waiting to be claimed. Participate in our wheel event to win awesome prizes. You have a 100% chance of winning a free stock. This is game language. This is stuff that the tech industry is pulling directly from casinos and video games and things that they know will be compelling and really, really hard to ignore. The more that they make these feel like a game, the more people will forget that they're making a serious financial decision. And I think that the Robinhood came under fire for the confetti animation. I think that that's the least that they did. I think that all these apps are growing so strong in what they're doing, and it's getting, they're getting better at it, that the confetti animation is sort of Bush League by comparison.
Sorry.
Go on, yeah.
So putting this together, as Andrew's saying, that we have all of these kind of game-like features. Camille's pointing out the lack of literacy in the market. Raphael, based off of your sort of economic sense of things, how sticky do you see this trend being? I mean, do you feel that when retail investors lose en masse, are they going to disappear from the market? And then what does that mean for the market in terms of its overall capital and quality?
Thanks. Let me also just say it's a great pleasure it's a great honor to be here in this panel. It's a great mix. Thanks to Chris and to Yesha. And also let me start by saying that financial innovation is a good thing, and central banks around the world are really embracing this. The BS with its innovation hub is actually at the forefront, and also we call it gamification, but sort of the accessibility of assets that comes with a smartphone that is connected to a credit card and that can offer a seamless entry point into finance is a good thing too. But of course, there are also risks. And I think Andrew, Michel, and Camille framed it nicely in terms of investor sophistication. There are new investors that have never done it before. We've also, we have a very different macroeconomic background for the last 10 years. We have a very long time of very low interest rates, and this might not go on forever, and asset prices might go in many directions. So there are these issues of consumer protection if apps nudge investors into a certain direction. And here there are also new risks can emerge. And I think what and this goes really back to the heart of the question, how long lasting is this? And I think obviously low access barriers will remain, right? The smartphone won't go away. But what we also see now is sort of a feedback where retail investors pile into some stock that obviously then increases really in price, and that attracts more retail investors, and we see narratives spinning on social media around what is really happening and why this is the right investment product. But there are like people that are driving these narratives because they profit from them in one way or another, and sort of and this has an implicit risk that sort of we will also see crashes and some retail investors suffering losses and maybe then leaving, right? We saw this about 20 years ago with the new economy bubble. And I think as a regulator, the main thing is that when you see new market structure emerge, that comes with new risk, and it's not that the new risks are larger than the old risks in the existing system. It's just that you need time to understand them, and you sort of that's sort of why sometimes a slower approach and a long-lasting approach is sort of preferred from our side. And so to sum that up, I think it's really more democratic access is gonna be a permanent characteristic going forward, but there will be some hypes and some bubbles will burst.
So on that topic, sorry, Michelle.
Oh, I was just going to add, yes, there may be new risks with this increased participation, but I do want to just highlight, and Camille knows this very well, that the SEC and FINRA have many laws on the books that govern everything from communications with customers to advertising to other forms of social media content. And I do trust that the SEC has the existing authority they need to suss out deceptive practices and to ensure that retail investors are protected. So there is an existing body of law that covers this. The other thing I would mention is that the industry is also playing a role. We have a code of conduct at ADAM that all of our members agree to adhere to, and it focuses on market integrity. It focuses on fairness, conflicts of interest, and avoiding them. So all of this would all be covered by our code of conduct, which really is a governing document for the industry.
So I'm really glad, Michelle, that you raised that point. Given what Andrew said, Camille said, Raphael, and how suitable are our current paradigms in regulation for dealing with some of the behavioral risks that are emerging? So as Andrew, and Andrew would love to get your thoughts on this, do you think that just disclosing the risk, for example, is enough? So even if we do have new rulemaking, or we use existing rulemaking, as Michelle is saying, or existing codes of conduct to highlight risk and to disclose like we normally do, is this sufficient to overcome these kind of addictive features that we're seeing in these games? Andrew, do you want to kick us off, and then we'll get everyone
Sure.
to chime in?
I don't think that just disclosure is enough. We already, I had to click through. Yes, I agree. I know that this is risky. Blah blah blah. And retail investors just ignore that. They know that it's risky, and that's why it's so exciting, and that's why it's a game. That's why you can win it, because it is risky. And so I think that, as Raphael mentioned, you need to nudge people. You can nudge people, and so you want to push them in a direction using this behavioral psychology that protects them, that leads them towards smarter investments, that leads them to longer term things that can prevent them from making these decisions that put them into terrible debt right away. And so you get to choose essentially what you want to gamify, what you want to reward. And so I think that seems to be the way to start regulating this, is to what you're allowed to incentivize.
Do other panelists have thoughts as to what could work here? What might be
actually, I wanted to kind of chime in there. So this is in some ways is no different from people getting a mortgage or an auto loan or any other kind of financial product, right? And what we know from those other markets is that the sellers of those products tend to create an information bubble where you feel like they're the only people that you should be interacting with, right? So it's really important for investors and anybody interacting with any, people who are providing products in the financial marketplace to understand that they have choices, right? And that is the first and the most important thing. So beyond disclosure, consumers need to understand that they have choices, and that they should give themselves the benefit of looking across a range of different providers. And some of them can be online, offline, whatever. And I think promoting that message is as important as talking about disclosure.
I was just going to add that the SEC is a disclosure-based regulator. I mean, that is the stance that the U.S. Securities laws take. So that is what the SEC typically uses, in their toolbox. The other thing is that, look, I mean, we're never going to be able to avoid losses for anyone. I mean, we've seen lots of swings in the stock market. I think losses and gains are part of the experience of investors. We've seen huge swings in the stock market in every decade since the 1930s. So of course, like a lot of the younger investors would not have had the benefit of having lived through these experiences, but I think we should give retail investors more credit. It's not just a bunch of Reddit following gorillas out there. There is a broader retail narrative here, that it's not, the Reddit crew. And I think that, I think that we're actually seeing a lot of really positive movement and gains. The other thing I would just add is that, obviously, we would not want the SEC necessarily to be a content regulator. We don't see that in any other aspect of the law with the SEC. So the SEC, I can understand the difficult position that they're in. I'm a former SEC employee, so I get that probably better than anyone. But anyway.
This is a terrific segue on the topic of choice, as Camille was talking about, into crypto, which is providing even more choice for the retail investor, particularly as we see the launch of new products. Raphael, I thought I might start with you to explore some of the potential gamification in crypto that might follow. What is your sense of who's already investing in crypto today from the retail side, as well as more generally? What's your research telling you here?
Yeah, thanks. So I obviously, as a central banker, I take a professional interest in understanding why are people investing in crypto, right? Because if you read Nakamoto's paper, the original motivation is to sort of offer a substitute for fiat money in commercial banking with a new form of exchange that's, supposed to be resistant to debasement and censorship. So is this really why people are investing in crypto these days? We were actually looking into this, and we found a study that's representative of the U.S. general population. It's a payment study, but because they were interested in whether payment and whether people use cryptocurrencies for payments, they actually surveyed also on the owners of cryptocurrencies. And then we looked into this data, and there are some variables that measure whether people actually have concerns with the security of cash, with the security of online banking. So and we can from that infer that actually cryptocurrencies investors are no different from the general population in terms of any levels of distrust in fiat money or distrust even with commercial banking. It's rather probably they see this as a new asset class. And then Michel said it nicely, right? They're probably not gorillas walking around. We confirm this because we can look into like what are sort of the social demographics of investors, and up to 2019, these really tend to be young, high income, and more male investors. So it's sort of a niche of probably young suburban urban dwellers that they find this an exciting technology and invest into it. And then we have data. We don't have very recent data because these are annual surveys, but we looked into 2020. There's a bit of a change as ownership picks up. Sort of the investor base also becomes older and a bit less educated and a bit more female. So I don't have the data for now. I'm extrapolating trends. I think we're seeing sort of this really becoming a bit mainstream, and we need to be aware of this shifting investor sophistication from very tech savvy people to maybe the average Joe, where sort of consumer fraud or considerations should be taken more seriously.
So on that topic, Camille, I wanted to ask you as well. Okay. On the inclusion side, which is that increasingly there is data. Comptroller Sue was talking about crypto ownership within minority communities as being a really important phenomenon. So can you say something about that in terms of how you see this trend and the vulnerabilities and the risks that potentially minority communities are having to bear?
Yeah, absolutely. I wanted to sort of build on Raphael's point. By saying that, so in general, you see a very different profile of investors. So in the US, in particular, those investors are more increasingly female, they're increasingly lower income, they're increasingly people of color. And most importantly, across all the demographics, you find that the average portfolio is worth less than $50,000. So what that means is, while you're getting a much greater proportion of the population and populations that haven't, frankly, been, retail investors before, you're getting those folks involved. You also have people who are going to, where if they take a hit, you're really going to feel it a lot more than somebody who has a portfolio that's, over 250, let's say, right? So when we're thinking about, sort of the risks associated with this market, I think it's also important not only to think about, the gamification, the actual techniques, but also, what does a loss really mean to this group of folks?
Yeah.
And that would be very significant in minority communities, and it certainly would be very significant for anybody who is less than $50,000.
Right. We're coming towards the close of our panel. We have sort of 5 minutes left. Looking forward, are we entering a world, given what Camille just said about particular exposures that vulnerable communities may be facing, Andrew's points, Raphael's observations, and Michel's, are we approaching a point where we're going to have to maybe regulate or think about regulating that kind of app experience, as well as sort of some of the general normal ways in which we regulate? Are we looking to a world in which we will actually be overseeing the experience that users are confronting within the apps themselves? Andrew, how do you feel about that? Would that be something that would be useful to you? And then we can have other chime in with their sort of final thoughts.
I think so. The idea of gamification in finance, it's here to stay. It's too powerful and too profitable for people to walk away from it now and go back to business as usual. And the line between a well-designed app and where it becomes predatory is just it's so hard to define that I think we need some sort of oversight. I don't know where that is exactly, but we need some way to protect people from what is essentially a trend that I don't think we can come back from.
I would just add, look, I think it's really important that we have clear and transparent information. And I think these platforms can get it right. And in many ways they are. And I think there's a real opportunity here to continue to improve financial literacy. And this helps consumers and investors access markets. I think the SEC has made a lot of statements on gamification. And I think that's been helpful in making, firms think about the information that they're providing, and that is helpful in helping them improve their offerings and, the way that they're going about, operating the platforms. I think it's going to be really interesting to see where the SEC comes out on the request for information. It was a 30-day comment period, which is pretty tough for the, that's a tight one, especially to really do a lot of research, I would say. But I think, this is going to be a topic that we'll continue to discuss, and certainly will be, continue to be studied by industry, academia, folks like you, Yesha, BIS, Camille, Andrew. So I think there's a lot of work to be done here.
Camille and Raphael, some final thoughts on where we go next?
I'll let Raphael go and I'll close out.
Okay. I can, on this previous question, should we, we see these nudging evolve, but there's always been nudging, right? You go into your bank or to your investment retailer, and then there was a capable person of nudging you into something, and there have always been regular frameworks for that. I would just be careful, right, in sort of watching exactly this space for quite some time before taking regulatory actions. I think this is important, right? There lots of things are changing. We are being nudged on multiple dimensions into purchasing something or into investing into assets, and maybe it's a broader societal question that's not really specific to investing. But I dare not make predictions of where we go next beyond that.
Yeah, and I'll just add that I think, getting more people into the investing market is a really good trend. I think we're at the very beginnings of that, and I think certainly FinTech has taken the lead. But what it does is it opens up opportunities for all sorts of players, and I think there are lots of opportunities for responsible players to be in this space and to conduct business in a way that not only is safe and responsible, but also is exciting to investors, and particularly these new investors.
Phenomenal. Just to close out, this has been a fantastic panel. And it's one that, we are looking back at the events of January, and I think we're looking forward, not just in terms of gamification of our retail stock markets, but thinking about the cryptocurrency environment, which is obviously going to become incredibly huge. And I think the sort of takeaway that we're getting is that innovation is good, that we are improving inclusion, that we are making big changes, but that, we need to take it slow and think about what is happening here. So thank you to our panelists for a truly terrific session. It's been a real pleasure. And I'd like to hand it over to the next fantastic panel. So thank you all very much.
Thank you.
Thank you very much. Bye.
Everybody. I'm Melissa Coide. I'm the founder and CEO of FinReg Lab. It's a pleasure to be among experts to talk about what's a really critical conversation when it comes to technology and FinTech and consumers and our entire financial ecosystem. that is data. Data really is, in many ways, the essence of what is enabling so much of these technology-enhanced financial services to evolve. And we're going to really hone in on a particular area of data and talk about different types of data that are being used, especially in a very important, very sensitive use case, and that is credit underwriting. So we don't have a lot of time. So what I'm going to do is I'm actually going to open it up and ask my fellow panelists to talk about the different types of data that are making their way into the financial system, and in particular into credit underwriting. And the conversation overall is going to hone in on how are we evaluating, how are we assessing the use of alternative data, especially in credit underwriting. And speaking to the title of this panel, which is de-risking alternative data. How do we think about de-risking alternative data, and how do we think about it from an individual, a household, or a consumer standpoint? How do we think about de-risking from the providers who are leveraging the data insights? How do we think about it from a policy standpoint? And I think really importantly, how do we think about understanding and de-risking new types of data from an inclusion angle? So without further ado, let me start by kicking it off and check myself who I was going to turn to first. Jalapa, do you want to introduce yourself and share with us what types of data you've been paying attention to and why?
Sure. So I'm Jalapa Jagtiani. I'm with the Federal Reserve Bank of Philadelphia as a senior economic advisor. And so I want to remind you that everything I say today is my own view and not the views of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. So yes, alternative data has been one of my favorite topics for research at the Fed. And so it is a very broad term, and there's no precise definition. Different lenders may be looking at different alternative data. I can see most of us think of cash flow data, and your own study, Melissa, at the FinReg Lab. Cash flow is the closest, alternative data to in predicting ability to pay, right? Also now utility payment, rent payment, yes, that's, but it also could extend much beyond that. And we don't know for sure because it's a secret recipe for each lender, what they use. So it could be credit worthiness of your Facebook friends. It could be what time you get online or how you shop. So all kinds of variables. And there's some studies that actually look at these online behaviors, and they are predicting default pretty well as well, just like Equifax risk score. So I think that's, so yes, that's what I look at in my research. Overall, alternative data that's non-traditional. I don't know exactly what they are.
Great. Yeah, that's helpful. And you helped to start to, I think one of the things we need to keep in mind, while I think many of us are pretty US centric, our audience is broader than that. In part, this is a conference that's hosted by BIS. And Jalapa, you're speaking especially to some of the research that's been done, I think, out of India, Germany, where other types of data, even non-financial data, have been evaluated for their ability to predict credit risk. So that's helpful. Dominique, before we turn to you, I'd like to welcome Nat. Do you want to introduce yourself and talk about some of the data that you all think about and what you can share in terms of what you use for credit underwriting?
Sure, absolutely. Nat Hoops with Upstart. We are a company that was really founded on an idea that comes out of a statistic developed by looking into reams and reams of old data, which is that roughly 84%, 85% of Americans have never had a meaningful, default on their record, and yet less than 50% would qualify for prime credit using traditional underwriting, right? That year after year, there are a lot of people who are missed by traditional underwriting systems. And so Upstart does apply a lot of data to help lending partners, banks and credit unions, a couple dozen of them now, try to make better lending decisions and get a more granular view of the individual. And that doesn't mean Facebook posts and things like that. It really means things like employment type and education and so forth that are predictive of how a person's income stability is going to look over the next few years. And that's what you're really looking at when you're trying to underwrite credit responsibly. And so by doing that, we've been able to dramatically, help lending partners increase the number of people that they approve relative to their traditional system. So an example would be if a community bank had 10 people that they rejected, and this is actually from a real example that was just cited, they would have actually been able to approve 6 of those by using more alternative data. So 6 out of 10 declines could be reversed and become approvals with better data and better underwriting. And so I hope that's kind of a helpful frame of the opportunity here, and really eager to hear from Dominique and everyone else on the panel.
Sure. Dominique, I'm going to ask you to hold just a moment while we hear from the lender side. Teddy, would you like to share with us what Zest has been looking at in terms of alternative data?
Certainly. Teddy Flo from Zest AI. And we focus really on the modeling. Using that data, we build machine learning models for financial institutions so they can make underwriting decisions using this alternative data. And we use many of the same data sources that Nat was talking about. And we would also include perhaps banking transaction data from our friends at Plaid and some other CRA data sources that are out there. And one of the other points I wanted to make, I know we talk mostly here about alternative data, but there's also a lot of opportunity to make better use of regular CRA data. The consumer reporting agencies like Equifax and TransUnion, Experian, they have a host of data that's just untapped right now. And so there's a lot of data there that folks aren't using that we found to be highly predictive of credit risk.
Yeah, that's helpful, Teddy. And you're definitely hearing a theme in this, which is it's not just the data, it's the analytics. And I think we do have 2 companies who have really been quite leading in leveraging more complex math to evaluate different types of data. But before we sort of jump into some of the questions around the de-risking and the use of the data, Dominique, it would be great to hear your perspective around alternative data and what you're thinking about in terms of some of the opportunities and the challenges, especially for Black communities in using alternative data in making underwriting decisions.
Yeah, thank you so much for that question. So I'm Dr. Dominique Harrison. I'm the Director of Technology Policy at the Joint Center for Political and Economic Studies. We are a think tank in Washington, D.C. that focuses explicitly on Black communities. And in leading our tech policy program, one of our program pillars is on privacy and algorithmic fairness. So that is the use of personal information that can result in discrimination in housing, employment, and lending. And so in thinking about this topic and the question that you've asked, one of the things that we think deeply about is America's legacy of racial discrimination and social inequality, which has undermined the accuracy and fairness of data used across industries. And what we see is that payment histories, the largest factor in credit scoring, are calculated in ways that weigh against African Americans and people of color. And due to persistent redlining and financial unaffordability, many Black people cannot afford to own their own places where they live, so they rent them. And mortgage payments are highly regarded in credit score calculations, but rent payments are not including. So there are also, problems as it relates to data that we use across industries that relates to what a term Rashida Richardson calls dirty data, right? So that means data that is missing, wrong data, data that derives from corrupt bias or unlawful practices, including data that has been intentionally manipulated. So the inclusion of more universal payment categories and universal cash flow analysis may help in kind of moving past some of these problems that what we're trying to achieve, but it will not resolve racial disparities in credit lending, but it can make calculations much fairer. And we need to have that understanding as we move towards using more of these tools. So we should be aware that using alternative factors are more closely related to race, ethnicity, or gender. And given that many measures of creditworthiness disadvantage already marginalized people, machine learning algorithms may continue to perpetuate and exacerbate existing systemic discrimination in lending. And so I think that it's important that we understand this background as we think about the possibilities of using other types of data and making these kind of lending decisions.
That is really a fantastic transition, because you're getting to the core questions that we are all grappling with, whether we're think tanks or lenders or policymakers, who, especially the regulators, are sitting with these questions. How do we really de-risk the data that are being used? And then we just can't help ourselves. We're going right to the complexity of the models. Teddy's laughing because we were having a little bit of a preview conversation about how would we hold ourselves back. But the complexity of the models, the algorithms that may be employed. Jalapa, do you want to kick us off? You're sitting at the Philly Fed. I know these are the views of your own, but I think it's important to call out, particularly in the US, we do have laws and regulations that give some direction to industry around requirements around transparency, communicating to consumers, and really importantly, evaluating for fair lending. Do you want to share with us how we think about de-risking?
Also, just to add some more evidence to support what Nat and Teddy and Dominique has already said, that my own study also shows that there isn't much correlation in recent years between the traditional credit score and the score that the fintech lenders actually assign using alternative data. Although this lenders' own score is much better at predicting consumer performance, at least for the 2 years after origination. So I think there is a significant lift in using alternative data. It gives us a more holistic understanding of the person's entire life and financial life, right? But what goes in that magic score that is so good at predicting this consumer performance? So as Melissa said, transparency actually becomes a key question. When some consumers may have low score, a traditional score, and get credit, and actually can get access to credit at much lower APR, many of them, so expand credit access. But there are some others who also got denied, and some of them may have good score, but actually got denied credit, right? And they would want to understand what are the factors that cause them to be denied, and is that where they live, their education, the type of employment, and what are the weights that go into each of these. So I think this type of information, understanding what goes inside the model, consumers are really interested to understand. And so we would also, as regulators, would like the lenders to understand how they make that decision. Sometimes it's complex models, work very well, but it's hard to understand how it works. And when banks partner with fintech or vendors, banks may actually just make decisions based on what the black box tell them to do. And that's something that they may not be able to document the detail of how they actually made that credit decision. So I think that's one thing that regulators also would like to actually understand more, how many of these loans also are on the bank's balance sheet, because small banks also buy loans from fintech platforms. And so they need to understand how those loans were made. So I think there are many different factors that from the consumer's perspective, from the bank's own perspective, to be able to document everything, and also just overall responsibility, accountability on how this information get used or shared or sold later as well.
Right.
So I think that Nat and Teddy may have a lot to say on this.
Thank you so much. I think you're spot on. There is a tremendous risk with algorithmic bias. I mean, it is real. And I think to Dominique's point, the data reflects years of systemic racism. Even when it's not being intentionally manipulated, it reflects years of systemic racism. At Zest, we found quite the opposite, though. We have spent the last decade building technology that explains machine learning models that consume this sort of alternative data in a way that is completely transparent and can be demonstrated with mathematical certainty to give you accurate explanations of what's going on inside the model. So like there's no black box. And if you're looking at for black boxes, you know, existing credit score providers won't tell you what model they're using. They won't tell you the variables that are in the model at all. And so, you know, I know folks worry about machine learning being a black box, but we're not the black box anymore. There are other ones, you know. And then to your point, Dominique, the data does contain a ton of bias. But what at Zest, what we've done is we've developed a technology that debiases the data. That you take an existing machine learning model, and you take an existing model, whether it's machine learning or logistic regression, whatever it is, and you can actually run searches to find less discriminatory alternative models that approve Black folks and women and others at rates that are much closer to their peers, white folks or men or whatever the comparison group is, but maintain the accuracy of the model. And when we run these searches for our clients, we see that we can take fairness, you know, very close to sort of that threshold, that 90% threshold where it's considered fair. And so that is a focus of our company, and we help all of our lenders do exactly that. And so I think it's extremely important to worry about the data sources that we use, but there are tools that exist that can help us test that data to make sure that we take out as much bias as possible, and then also to implement it in ways that actually make life better for women and people of color who've been historically shut out of the credit system. So I think your points are very well taken. I just would add that there are good guys. There are good guys out there.
Well, and this is you asked both of us, so I would say I think what Teddy framed up is that the notion of a model needing to be explainable is true whether it's a traditional model or one of the advanced algorithms. And I think that there has been very little attention paid to, in a simple model that relies heavily on this credit score that was, invented in 1979, in which we've seen study after study show enormous problems with disparity. There's just no real explanation for why would that get a certain amount of weight in a traditional model. Like there's no explanation, like how, there's no predictive, they can't say it's more predictive than another tool. There's no, so when you really think about the whole notion of explainability, it's really important to frame it up holistically that all lenders need to be able to explain to the people that they're lending to, why were you declined? Why did you get the rate that you got, whether it's an alternative data model or a traditional model. And so I think that looking at through the use cases of, where do law and regulation require, such as adverse action notice, you to explain models, and then what are the tools that you can use to determine, why were certain decisions reached. And there's a lot of new tools like SHAP and Lime and other things that have been explored in the case of these newer models, which Melissa is doing a great job of looking at and examining in all of her work. But I think it's also just important to back up and sort of say, when we're trying to explain to a customer why they were declined, can we really say why a certain variable was weighted in a traditional model and why did it deserve that much impact? And especially when you look at the history of, the whole overlay of our racial discrimination in our country, it's on everything. It's income, it's wealth, it's credit score, it's the whole foundation that we all try to, improve and ameliorate. And so, we just think that in this day and age, with all the explosion of data sources and the explosion of technology, better machine learning, better AI, that every financial institution needs to really be kicking the tires on less models that are more accurate and less discriminatory than the age-old ones that they may have relied on and felt that they sort of somehow have a safe harbor for using.
And if I can just add one other point there, even the accuracy of those legacy models is being called into question. The Fed, I know Jalapa can't say this, but the Fed issued a warning about some legacy models getting less accurate over time, just recently. And so there is, to your point, Nat, there isn't a great reason why we're continuing to perpetuate these legacy systems and suggest there's sort of like mythology that they're somehow safer and less racist than the new technology, which is specifically designed to take racism out of the data.
So I would add that the traditional model, generally, when we rely on traditional credit score, it's somewhat like looking in the rear mirror, where people already defaulted in the past, their score declined, and so they're more likely to default. So additional information about cash flow and utility payments and all these other things actually is, I would say, more forward-looking. But there are some of the variables that we think it's very safe to use, like education, right? But is education related to maybe your parents' wealth, or some other factors that we may not be thinking of, and it may be actually kind of partially unfair? Maybe Nat can explain that.
Well, I think that's where you have to test. I think that anything, I mean, if you look at any data source in a society as unequal as ours, there's going to be correlations to race, to gender. There are going to be problems in any data source. The question is whether or not those correlations rise to some sort of a proxy for a protected class. Obviously, that would make it illegal to use the sources. And then secondly, it really means, how are you testing your outcomes for fair lending, right? So one of the reasons why Upstart has been working for years with the CFPB is because, and sharing data with them is, we know that we're doing things that are new. We're using new data sources. We're using new tools. And so we want to make sure we're turning over every rock when it comes to thinking about how do we make sure that our data, both the data sources are fair, and that we don't inadvertently walk into, a protected class, proxy, that we don't make that error. And so it really is a critical thing to be kind of testing on a recurring basis. Every loan that's going through your system, you really need to be sort of looking at from the standpoint of accuracy and sort of safety and soundness. Is the model performing the way it was predicted to perform or not? Because if it's not, then you're starting to say, well, maybe we're going to show up with way more defaults. It's not going to be more predictive than a traditional model. We're going to have problems. So that's sort of one dimension that you always need some sort of third-party model validation. But then we think that you should also be doing it on a fairness basis. We do it with the CFPB. I don't think that should be required of every firm, that they all do it with the CFPB. That would probably be burdensome, but there should be some sort of third-party eyes, like, think about a stakeholder group like the NAACP, think about like, even just a model, Moody's or a Duff & Phelps. There should be some sort of third-party validation on fair lending on a regular basis, and not just for the new guys, not just for the Zests and the Upstarts. It should be for the traditional guys. They should really be examining these things through the lens of, is there a better way out there that we can use? Are there additional ways that we can increase accuracy and reduce bias?
Great. I'm going to jump in as the moderator with the moderator's prerogative. This is really good. I want to just table set a few things that I think themes are coming through. One is, we know we have up to 50 million, almost 60 million people in the US alone who are thin file or no file, and they are on average more likely to be minority and protected class populations. And so we know that we need more data that at least gives us the base of bringing more people in for credit risk assessment. That's why we've done this cash flow research, where we found the data to be predictive, inclusive, and of the data we looked at, not creating a disparate impact risk in the context of the data we're not proxying with protected classes. But every lender has got to do a full fair lending disparate impact assessment, and that's important. I don't just underscore that point. Jalapa is making a really good point, which is, it's not just that we want to make sure that we have data that is able to understand everybody and not leaving out important populations, but it's also the potential of what it does in terms of looking forward and predicting its potential for predicting future risk. And then the complexities of the models that that we are beginning to see industry, fintechs maybe somewhat more in the lead and using more complex models. But even there, I would say, we're not seeing lots of fintechs out there using unconstrained neural nets. But even when we do see some of these more complex machine learning algorithms employed, it is important to keep in mind we have laws and regs that require, and you've all just spoken to it, that you have to be able to explain to a consumer if they are not getting the credit or at a different price than they expected, adverse action notices. We have model governance expectations, which we could debate, that require those models are going to be stable and robust over time, right, under the prudential expectations. And really importantly, we do have requirements around evaluating for not creating either disparate treatment or disparate impact effects. And so that I think is helpful. It's critical for making sure that we are evaluating for fairness. Dominique, I would love to turn to you. How are you thinking about what financial institutions should be doing in terms of de-risking or leveraging some of this data for the potential benefits, but mindful of, you mentioned privacy. That's a really important piece. Would love to hear your view on this.
Yeah, so I mean, one of the things that we're looking at in our research regarding this topic is that in absence of privacy legislation, what are the kind of regulatory tools that federal agencies do have? And so we're thinking about anti-discrimination laws that can be used by the Department of Housing, EEOC, and other federal agencies in terms of rulemaking to ensure that any information, personal information that is going to be used by companies does not produce disparate impact for other communities of color. And so we're thinking about that as members of Congress are thinking through privacy regulation and such. But in the meantime, I just want to double down on some things that Nat said, which is we really think it's important that there are algorithmic audits to evaluate the concerns about bias and fairness, to check for unintended consequences, and to create more transparency to build consumer trust, but also to not cause more harm for marginalized communities and communities of color. I mean, the data continues to say that there is unfairness, right, in lending, and we see that continuously. So we need to be thinking more about the kind of intentional approaches that we can make in this moment to ensure that all people have access to credit and lending and are evaluated in ways that are fair. And so as I think about the future, there are a lot of possibilities with these new kinds of models, but we cannot forget the past and what that has taught us in the data that we see today.
Yeah. That's really helpful. We have just under 2 minutes left. I'd love to do a round robin points of view from everybody, some of the best practices now and into the future for overseeing using non-traditional data and oversight of the models. Who'd like to go first?
I nominate Teddy. Teddy, talk about DeFi.
I'll go first so you all have time to come up with better answers than the one I'll do here. I think there are really three critical components. I think you got to test upfront for accuracy and fairness of the data that you use. The second, I would say you have to create reporting. The model risk governance requirements require it already. So you've got to have robust reporting on how this model is expected to perform. And then in the end, you have to have monitoring. You should be watching that model to make sure it's stable from an accuracy perspective, but also from a fairness perspective. The same tools can be used for both. Zest does it already for our clients. And so it's really important to do all three of those things: the upfront testing, the detailed reporting, and the careful monitoring for fairness on the back end.
I'll quickly just say that there should be conversations with social scientists and other kind of stakeholders as you all are making these tools and having conversations, because there are a lot of insight and perspectives that they bring to the table that many engineers or data scientists might not. So just wanted to emphasize that.
So I would say that so far, the goal of this alternative data is to expand credit access, to understand more about the person's financial life, and cash flow has been the most powerful. But if we talk about this unbanked population that we are trying to reach, they don't really have bank account. They don't have cash flow that we actually use that works so well, but it would not reach, we would not get us the last mile. And so there would be more information that we need to incorporate, other alternative data. And then in order to check that it's actually fair and in compliance with everything, as Nat said, we have to look at the outcome. But checking the outcome would mean that you already made the loan and you actually check to see if it actually complies. So there may be some kind of upfront, as Teddy said, sandbox or something. But then things keep evolving. So it's a very complex issue that we need to deal with in the near future.
Yeah, I think you're right. And I'm afraid we are out of time, but that's a good place to leave it. It is complex, and the BIS and Georgetown team have us back next year. We'll have more to share. Now back to the program.
Hi, my name is Petal Walker, and I want to first thank DC FinTech Week and Professor Brummer for the opportunity to speak today. Today, I want to discuss some ideas, some thoughts on how we could enhance the oversight of the cryptocurrency spot markets. And these are ideas, thoughts, just to bring them into the discussion. Not strong opinions per se, but just wanting to raise these potential ways of dealing with it. Now, when I think about regulation, I think first about risk, and my thoughts are really organized around four, I think, main risks. The first one is a bit funny because of what we're doing, and that's the risk of regulatory uncertainty. The uncertainty itself creates a risk. When you have individuals and entities that are attempting to use cryptocurrencies for legitimate reasons, but then these currencies can at some point be redefined or reclassified as securities or derivatives, that creates a risk. And the way to obviously deal with that is to have that certainty. We have lots of guidance, but not lots of interagency guidance. And so the agencies that are important in the space, it would be great if they had guidance or rulemaking that went through notice and comment, that took in, therefore, the ideas of the market and the industry in order to create a common framework on what is a compliant coin throughout the life cycle. That would be very helpful. The next risk that I think is out there in these markets is that of manipulation. Now, there have been many who have speculated on the degree of manipulation, if any, within the cryptocurrency markets. And so today we will not be discussing whether or not that's true, because every market is susceptible to some degree to manipulation. And so manipulation is an important topic for all markets, including this one. Now, let me first distinguish between manipulation and volatility. Volatility can be natural to many markets. The natural, legitimate market forces can lead some markets to go up and down. Manipulation is different, though. Manipulation is a trick. So you have a person or an entity that really is gaming and tricking the market with false information in order to get personal gain. And so manipulation is something that everyone, not just regulators, but the market itself should be concerned about. Now, in the space of the cryptocurrency spot markets, there is a cop on the beat for manipulation, and that cop is the CFTC. The CFTC, through statutory and regulatory authority, does have tools to govern manipulation in these markets. And from many indications, the CFTC is using these tools. First, they've put out a number of primers and advisories about manipulation in this market. Second, they actually created a virtual currency task force within the enforcement division in order to focus on this area. And third, there have been a number of cases brought by the CFTC within the area of manipulation in the cryptocurrency markets. And so the CFTC has been actively engaged. Now, there are some who raise the point that it's very difficult for the CFTC to have meaningful enforcement authority without some underlying regulatory authority. So for instance, in the case of derivatives markets, the CFTC has enforcement authority, but it also has reporting and record keeping and other underlying regulatory underpinnings that really help to support that enforcement authority. And so why not bring that into the cryptocurrency markets? Now, I think it's worth considering that, not whole hog. These are different markets, different level of regulation. But I do think it's worth considering whether to some degree, some sort of streamlined version, maybe of record keeping or audit trail could be useful. And not necessarily just with a regulatory agency like the CFTC. Possibly a self-regulatory organization could be the vehicle to do that. And so I think that's something that's worthy of consideration. Keep in mind too that with Bitcoin futures, the CFTC to some degree already has that, because Bitcoin futures are being offered by DCMs, which are highly regulated by the CFTC, and the CFTC has this heightened review method with these DCMs for these futures. They already have insight into certainly the Bitcoin market, but also the wider cryptocurrency market on these exchanges. Maybe that can be expanded in order to bring more stability, in order to bring more tools for the authorities to use in going after manipulation, which, as I noted, is not just an issue for regulators, it's an issue for efficient markets. A third risk is interconnectedness. Now, interconnectedness is the fear that many have, that there are companies that are significant to the overall financial system that could be using cryptocurrencies to such a degree that if there was a sudden loss of value, it could lead to distress within the company that could spread across the financial markets. Now, this is a fear that I think needs to be addressed. I think we need data to actually look and see, okay, what threshold of company could potentially cause this kind of ripple effect? And then for that threshold company, what threshold amount of cryptocurrency could then cause the company to feel distress that could lead to a ripple? I suspect this will be a very small minority of companies given the company threshold and the potential cryptocurrency threshold. But it's important to have that discussion to address this risk and see how big it actually is. And it's also helpful to have outer limits for those few and far between companies with that threshold level, to have outer limits, to provide for risk mitigation if they are indeed using cryptocurrency at that level. That may be a conversation worth having. And once again, an SRO, regulatory agency, may be the agent for that, or maybe we find through the analysis that nothing is needed. But I think it's important that we address the risk and that perceived fear. And last but not least is cybersecurity. So there have been many famous examples of cyber intrusions into cryptocurrency spot exchanges. There have also been many famous examples of cyber intrusion into every other market out there, right? Cybersecurity is just a part of the times in which we live. And so it makes sense then that those who are in the market and those who may want to enter this market will want to be assured that cryptocurrency exchanges and other entities that are critical to the space have reasonable cybersecurity measures, which many of them may have. In the CFTC derivative space, CEFs and DCMs have system safeguards in which the CFTC has outlined certain requirements, including all kinds of testing, including penetration testing. It may make sense to import some of that into this cryptocurrency spot market space as well, to just have some clear, reasonable requirements. Once again, SRO or an agency possibly officiating here, but clear requirements that are consistent with expectations for cyber health across the board. And so in sum, The cryptocurrency spot markets certainly have risks because all markets have risks. But I think it's important that we engage in a data-driven, thoughtful analysis of what those actual risks are, and then figure out the ways to address those risks that make sense. Thank you so much for the opportunity to share my thoughts.
Welcome back. And we are just delighted to carry on our conversation on pricing risks and opportunities. Risk and opportunities in the market, risk and opportunities in regulation. And for that kind of conversation, it's hard to think of anyone better to have to engage in sort of what the status is and where the challenge is, and to get a really full perspective from Brad Garlinghouse, the CEO of Ripple. Brad, thanks so much for joining DC FinTech Week. You are now a veteran of this program, and you've been here many times, and thank you once again for joining us.
And thank you, Chris. I will say, for everyone's benefit, I said to Chris backstage a moment ago, the fact that he does this event, I think, is super important for the industry, and so we all owe you a debt of gratitude. So thank you.
All right. Well, I guess, everybody, first of all, is going to want to know, I actually, have had conversations about the importance of Twitter in crypto conversations in general. And but there are limitations in terms of what information is being shared and the speed at which the different sort of going backs and forths go. But when it comes to the litigation between the SEC and Ripple, it seems like it moves around pretty quickly, and things simply are changing. Maybe can you give us a background as to sort of where things stand and what is the posture when it comes to that litigation right now?
Absolutely. So in some ways, it actually, as you know, as a student of and teacher of the law, in some ways, for the pace of activity actually has been for federal courts pretty fast. On the other hand, Ripple would like it to go faster. Our point of view has been, given that the SEC sued Ripple on the day before Jay Clayton left office, clearly they were in a hurry. And even just, recently they have been seeking delays, which is, as you certainly know, unusual for a plaintiff to be the one looking for delays versus the defendant. So, look, there's been a lot of progress made there. The fact discovery part of the litigation has completed. Now we're in what's called expert discovery. The court just granted the SEC a delay of expert discovery into January, which again, we find frustrating. Just like, hey, let's make progress here. But look, Twitter has had an interesting, in my judgment, role that I have never seen before, because there are some amazing people out there, which I'll just generically call the Twitter sleuths. And they have found, videos of, people at the SEC, whether it's Jay Clayton or Director Bill Henman, or more recently, the new chair, Gary Gensler, whom you had on this morning, saying things like, hey, that the status isn't clear, or saying, hey, 75% of the market of crypto is not securities. This is a quote from Gary Gensler, that now saying, well, no, he views most of it, if not all of it, as a security. So I think it's clear that the market has not had clarity. I think it's that is certain. You and I talked very briefly back, kind of the proverbial backstage, and almost 2 years ago to the day, you had Jay Clayton on stage at DC FinTech Week in person, one of the last events. And I was on about an hour later. So I was in the room and someone asked Jay Clayton, hey, what's the status of XRP? Is it a security? And he didn't answer the question. More recently, Gary Gensler won't answer the question, is ETH a security? And look, if these laws are so clear, then let's just say the answer to those questions. If they're not clear, let's say they're not clear, and let's make them more clear.
Yeah, I think certainly as a law professor, it's teaching securities law has changed quite a good deal. The significance of talking about a bunch of oranges and orange groves in Florida, has certainly taken a twist in the last couple of years. And there is, and I did ask Chairman Gensler earlier today, why, what is it about crypto that is a flashpoint? Because whether or not you're a supporter, whether or not you're a detractor, there's a lot of energy behind it. And the question is, how much of that is the technology, the complexity. Certainly, there's a lot of swagger in the industry, but how much of also is the regulatory response, and how much does that create its own kind of a function, and that's also clearly a question. Interesting perspective, right? Because Ripple is certainly not the only company that's been in the crosshairs of different kinds of SEC actions, or frankly even as recently CFTC actions, and you've seen companies face their own form of regulatory uncertainty. That's a conversation you and I now, I guess, are having several years on. What comes to mind when you see certain kinds of questions like the ones you just mentioned sort of percolating from time to time? What's your sense of the stakes when you certainly do see more enforcement actions in the space with similar kinds of postures in terms of the response to those enforcement actions?
Well, one of the things I said when the SEC sued Ripple and sued me personally last December, I said, look, this is not an attack just on Ripple. This is an attack on crypto. And I think at the time, for some people anyway, my impression was that was not totally obvious to them, that they weren't convinced of that. And I think as time has gone by, you're seeing, oh, yes, in fact, it's clear that the SEC, the United States SEC, is taking a pretty aggressive posture towards crypto. And whether most recently, obviously, some I guess I'll just generically call it drama with Coinbase and their Lend product. But the SEC has told responsible actors, hey, come in and talk to me, come in and have a conversation. As an observer, it feels like responsible actors go in and meet with them, and they use that as lead generation for the enforcement team to, hey, let's now go and let's try to figure out the policy through enforcement. So again, from my point of view, it's been, this is important for the whole industry, and it'll take a little while to play out, but I think it's trending in I think, good direction to provide that clarity. One other thing that you brought up that I just want to touch on, I think, you got to step back a little bit and say, what's the end game? There's a narrative that you hear, I think Chair Gensler has used it, certainly, that this is the Wild West. The US crypto industry is regulated today. You referenced the CFTC. The last speaker who was speaking was talking about the market manipulation and the role the CFTC plays. So the idea that this is an unregulated industry in the United States is a farce. That's just not the case. And so for part of me, it's like, what is the end game the SEC has in mind? And so I go to kind of first principles. The SEC's mission statement, this is on their website, the mission statement, first sentence is about protecting consumers. Okay. Now, in the case of the Ripple lawsuit, you have nearly, I'm told, 50,000 US people who hold XRP who are trying to sue the SEC for protecting them, And it's kind of like, well, wait a minute, if the mission, let's go to first principles. If the mission is about protecting consumers, about ensuring orderly markets, how are we ensuring orderly markets when we can't 2 years ago? If the SEC thought XRP was a security 2 years ago, Chair Clayton, answer the question. And then we know, and then we can act within that construct. But then to say to Ripple and even to me personally, hey, we've now decided we think XRP might be a security, and everything you did in 2015 and 2014 and 2016, sorry, that wasn't in order, but that doesn't make any sense to me.
Well, the legal process, and there are lots of ways to make laws and rulings, and this will obviously work itself out one way or another. Well, one question I did ask Chair Gensler, and I think I'd be curious to get your view on this, in part because I've asked you it before, and now with a year of hindsight, it could be a little bit more interesting to return to that question. And that was this question that I asked earlier this morning on digital transformation and sort of the global nature of the internet and obviously crypto markets. And whether or not especially in a post-pandemic world and the shift to digital, to what degree sort of international competition, sort of the competitive posture of the United States, and frankly, even the mobility of the industry, how much does that weigh on his mind or not? I mean, because certainly questions about global competition have been around for a very, very, very long time. And, he had made the correct observation that, the digital economy has been around for a while. But, when you think about the let's call it the U.S. regulatory posture, what does the global dimension add to this, in your view, that's different from, let's call it the standard sort of talking point on the fact that we live in a global market? Is there something about crypto and crypto markets and the regulatory posture that really does make this a salient issue for consideration?
I think it's a really important question, and I say that you're obviously in Washington. I think many in the crypto industry probably need to spend more time in Washington and providing open transparency and education. Look, I think if I go back to my first kind of introduction professionally getting involved in technology, in the 90s, I moved to Silicon Valley in 1997. And, so I reflect on that time period and why so much capital and so much entrepreneurship was happening. And one of the reasons is because the US government provided clarity. The US government provided certainty so that investors, so that entrepreneurs could build companies in the internet space with clarity about what the rules of the road were. And that obviously put the United States, not just economically in terms of value creation, you got Amazon, you got Facebook, you can debate some of the policy things they're dealing with now, but there's been massive value creation to US participants. But even on a geopolitical basis, has it been useful that the internet as we know it in many ways has been grounded kind of, in the US, it was certainly a pioneer and leader. I believe we're dealing with a next generation platform that is analogous to the internet as we know it today. And if the US doesn't take a leadership role, which frankly, the US so far has clearly been a laggard, that we run the risk here in the United States that global economies have some of those benefits over the next 10, 20 years. So countries like the UK have done the hard work to create what they call the Token Taxonomy Act. It provided the clarity and kind of here's how they're going to segment different tokens and how that taxonomy will affect regulation. Singapore, Japan, these aren't, I'm not talking about kind of small countries with small economies. These are G20 markets, Switzerland. These are all countries that have provided clarity and certainty. They've done the work. They're not trying to do the work through enforcement actions and trying to create policy through enforcement. They're saying, look, let's step back, let's create a construct, and let's make sure we're doing the right thing to help that economy. And so, look, here in the United States, I think we run the risk. We need to make sure we don't paint all crypto with one broad brush. There's not going to be one winner, despite the SEC's kind of, hey, we're going to anoint, winners and losers a little bit.
Yeah.
I'll let you jump in. Sorry.
Yeah. So I mean, you just sort of obviously that last line brings up an entirely sort of different vector of questions. But I just want to close the loop on the international question really, really quickly. China hasn't exactly been very friendly to crypto either, and certainly that there's been really an uptick in enforcement there. When you think about sort of the mobility of capital and crypto and opportunities, and you listed a number of interesting jurisdictions, how much though does the entry of China and its posture sort of change that formula of potential outcomes?
It's a good question. I mean, look, Chris, you've been following crypto closely for a bunch of years. And so you and I both have seen the kind of, I was going to say pendulum. That's probably not the right comparison. But, at least in my experience over the last, 7 or 8 years that I've been paying close attention to crypto, China has at least on 3 occasions taken a aggressive, anti-crypto stance. And then that has kind of moderated over time. And look, I think governments are generally feeling the pressure of, hey, we need to act. El Salvador on the other side of the spectrum, making Bitcoin legal tender. But, I think it's very clear an all-out ban, and what we're seeing in some countries remains a kind of hostile posture. But, that doesn't make a ton of sense, in my opinion, in the long run. If you again step back to the macro perspective, over the last 7 years, the trend line for crypto and, friendliness from governments is very positive, right? The U.S. may not be a leader, but certainly if you look at the macro, the fact that 7 years ago this was viewed as very fringe and really primarily there to serve maybe the Silk Roads of the world, that's not where we are now. You have real companies in many different industries identifying and understanding how blockchain can actually reduce transaction costs from a speed point of view, from a cost point of view. And where Ripple has started very much focused on that around cross-border payments, there's going to be a lot of winners, just as there was with the internet in the kind of 90s and 2000s. Like, there's going to be a lot of winners here.
Yeah, that's a really interesting point in terms of, a lot of times, even though we are obviously in a world of network economics, even in a world of network economics, you can have more than one or two winners. Yeah, the question is obviously how many and the degree of competition between them. You had obviously sort of opened up in that last little comment there. This interesting question of sort of picking winners and losers, and it's just too irresistible for me to sort of ask a little bit about. I suppose, and if you're going to ask Chairman Gensler right now, and he said so publicly before, going back to those wonderful Orange Grove cases of how he'll say, hey, look, we have an existing regulatory perimeter, and we have it based off of the facts and circumstances of the Howey test, and the Howey test will point us in the right direction as to whether or not any particular crypto asset is a security or not. Now that kind of posture by definition sort of says, look, this it's pretty objective test here. I mean, certainly under securities law, it's called an objective test in many ways. So hey, that's how it is, and that's the outcome. When you come to sort of then your view on winners and losers, and we have a lot of also even students who are listening as well as everybody else. What does that mean sort of in practice? Like, where are you getting this particular sort of argument about sort of almost outcomes based regulation?
Yeah. So, I mean, look, first of all, I will say, and I compliment you and your interview of Chair Gensler this morning. Chair Gensler said this morning that he does think there's, laws that need to be updated to keep up with 21st, I think he said 20th and 21st century technologies. I hope we're not focused on 20th century technology, because that's 21 years ago. But, look, he did acknowledge, I think, that there is a need for regulations and laws to keep up. Of course, I think the idea that the Howey test, this test you're referring about, Orange Groves from, I think it was 1940 something. I don't remember the exact date. You may know as a professor. You should teach me some things. But look, the idea that an Orange Grove Supreme Court case from 80 years ago is the right framework to assess if digital assets are securities feels challenged to me, and I think it's the reason why 2 years ago, almost to the day, Jay Clayton couldn't answer the question, is XRP a security? And the reason why Chair Gensler is not answering the question, is ETH a security? So I think there is a need to do that. I think you are very familiar and have been, I think, a champion of some of the opportunities through Congress to make some of those changes. But to the other part of your question, which I think is the meat of the matter, I fundamentally do not believe it's the role of government to pick winners and losers. And there is the idea that the United States government, particularly in a very climate aware, climate forward administration, hasn't helped pick winners in the United States ecosystem around crypto is crazy. First, obviously, I mean, even today, Chair Gensler is taking he appears to be saying, well, Bitcoin is different from everybody else. And then obviously, Director Hinman under Chairman Clayton, said that ETH had a free pass. The interesting thing to observe is that it is affecting the market, right? Within the last few years, XRP was the second most valuable digital asset. As it became clear the SEC had given the hall pass to ETH, ETH obviously has, kind of exploded in that clarity has helped, right? Now, the question is it now clarity when Gensler seems to maybe be backing away from that, not answering some of the same questions? I don't know, but I just fundamentally think we should let market forces determine winners and losers, not, regulation by enforcement as what we're seeing today.
Yeah, so getting out of like the securities versus this very stringent box of securities law for a moment, and just to transition for a moment, when you think about the kinds of changes that we're going to be seeing in the ecosystem, regardless really as to the specific regulatory box, you see issues talking about changes in consensus mechanisms, governance. And even sort of the services, right, that are being introduced into the ecosystem right now over at Ripple. Where are you guys sort of putting your energy, and what do you think are some of the drivers that are going to maybe cause certain elements of that very large ecosystem-wide sort of self-evaluation progression? What kinds of areas of emphasis are you guys really putting your energy into right now?
So there's two parts of Ripple, and this has certainly evolved since you and I last spoke publicly in the last couple of years, but there's really two parts. There's the part that I think is Ripple's the most known for, and we have a business unit called RippleNet. RippleNet is run by a very talented guy named Ashish Birla, and we think about the primary metric of success is transactions. How many payment transactions happen per quarter? Despite the headwinds from the SEC, we have had a record year on a ton of different dimensions. Here in the United States, we have signed exactly 0 new customers and we've lost customers here in the United States because they're like, hey, look, until the United States regulatory framework is clear, we need to lean out. And that puts headwinds. But despite that, we've grown, the last quarter, we grew 33% quarter over quarter. So that's, we feel very good about that. Actually, one of the parts of our technology that I think, Chris, you're familiar with, on-demand liquidity, which is where we use XRP to shuttle liquidity for financial institutions, that grew 130% quarter over quarter. So demand for the solutions we have is high. That growth's all coming from outside the United States. And in fact, it's making up for contraction, having lost a couple of customers here in the United States. So recently we announced a new corridor with Japanese yen as the origination point, and a big remittance customer there. But you certainly know this stuff well. The cost to move money, particularly overseas, and particularly, by the way, the remittance segment. This is a population that is, the least equipped to, have what I'll call high penalties of the result of the infrastructure and how it works today. And as we remove that friction, costs are coming down, and that's good for the companies involved, and it's good ultimately for those end consumers and those most at-risk populations that depend upon those remittance corridors.
Yeah, and to carry that out, because and as a sort of a bridge sort of currency idea that was always sort of introduced for XRP in particular, to what degree does, let's call it, the regulatory cloud, not just for Ripple, but just overall in terms of the direction of policy making? We had an earlier sort of panel of crypto investors on, and one of the questions was, because we started today off with this great pitch book sort of assessment of venture capital and money going into either tokens or infrastructure, et cetera. And one of the questions was, well, to what degree is that regulatory cloud or potential regulatory action sort of impairing or making it harder to price any particular risk or opportunity in the sector? From your vantage point, when you watch and you talk to your international partners, what are you hearing from them, not just about obviously the lawsuit, but just writ large in terms of their impact on the overall sort of crypto space in the U.S.?
When you talk to, and I'll use an example, you talk to a Japanese financial institution, whether they're in payments or banking, they look at the Japanese laws. Japanese laws have been clear and they're certain, and so that we've signed a bunch of customers. When you look at a market like in the Middle East, UAE, the laws are clear. if you're a non-US actor, you look at what the SEC is saying and you're like, well, that's super confusing because, the governments in the UK have called it, a virtual currency or a utility token. And, the irony to some degree as a US citizen and US company, the only country on the planet that thinks XRP is a security or could be a security is the United States. So, the good news for us has been, outside the United States, things are going well. The business is growing. We are applying energy into, what I'll describe as just other use cases. The XRP ledger, as you know, does work differently than the Bitcoin blockchain, or in terms of proof of work, as opposed to a consensus mechanism. And that has made it extremely efficient and low cost and fast as compared to other blockchains. And we think there's a lot of other use cases. And so we have another business unit called Ripple X, and the energy, pun intended here, around the energy consumption is all about how do we look at whether it's building internally. We announced a creator fund, a $250 million fund that is working with other parts of the XRP ecosystem, and we'll continue to do things like that because we think it is such a unique and almost comparatively almost magical blockchain in terms of its speed and efficiency.
So again, one of the sort of these kinds of conversations are really interesting because we can always sort of check back over the years. One of the questions is even beyond the securities law world. I mean, for obvious reasons, that's a focus. That's where a lot of people are thinking about. But when you look at the evolution of the regulatory environment, and you look at a company like Ripple, and you look at the crypto ecosystem writ large, outside of the securities law world, and you're thinking, either about the banking, we have a lot of conversation nowadays about banking and banking regulation and banking laws, as well as what's going on with our commodities regulators and money transmission. Are there areas there where you're seeing either opportunity or maybe underinvestment of attention as compared to, say, securities law land? I mean, like, a crypto company, like any financial services company, there are lots of different things you have to be aware of. Are there any other sectors where you're looking at and you're thinking, here's either an opportunity, or here's a risk, here's like, I wonder why no one's thinking about this? Is there something that kind of comes to mind, again, outside of the securities law world?
Yeah, it's a really interesting question. I'm going to be a little bit, openly dodging the question. I'll just tell you that. Because
okay.
It's unusual to say, hey, I'm going to dodge that question, but I'm going to dodge the question a little bit. I don't want to share, here's what Ripple's thinking about and working on. I do think, however, and I'll pick on one. It's a company that I am not involved with, but I find to be super interesting. The settlement, and by the way, I know shit all about this, so I apologize in advance if I'm stepping in it, but, settlement of transactions for the real estate industry are like the costs involved, the title insurance, like it's crazy how much it costs. There's a very cool company called Proppy, which is relatively small right now, trying to basically tokenize real estate transactions. So if you own a home, you own an apartment, you own hypothetically a building, and you can even fractionalize the building ownership. It's just an area that I find super interesting. The amount of friction where it hasn't kept up with the efficiencies of technology, I think, is an interesting one. And I use that example because it's not one that Ripple's likely to go work on.
Yeah.
But look, there are a whole bunch of things. If the magic and novelty of a blockchain is to allow two parties to transact with certainty, but without trust, you don't have to have the trust. Now, today, we commute trust through a central counterparty. And that central counterparty in correspondent banking is that correspondent bank, and that's where cross-border payments and Ripple's focus there. But if you're in the real estate industry, there's a central counterparty that commutes trust of a transaction, and you buy title insurance and all these things. I think any industry that has a consequential central counterparty that's extracting tolls and slowing transactions down is at risk from how blockchain technologies can impact those industries.
All right, so I guess for the last question that I want to ask, it's again a continuation of a theme, but it's really important. And you may or may not recall, but I'd asked you once, how exactly does someone navigate uncertainty, right? Regulatory uncertainty. Now, since then, obviously the circumstances have changed dramatically, but the question is just as, or if not more relevant. From your perch and as a leader in your company, when you look forward and you look at the next sort of big phase or cycle of activities as the company, how do you go about actually navigating those activities, and how, where are you putting your energy just in terms of management, in terms of thinking through what are the next separate opportunities for the company, either overseas or in the United States? What's that like, and how do you navigate it? I'm genuinely curious.
Well, look, one thing I will say in terms of how we are applying our energy is we are growing a lot more outside the United States. And I'm not just saying in terms of customers. I'm also, our hiring has shifted. We had also a record Q3 in that we added 75 people in Q3, which is a record for us. And, a lot of those are non-US, and we will continue to hire more outside the United States. There's also the kind of corporate treasury use case, and a lot of large multinationals and even small businesses that are export. There's treasury use cases there that I think are interesting, and certainly some stuff that Ripple's thinking about.
Well, listen, Brad, thank you so very much. Again, you've always made time for us and for DC FinTech Week, and it's really appreciated. And it's just a very unique insight that you've always brought, and that you've brought again this year. Thank you so much for joining us.
Thanks, Chris. Be well.
Hello, it is a great pleasure to present our paper at the DC FinTech Week. My name is Chen Yun Sam, currently an associate professor at National Zhengzhou University College of Law in Taiwan. In the past few years, we have seen a rising discussion on central bank digital currencies, or CBDC. These discussions mainly focus on CBDC's institutional infrastructure, its impacts on monetary policy and financial stability, and its implications for the role of modern states and central banks. However, missing from current debate is an analysis of CBDC's cross-border impacts. In our recent paper, we explore 3 spillover effects when general-purpose CBDCs circulate beyond borders. And we use China's ECNY as an example to demonstrate how these effects will play out. Accordingly, we propose a set of specific policy strategies across unilateral, bilateral, and multilateral dimensions. We find that the unique characteristics of CBDC will make it difficult for the issuing jurisdiction to prevent cross-border transactions, and that receiving jurisdictions will have an even harder time when it comes to monitoring and regulating the flow of the foreign CBDC. So we expect 3 spillover effects that will impact the receiving jurisdictions, while the issuing jurisdictions may also face some challenges. These effects are, number 1, a crowding out effect on local currency. Number 2, evasion of local capital controls. And number 3, infringement on privacy of foreign users. First of all, the crowding out effect involves a gradual process of replacing a less popular local currency when a popular foreign with a popular foreign CBDC. If the technological design allows for it, people can use foreign CBDC domestically with other holders of the CBDC. Thus, local currency is a risk of being replaced by the foreign CBDC if the foreign CBDC is considered more trustworthy or convenient in daily transactions. This effect will hamper the local government's monetary policies even if the issuing jurisdictions denies transactions outside its jurisdiction. And this is especially true if the foreign CBDC permits offline transactions. In such scenarios, users will be able to use foreign CBDC even outside of the issuing country. Second, with the advent of CBDC, capital control will cast a heavy burden on the receiving jurisdiction, as detecting and monitoring the inflow and outflow of CBDC becomes very difficult. And that is because capital can move faster via digital wallets, rendering traditional monetary measures no longer effective. And what is more, the customs officials may not have the required expertise and training to properly oversee CBDC-related digital wallets. And third, one of the main criticisms of the CBDC is that its design can potentially allow the issuing government to oversee the details of users' daily transactions. Although some have proposed designs that can limit or avoid privacy concerns, the threat to privacy remains real. This is especially true in countries where surveillance of citizens is a common practice. Since foreigners can also hold local CBDC, they might be subjected to the issuing government's surveillance. Now we turn to the case study of China's ECNY, and I will give the floor to my co-author, Ping-Hui Chen.
Hi, I'm Ping-Hui Chen. I'm an associate professor at Department of Diplomacy at NCCU. We take ECNY as an example in our paper because renminbi is a significant currency in the world economy. And also, ECNY is well developed. It is ready to launch. So as you can see in the picture, ECNY can take many forms. It can store in a cell phone. It can still store in a card. It can store in different devices. The ECNY will use double-layer design, and it allows offline transactions. It has the so-called controllable anonymity. So it allows different level of privacy settings. So based on these facts, based on these characteristics of CBDC, how would ECNY impact other countries when it is circulated in foreign countries? We argue that countries who signed up Build and Roll initiatives are most likely to be affected by the circulation of ECNY. So countries who have smaller economies, such as Pacific Island nations, or countries who have weak and volatile currency are likely to be affected. So, and those countries who host a large amount of Chinese specialists will see a lot of ECNY inflows, as those specialists will use ECNY in local markets. And those countries who receive a large sum of infrastructure funds will find their market is full of ECNY because ECNY will flow in through those infrastructure funds. Although those countries, there are many BRI countries, and we argue that those BRI countries who borders China will be most likely to be affected, and they are likely to face these challenges of spillover effect. So in our paper, we explore several policy responses, and we discuss three scenarios: unilateral, bilateral, and multilateral scenarios. We will not go through each of them because it would take too much time, but we would like to stress that the receiving jurisdiction can have a lot of measures to tackle these problems. However, these measures won't be more effective until the issuing jurisdiction take part and cooperate. So in our paper, we stress the importance of establishing a global governance structure that governs the design and the use of CBDC worldwide. So if you are interested in our paper is available at SSRN, and you can contact us through our email. Thank you very much.
Good afternoon, morning, or evening, depending on where you are. That was such an awesome panel. And now I'm excited to spend the next 30 minutes exploring special purpose acquisition companies, more well known as SPACs, which have in recent years served to reinvigorate the initial public offering market. I'll start with some quick introductions, which admittedly won't do any justice to our panel, but I nonetheless will try my best. So first we have Brendan Carroll. He is a co-founder and senior partner at Victory Park Capital, a global investment firm with a long track record of executing debt and equity financing transactions with some of the largest global fintech firms. Also of note, in my biased opinion, one of the greatest things is that he's a proud graduate of Georgetown College, class of '99. Next, we have Keir Gumbs. He brings a wealth of legal experience to bear as the Chief Legal Officer of Broadridge Financial Solutions, Inc., where he oversees the legal compliance and physical security teams. Previously, Keir served as Deputy General Counsel and Deputy Corporate Secretary at Uber. He was once a partner for nearly a decade at Covington and Burlington and still made time to serve nearly 6 years as counsel at the SEC. Also, we have Robert Jackson, a professor of law, co-director of the Institute for Corporate Governance and Finance, and director of the program on corporate law and policy at the NYU School of Law. Previously, he too wore many hats, including as SEC Commissioner for nearly 3 years and Senior Policy Advisor at the US Treasury Department. And then finally, we have Stephen Davidoff Solomon, the Alexander F. and May T. Morrison Professor of Law at UC Berkeley Law School, who is a well-known authority on corporate law, has co-authored a leading casebook on corporate mergers and acquisitions, and regularly writes a column for the New York Times Deal Book as the Deal Professor. So welcome you all. I'm just gonna jump right in, starting with Stephen. So the SPAC has been around for decades, yet there's something unique about the recent market boom. Can you explain SPACs and the D-SPAC, how they compare to the blank check companies of old, and what might be driving the current popularity?
Sure. I should also mention, in full disclosure, I'm a director of a SPAC sponsored by Social Capital. I have some familiarity personally with them. And SPACs have been around for a long time, and the idea is basically they raise cash, and then they have an 18-month to 2-year horizon to acquire a company that is private, and then they take that company public. Historically, SPACs have had a less than stellar reputation, there's been regulation imposed specifically because of that. They actually had a high point in 2007, 2008. They were the flavor of the month back then, and now they're the flavor of the month these days. And one of the things that they've done is, if you go to a website like SPAC Analytics, you can see there's over 500 SPACs now looking for acquisition targets. They're over half still of the IPO market. And basically, one of the things, the controversy around them is that on the one hand, they found a way to solve the small IPO process, which is back in 1999, we had about 500 IPOs that went off a cliff. They're finding a way to bring these more entrepreneurial, smaller companies out public. At the same time, that increases the risk. And obviously, with a lot of SPACs searching for targets, there's high demand. And so there's a lot of controversy around those issues, particularly on the de-SPAC transaction, which is when they actually make an acquisition. And so that's a basic summary, and I'm happy to hear from everyone else their thoughts.
Yeah, thank you for that. Now, turning to Keir, over your career, I imagine you have had plenty firsthand market experience with SPACs. So what's your take on this market? And particularly, what do you think are the benefits and drawbacks of SPAC mergers for a target firm?
Yeah, it's interesting. First of all, I totally agree with the comment that Professor Davidoff just made, which is about the stigma. And I think it's important to start there. When I was in private practice, we worked on SPAC IPOs, we worked on de-SPAC transactions, and they weren't viewed favorably at all. I mean, at that point in time, there was this idea of trying to create a private equity-like product that retail people can invest in. And that's what SPACs were intended to do. But when you looked at the way that they were constructed and just the way that they compared to other deals at the time, they just weren't viewed nearly as favorably. And then you fast forward to now, and to the point that Professor Davidoff just made, it's an incredibly vibrant market. And when you think about the IPO market particularly, it's huge. I still think that there are some challenges, and I know we're going to talk about some of those challenges on this call. But again, from a firsthand perspective, both at Uber and in my private practice, we've worked with a number of targets of SPACs. And the thing that's very interesting, at least from my vantage point, if you're a target, is that if you're a target company or private company that's thinking about different ways to create liquidity for your shares if you're privately held and create some liquidity and value for your investors, you think about the IPO, we largely know what that means in terms of what you have to put together, the disclosures, the process, all of those things. But the big difference, I think, in talking to some of those companies is that you have a little bit more control over the process, at least with respect to valuation in the context of a SPAC. And without speaking about some specific SPACs that are out there right now, I can just say I have seen numerous situations where you've got a privately held company that has, valuation A, and they know if they were to try and do an IPO, they'd have to fight really hard to keep or go above that valuation. And then that same company enters into conversations with SPACs. And the story you hear from entrepreneurs is kind of this, turnstile of SPACs coming in and pitching to acquire some of these companies, because some of the SPACs have these funds. They need to find an acquisition if they want to realize what the SPAC was created for. And then it's kind of a seller's market if you're one of these target companies. And what that has translated into is when you look at the SPAC valuation for many of these companies that are targets for de-SPAC transactions, they've gotten much more than they might get, certainly in the private market, but then much more than what they might expect to get in a public market as well. And so I just think it's a traditional IPO as opposed to a de-SPAC. And so I think that factor is huge. One of the questions is, what's the most important thing from the perspective of a potential target for a de-SPAC transaction? And in my mind, pretty consistently, the first word that comes to mind is valuation. The valuations are incredible. And, if we have time, we can come back and can give some actual real examples of that. But you do see that where these companies that really would have struggled doing a traditional IPO are being courted by and getting amazing, sky high valuations in these de-SPAC transactions, which I think is just very interesting to observe.
Awesome, thank you for that. And actually, that brings to mind a question, particularly for Brendan, because we do see these great valuations. And one example, in light of this being FinTech Week, is your firm's anticipated $4 billion SPAC merger for the banking app Dave. And so with that in mind, how do SPACs target firms to acquire? And what might SPAC mergers with FinTech firms in particular, what might be beneficial there or appealing?
No, sure. Dave is in process, as is Credivo. But this past Monday, our first FinTech SPAC announced and is now trading. It's called BACT. BKKT is the ticker. It's a spin out of Intercontinental Exchange, which owns the New York Stock Exchange. So it's the first FinTech corporate carve-out SPAC. So basically, we took a piece of a public company in ICE and spun it out, and is now trading independently of it. And I agree with what Stephen said earlier. It's replacing the 1999 IPO boom for your, call it, sub $10 billion business. The demand for SPACs is a little different today than it was, call it 18 months ago, but there was a lot of demand from public market investors, big mutual funds, et cetera, for tech businesses and particularly FinTech businesses. So that drove a lot of the demand for that SPAC structure, combined with, as it was said earlier, this was viewed as a more legitimate way to get public than it was, even a decade ago. So if the venture capital firms and private equity firms that are the equity holders in these FinTech businesses view this as an efficient way to get their companies public, but then you have, demand and supply meeting, and that's why we saw a lot of it. And for us, I mean, whether it's through a SPAC, a private investment, we have fintech expertise, and we've been investing in fintech for 15 years and have done over 100 deals in the space. So the fact that we're doing it through a SPAC structure versus a private structure, at least how we look at it, shouldn't be any different. We're trying to find quality fintech businesses that we think we can make money for our investors with and that we're bullish on. So Dave is a company we've known for 5+ years. We were actually a lender to the business, and we knew management prior to even starting the business. So, I think a differentiator there, and we had this conversation, at length during the IPO process in the beginning of this PIPE process. We've known the company for 5 years. This isn't a business that we just met, came up with a valuation, and then decided to take public through a SPAC. There's long history. We know the business. So there's no question on our ability to diligence the business. We've been working with them for years. So, I think SPACs will be here to stay for fintech, but I think you're going to see, certain institutional backed SPACs who have the resources and expertise in the industry continue to do them, as long as there's demand, again, from the venture capital and private equity firms that own these businesses. If they continue to want to use the SPAC vehicle as a way to get their companies public, and there's still demand on the other side from your mutual funds and long only holders, then I think it'll stay.
Thank you. So we've got demand, as you mentioned, from the private equity companies. We've got SPAC stigma seeming to turn around, and presumably there's a positive for bringing these investment opportunities to the retail marketplace. But nonetheless, SPACs have faced significant scrutiny. And so my question for you, Robert, is there's criticism from policymakers and regulators, including warnings even from the SEC officials that were actually speculated to have had market chilling effects earlier this year. And then there's burgeoning litigation. So in your view, what are the core criticisms of the SPAC market?
Sure. Happy to say more about that. And thanks, Nikita, for having me. I'm delighted to be having the conversation. It's been an interesting discussion. I have to say a little bit of an odd discussion because as a former SEC commissioner, the way I come to this is from an investor protection point of view. And some of my colleagues on the panel have talked about the stigma associated with SPACs. And Nikita, it's not like that stigma doesn't come from somewhere. Like, it's not like SPACs were impolite at a party. No, the problem is that SPACs are an atrocious historical performer in terms of financial returns. It is really hard to look in the history of American finance and find a product that has been as bad in terms of performance as SPACs have historically. It depends on how you measure it. And that's not to say there haven't been some successful SPACs. But the returns of this product, the stigma that comes with the product is that for over a decade, they have punished investors with significantly negative returns relative to any benchmark and on an absolute basis.
But Rob, I mean, so first of all, you obviously are always the best dressed person on these Zoom calls. And I just want to note that you look fantastic. But second, those returns are a couple things. One, the study, at least the one study done by Klausner, is not a good study. They don't do risk-adjusted returns. They look at older SPACs. We're looking at the new crop of SPACs, which are bigger, more entrepreneurial. I think the jury's out. You can't really compare SPACs from 10 years ago to today.
Well, first, let me just
take into account the risk adjustment, right?
I want to talk through the concerns more generally, and I have a few points to make. But Stephen, let's just be clear. I agree with the jury is out on current SPACs because their performance is not yet known. But Stephen, let's agree that the historical returns from, for example, the SPAC class of a decade ago are very poor on any benchmark, Stephen. You can adjust it for a risk all you like. But these are investment vehicles that have consistently lost money. Now look, we can talk about why that might be, or whether it's bad for investors, or whether one's definition of freedom requires one to be free to lose 50% returns on a 10-year-old investment vehicle. We can talk about that if you like, but those are the facts historically. Now, Stephen makes a very good point, which is that the current SPAC crop might be different. And I can't predict the future. That's not the business that I'm in. I will say historically, predictions that this time is different haven't been great. like in terms of, but hey, who knows in terms of finance, the market might surprise me. I want to say a couple of things about the kinds of investor returns, the kinds of investor concerns that the product raises. First of all, one reason for the bad performance is the astonishing, enormous compensation that sponsors of SPACs take from investors in the form of dilution of the underlying vehicle. One thing that's interesting is SPACs have been described here and elsewhere as a helpful sort of competitive substitute for IPO markets. I'm actually someone who's publicly criticized the IPO book building process. When I was an investment banker taking companies public in the late 90s, we charged a 7% spread on an IPO book build. And when I got to the SEC 2 decades later, mid-size and small IPOs still paid a 7% tax to investment bankers who were building a book. I'm all for competition in the IPO market. The problem is that SPACs cost like 3 times as much in terms of dilution. And so one reason that the vehicle tends to underperform is that sponsors significantly dilute the underlying asset by extracting compensation. By the way, Nikita, as you pointed out,
Robert, that depends on the size of the deal and depends on the package. You can't say that in a uniform term. If we raise $100 million SPAC and do it with a $5+ billion company, that is significantly less dilution than if you're raising $1 billion SPAC and doing it with a $2 billion company. So you can't make a blanket statement like that.
Brandon, with all due respect, I can. Just to be clear, on average, do you think SPACs are less dilutive than the traditional IPO approach? You don't think that?
Are you including fees like you just discussed with the bankers?
Brendan, you can include almost anything you want. The SPAC vehicle is hugely dilutive. Like the median dilution is 20 to 25%, man. What are you talking about?
Now, I'm looking at what we do. Again, this is back to, I don't care what the structure is. I'm trying to do a good transaction for my investors. There's been a lot of bad IPOs. There's been a lot of bad private equity investments. There's been a lot of bad venture capital investments as well. So I'm more concerned, are we finding a good business and looking at it that way? I could care less whether it's a SPAC structure, it's private, it's an IPO, it's a direct listing. That should be irrelevant. If you're going to look at it just from a structure standpoint, fine. But if you're looking at it from a quality of investment standpoint, look at the manager, don't look at the structure.
All right. So look, again, I just like to highlight the investor concerns and then we can debate them. Obviously, dilution is a significant investor protection concern in this vehicle. I don't think anybody actually debates that. And then last, I think the key to the point I would make is to the degree that this has been pitched as a solution to the mid-size IPO problem, Stephen is absolutely right that IPOs peaked in the late 1990s, especially in the mid to small cap size. No debate there. And they have fallen off a cliff, to borrow Stephen's phrase. He's spot on. He's exactly right. The question is why and what, if anything, should we do about it? My own view, is that the evidence that this was caused by regulation of the public markets is really quite weak. I think, Nikita, what's much more likely, there's a good NBER paper showing that the adoption of the National Securities Market Improvement Act of 1996 allowed private fundraising in a way that made it relatively more attractive as a business proposition than public fundraising. We can debate that. I just think there's other ways for us to address the shortcomings of the IPO market than the SPAC vehicle. And I think that would be another concern on regulators' minds.
Thank you. There's a lot to say here, and I'm excited. And so many questions come to mind. But just to start with one, I'm going to take it back to here and just homing in on the investor protection, because we have been looking at it from the business side quite a bit. So there are these quality of investment concerns. And even some research showing that SPAC share prices tend to drop by at least 1/3, I think it is, of their value within a year following the merger, which to some that leaves the retail investors bearing a loss. So are these major concerns from your perspective, or as Brendan put it nicely, is this a sort of manager problem versus just a broad market problem? Ultimately, do any of Robert's comments resonate, and how might the market actually mitigate those risks?
Well, I'll just say, as I was preparing for this panel, I was like, don't be negative on SPACs. Try to be as neutral as you can. There have been a lot of great comments made, and I agree with a lot of them. I am particularly, in line with some of the points that Professor Jackson was just making, which is that I do think that there is a quality of an investment issue with SPACs. And let me just be very clear. There are absolutely high quality SPACs out there. There are high quality managers. Like, there are good deals out there to be done. And there have been good deals that have been done, to be clear, right? So I don't want to cast aspersions on every single SPAC. However, I'm a big believer in incentives. You show me what the incentives are, I'm going to predict what the behavior will be, right? And in this instance, you've got literally billions and billions of dollars sitting in these funds in these SPAC transactions, waiting to find a target, and sponsors who are going to profit if they can find a target and sell it to investors and get that deal done. And when you take that and then you compare it against the number of quality companies that are out there, it is absolutely, in my mind at least, intrinsic in that structure that there are going to be bad deals that get done. That is just a fact. And I can say firsthand, I've worked on deals representing targets where SPACs are coming in looking to acquire them in connection with a de-SPAC transaction. And literally, here's the conversation. We've got X number of months left before we have to release the funds from the trust. We need to find a deal to get these funds out. We've tried. We've negotiated with these one, two, three. They all failed. We're not talking to your company. Can we get a deal done in 6 months, 9 months, whatever time is left? I've had that conversation, and I haven't had that conversation once. I've had that conversation multiple times with SPAC sponsors when they're trying to find a de-SPAC transaction. And so while, again, there are absolutely great deals that still get done in that scenario, from my perspective, those incentives really set up a big investor protection issue, I think. And the real question is, how do you address that investor protection? Because let's be clear, the disclosure is there. There are disclosure requirements that currently apply, and we're going to talk about potential expansions. There is liability for there is liability for the officers and directors, and so people can't be deceptive as they put these things together. So just those are there. However, that incentive is also there, and how you address that incentive is a real question, at least in my mind. And I think that that's something that this current administration is going to really grapple with, because they've identified it. I agree totally with what everyone has said, which is this has become a completely legitimate form of capital raising and a completely legitimate way for companies to go public. The question is, are the right companies going public, and are investors suffering when the wrong companies do? And that's a question I think that the SEC and others are going to grapple with.
Can I respond to that? So I think we live in an age, at least with the current administration, where I would call it like California rules, where any perceived harm must be regulated and addressed by the government. And I think taking a step back, like, this is no different than our capital markets. We have reputational concerns or otherwise. When I became a director of a social capital SPAC, I did so because they have a great reputation. They've done Virgin Galactic, they've done other IPOs, and they've returned for their shareholders. And that's no different than any other investment vehicle. And we can quibble about, and maybe it's not quibbling about the dilution or otherwise, but people are not being forced to invest in these. There's a pipe that happens at the de-SPAC. There's, people stay in it. And I also think that I totally agree that it doesn't mean we can't fine tune these. I think Rob's lawsuit, for example, about the Investment Company Act, and we shouldn't be allowing them to become investment companies and investing in securities. I agree with that. I do think we can look at the disclosure. I think we need to know more about the dilution. I'm still uncertain about who invests in these on the de-SPAC and who goes forward. I think the point, though, is that we finally have solved, and with all credit to Rob, who's much smarter than me, like, we've been trying to solve the IPO problem since the 2000s and haven't come up with a solution. We finally have a solution. Let's not kill the golden goose. Let's try and make it better.
I mean, I think, I'm not the lawyer or the former regulator, but we've had conversations with, other exchanges around the world who are looking to, add SPACs there, whether it's in Australia, the UK, et cetera. And first and foremost, I mean, what Victory Park does primarily is we manage private capital for pension funds, insurance companies, endowments, et cetera. We're regulated by the SEC. We're a regulated investment advisor. You should have to be regulated in some way, shape, or form if you're going to manage a product like this. We fully believe in that, and we see now a lot of companies that are calling us, they want someone who has an institutional background, compliance, legal, et cetera. So I'm all for that. Second, they made a rule change from the last time SPACs were popular. The last time around, you couldn't vote yes and get your money back. So change that. Make it very simple. And change it to above 50%. Make it 2/3 vote required. Let the investors negotiate that. So again, you can tweak this and make it, at least in my opinion, far more fair. And then last but not least, we can debate the sponsor economics, et cetera, but the way we do it, like, we have to put our own money up personally for that sponsor share. So here's right. If the SPAC doesn't happen, we're losing our money. That is not the case with all SPAC managers where the money's coming from their fund and it's whatever. You're on average for every 100 million in SPAC raise, it's about $1.5 million, give or take, that you're putting in. If it's a massive fund that's sponsoring the SPAC, it's not really going to move the needle at all. If it's a multi-billion-dollar fund and you're putting whatever $4 or $5 million into at risk for the SPAC, make the managers of the SPAC put that capital in personally. That's what we do. We have all our employees put it in as well, and that's resonated well. So there are some things you can do, in my opinion, to make this fairer, add more regulation, add more transparency. I'm all in favor of getting rid of future estimates. Let's get rid of that. There are ways to make it, a much better product.
And again, I just want to jump in because I want to just build on. Is that okay?
No, I was literally about to go to you and ask you to build on the regulatory discussion and potential. So you read my mind. Go for it.
Thanks. So sorry about that. I want to build on because I really agree. I think Brendan's and Kira have made some, and Stephen have made some powerful points. So from a regulator's point of view, I want to say three things. First of all, Brendan and Kira are absolutely right that to the degree we have good data on performance, the manager matters. And that makes sense to me. It makes sense to me that managers with good reputations and in particular operational expertise, that they tend to outperform. That makes sense to me. And the idea that we would let the market segregate those different kinds of SPACs is intuitive to me. And as a regulator, what I might be interested in doing is making sure that people can tell the difference, that there's a sufficient transparency and that people have a good sense that, for example, someone like Brendan has got a lot of skin in the game. The SPAC is building a board full of profoundly, deeply, nationally known and respected folks like Stephen. I think that really matters, first. Second, I think it's in everybody's interest that this product get into better shape. And I think all of us on the panel agree about that to the degree that Stephen's right, that this helps us address the IPO problem, we should want the product to do that in a way that's responsible for investors. And I want to make one more point, which is Brendan is right. The SEC made a crucial rule change earlier this year that I thought made a lot of sense. The rule change they made was they said, to the degree you have outstanding warrants or other equity positions that are going to dilute this product, you're going to have to account for them as liabilities and disclose their value. Basically, my view, Nikita, is what this does is give investors information on whether I'm right, whether the dilution, the expense to the investors is really as significant or how significant it is, so investors can make a decision. Now, I was a guy who thought that was a common sense reform. If I want to understand the incentives as Keir describes, boy, I want to know how much those warrants are worth that the sponsors take, or the shares the sponsors take. I got to say, I was a little disappointed that the market didn't seem to welcome it with open arms. They sort of said, well, we're going to have to be a little more transparent, and that might chill investment. What I'd say to that is chilling investment that's got a bad historical record is not a problem in the market to me. I think we need to get this product into better shape for investors.
Yeah, Robert, I think the biggest issue with that one was because, again, obviously we had SPACs that were already in process. We had to go back and restate. There wasn't transparency and agreement as to what that rule, those rules are actually going to be. Pricewaterhouse said one thing, E&Y said another. But I agree, you need that transparency.
I think we're going to have to wrap this discussion up at this moment, guys. This has been rich. Thank you so much. I'm going to now toss it back to Chris, but thank you for an awesome panel.
Thanks, Nikita.
Thanks so much, guys.
For me? Okay, good. So we're about to go internationally again with a conversation switching from the intricacies of the market to really some of the global issues facing some of our major central banks. And we are just absolutely delighted and honored to have Amir Yaron, the governor of the Bank of Israel, here with us to talk and to share his perspectives on, again, pricing risks and opportunities in the global economy. Thank you, sir, so much for joining us. I know you have an interesting presentation, so I'm just going to pass the microphone to you and maybe listen to what you have and then engage in a conversation. But thank you so much for joining us.
Thank you, Chris. I'm delighted to be here. It's a great conference, and obviously FinTech is an important issue in Israel. Actually, it's 8 p.m. here. I'm in my Tel Aviv office. Usually I'm in Jerusalem. And the whole surrounding area is essentially the high-tech industry. And they are just about to go out for what in Israel is Thursday is the night out. So I feel this is completely appropriate that I'm doing this right now. So Israel is known as the high-tech, is kind of called the startup nation. We have the highest per capita startups, over 1,000 startups a year. We've gotten that name, and it's a major component of our economy. In a second, I'll show you how much it helped us. We call it the economic Iron Dome for us during COVID. And so what I plan to do is really, as Chris mentioned, just give you a few factoids about the Israeli high-tech and FinTech in Israel. And then probably we will dive to a conversation with Chris about maybe the sources of that, and then more generally about opportunities and risks that emerge in the financial world as these new technologies emerge. So this just tells you a little bit how important the high-tech sector in Israel. It's about 15% of Israel's GDP. In the US, which is already very high, it's about 10%. It provides about 10% of employees. And this is actually right now a binding constraint for us. We really need more high-tech people. You could see how important it is in terms of our exports. And even from a government perspective, it provides a lot of the tax revenue. This is, by the employees. There's also obviously the channel of the companies, and those who happen to make exits, et cetera, are very important for the economy. So this is the graph that I wanted to show you. I think everybody through COVID has learned about the exponential function. Well, look at the blue line. This is services exports in Israel. You could see it just went through a locomotive through the past year and a half. And this is partly a benefit of what Israel is relatively strong within the high-tech sector. This is medtech, digitization, and in particular cyber and fintech. And you could see relative to the OECD and the US, where there was a bump, we just went through it. And in fact, that has led, Israel is one of the countries that managed COVID with a relatively, I would say, one of the smallest contraction, about 2% of GDP. And now we are a very high positive rate. And this has been the engine that has, moved the economy. And for us, this is obviously very, very important. I mentioned the human capital that's needed in order for that engine to continue lead the Israeli economy. Just a few notes on funding. The exponential is not just on the exports. You could see on the right-hand side, you could see even on 20, the growth relative to 19. This is all through COVID, and you could see essentially the exponential growth in the first 3 quarters in 21. This is a very large sum. In a second, I'll make a little bit of an international comparison. You can see it's about $17 billion right on the right-hand side. So here on the top left, you could see the growth rate in funding in the blue in Israel. You could see Europe and the US. I think the bottom is a more formidable picture of how important this is in Israel. You could see in terms of funding, this is like 4% of GDP. It's a very, very important component. And just for those who are, we're a small country, we're about 0.5% of world GDP, and yet we've provided in the past year about 8% of world unicorns. So it gives you a little bit of a perception on that side. What happens in Israel? Large R&D, both by the private sector and the government sector. You could see we're clearly on the right-hand side here in terms of as percent of GDP. This is large expense, and this is partly comes back in the form of generally of the high-tech sector. So I want to talk, this is a conference about FinTech sector. So what is the FinTech within this high-tech sector? It's kind of a subcomponent of that. And I'm going to make two arguments. I'll just say them out loud first. Basically, the FinTech sector is becoming an important part. Its growth is immense. And what's important for me, when I look at it, it's well diversified. It's not concentrated within one segment of the FinTech sector. And even through COVID, we made sure the seeds for early and continuation of growth are there. And I'll show you that seed money is really there. So let's get going. So first of all, you could see the percentage of FinTech investment in Israel out of total world investments. Certainly a rising share. And what's important, what's here in the little bubble, it tells you that we've sort of received a lot of, this is essentially 75% of the investments are foreign, which kind of means, to me, it's an indicative that we have it's a testament that we have the trust of the general community outside of Israel. On the right-hand side, you are seeing the funding just to FinTech. I mentioned 17 billion overall, out about almost 4 billion just in that area. We have about 550 companies and just around 40 R&D centers, all in that sub area. So this is a very active area. I mentioned that it's a diversified area. The major areas are trading and investment, payments, but you could see it's really all around. And what I mentioned earlier is the seed numbers. I was kind of worried that COVID will stop the engine in terms of very early stage. And to me, this means this phenomena is not stopping next year or the second year. This is probably here to stay. It also tells you how much Israel, and I don't have this graph, but generally the high-tech sector, and in particular the FinTech sector, are highly correlated with what's happening in NASDAQ, and it means we have those connections, but it's sort of potentially highly correlated with the fate of what's going on there. So what I'll plan to do, Chris, is now move the microphone back to you, and we can chit chat a little bit more where this ecosystem may be, and then talk more about opportunities and risks that emerge here.
Great. That was a fantastic overview. Thank you so much. As we sort of switch back to the toolbox, Joe, I think that what struck me with some of the slides was, first of all, just that particular slide about the 8% of unicorns being in Israel. That's super interesting. I mean, even relative to the R&D. What do you think are the ingredients, on your end when you think about Israel that really contributed to this kind of innovative environment, and is this something that you think that other countries can replicate?
So I think it's a great question. I often travel abroad, and not in the last 2 years, but in general, I get two types of questions about Israel. One has been about COVID, because we've had a lot of vaccination, and the other one is indeed about the high-tech sector. and how did we get there? I think, as you know, we've had security issues, and I think a lot of it goes back there to early stages where, well before people talked about buzzwords such as, or just data analytics, cybersecurity, big data. This was early investments in those areas were undertaken in the security area, usage of big data. You have many soldiers, young, early on in their formidable years, being in those types of units. A lot of our successful entrepreneurs, it's pretty clear, came from those units. And I think it's the combination of very, early investments in this area, and the fact that in those circumstances, you need to be very task-oriented, immediately helped sort of generate a very appropriate attitude towards sort of what we call the high-tech and sector in that regard. This obviously comes also with quality universities. We've had good areas of artificial intelligence, mathematics, and science, and some of these soldiers then go to the universities. There's a lot of interactions, I would say, relative to perhaps other countries between the universities and the private sector and the security sector. And so some of these students go back. And so this, I would say this synergy has also helped maintain a good step in those directions. The third component is government investment. There is a science, I would call it the scientist general, which almost is almost a VC arm. And it has been a VC arm for quite a while. And so, as I showed you, we had the number one in terms of percent of GDP R&D investment, and part of it is coming directly from the government. So that's the third component. And I would say that what allowed the fintech sector in particular to grow has been that two additional components. One is that it came after already a successful high-tech sector. So it had leaders leading it into funding. It had the know-how. And so that was important. And the fifth component that I would isolate is that Israel, what is really maybe an issue, became maybe a blessing. We are a small country, isolated country, and the focus of those who went there was B2B and not B2C. And these unicorns that you've seen and the ability to sell them in high valuation, in particular, the initial fintechs have been to financial institutions, big banks, and the initial step has been B2B, not B2C. And it's very hard to enter into the B2C area as a new entrant. And perhaps that was guidance through some of the VC, but partly I think it was because we're a naturally small and isolated market. Anyone who's thinking down the road is pushing in that direction. And that turned out to be a good bet. So I would say, you asked me about the ultimate question, how can it be replicated? I wouldn't suggest having security problems, but I would say high human capital is essential. Funding, access to funding is essential. Close ties between basic research and applied research, and something about which I'm changing an Israeli phenomena, which is very driven towards an entrepreneur, the ability to willing to even to lose things, not to be just a wage taker. We have a big segment of society right now that is entrenching those types of activities.
Yeah, I mean, really, really quite useful. Particularly, the R&D and it sounds like some may be some parts may be replicable, but other parts, for some countries it may be more of a challenge. And this is I don't know if you wanted to end the share screen or any of our folks in the back working with this. I just didn't want to interrupt this. It was just too frankly too interesting. But there are, fintech is interesting. It's just like anything in finance. You can have a lot of it. It can give you a competitive advantage. You can have a lot of it. It can create headaches, and so when you think about pricing the risks and the opportunities in the fintech sector, but also, with the central banking kind of public policy concerns, including investor protection, consumer protection, financial stability, data privacy. There's just a range of different kinds of things. Like, how do you go about balancing this special innovative environment and those particular risks and navigating that world?
So first of all, you hit the nail on its head in terms of a lot of the issues. I don't know if you are seeing this sort of green-red slide that
yes.
we posted here, and a lot of the things you just mentioned are actually on top.
Yep.
I think we think a lot in the same way, and maybe I'll to take a few minutes, I'll talk a little bit about the opportunities and then the risks, because I think they're very, very important. Some of the opportunities may be more obvious and some of the risks may be less so. But I do think it's very important to understand that I think the fintech industry, as it is challenging old industry, banks and other financial institutions, has the ability to improve in terms of product quality, product types, and ultimately reduction in cost. I think, and I think that's going to be manifested by the advancement of digital technology, the rich data that allows you to form new credit models and access other parts of segments of society. And also what we are seeing in the fintech sector is allowing that. And of course, the old traditional financial sector is reacting to that. So they're also doing it partly through cooperative efforts through the fintech sector. But I think the fintech sector is the instigator, is the unbundling of financial products. And that is I think that is very, very important. And just one example about technology, for example, faster payment, immediate transactions with smart contracts, programmable payments, they can reduce credit risk, counterparty risk, ultimately lead to better functioning, better and better cost. If you're thinking internationally, globally, at some point, we know certain countries already have a memorandum of understanding of developing cross-border, which usually have a large cross-border payments, which have large transactions. There's a huge issue of reducing those. So I think improved product quality, increased competition, that's one. You mentioned, and I completely agree, the importance of financial inclusion. There's a pivotal contribution here for them. The ability to, through technology, circumvent around barriers, using advanced means of technology to reach members of society that others couldn't get it, maybe new credit models towards savings and loans, even financial education can be done through some of these. And ultimately that should lead to inclusive growth, possibly reducing inequality, and also from a government perspective, perhaps reduction in underground economy. And I think I mentioned the unbundling. I think that's important because it ultimately can allow you to rebundle back and make what I call tailor-made financial packages, which allow for people, you mentioned risk, they can then understand better, tailor-made what's for them, their risks. And I think that's a lot of good news that can come from there. And that means regulators ought to promote innovation. They need to use smart regulation, perhaps allow for some excess or shared infrastructure. For example, we are in a central bank, so things like Sandbox allow them to do it. It basically promote collaboration between the banking sector and the fintechs. Now comes the red dots, which you mentioned, and you said there is a good. I completely agree with you that the risks are there. And the first one I see is consumer protection. There are new entities. Some of the regulations don't necessarily even apply to them. One issue that we are all seeing in the media and everywhere is the issue of data manipulation and consumer biases. And I think that's a big issue. And one has to deal with that on the one hand. And on the other hand, you don't want to create overly stringent regulation to dissuade fintechs or even big techs from entering into the marketplace and bringing about competition. So that's consumer protection. That's one. Consumer information, what we are seeing with privacy risk, due to the scale of data, the enormous amount of it, and the richness of that, is should we restrict collection, or should we instruct particular storage and usage? Should the same company that gives credit and uses some data, if at all, should it be allowed to sell that data, which the consumer really owns it? So these are important issues that I don't think we have perfect answers for them. And I think you have been in the regulatory side, and I think that we're thinking about those things. And obviously, developments move very fast, so regulators need to respond relatively fast on those dimensions. I would say one more thing that relates to data ownership and information. Data and information is in many ways the key asset for fintechs and for financial institutions. And there is an issue as you regulate these things, how it can be used. I mentioned some possibilities, but that can have profound implication for what the ultimate market structure will be. I'm thinking of large institutions. There are some natural network externalities, big companies. Do you want them to own everything, end up winner kind of having all, but at the end have large market power? And so I think when it comes to regulation, the issue of how it can be used, what type of restrictions are immensely important, not just literally on the privacy of the consumer. They ultimately will have implication of what kind of market structure we will end up here. One big elephant in the room is cybersecurity. As you have new entities here, I would say it's a major risk. Technology, digitization, obviously enhance this interconnectedness. We know, for example, we're doing the budget here. We just passed an open banking in Israel in a big format. There's going to be a lot of small fintechs that get connected to the major financial institutions. We want to make the old institution do cloud, use cloud and open source to some extent. And all of these things elevate exposure, and you are only as strong as your weakest point. And that makes it scary, because some of these fintechs, their view on their business might be a call option on success and not really downside if some things don't work. And you have to make sure there's no regulatory arbitrage, even with respect to adhering to cybersecurity. And this is something that I think is very important, and it's a risk that cannot be overlooked as you open it, and you now have a system that has very different institution in terms of their deep pockets, their investments in these things, and they are sometimes controlled by different regulators.
Just to jump in there, this overview, number one, it encapsulates almost everything that we've been doing on this last week. I mean, in one slide. I was actually talking without having seen the slide, but it really does reflect everything from our, with leaders from the BIS working on open banking to the financial inclusion questions that we've had, to FinCEN in the United States talking about sort of cyber risk, and to see all of these issues being centered in on a central bank is super interesting. We only have just a couple of minutes left before we have the U.S. Treasury Department signing in or leaning in on a very big issue here, and that of stable coins. But I did want to just sort of eke in one question before we get there, and I think you could have a very interesting perspective, which is, do you have a sense, or what's your view really on, the future of money itself, from a regulatory perspective and from your seat and from your perch over at the bank?
So I think it's an appropriate question. It's a very good question. I think all people in finance and certainly in central banks are thinking about it. And it's directly linked to the, fintechs are heavily involved in cryptocurrencies, in trading platforms on these kind of things. And these things are getting closer and closer, or affecting, I would say in a geographical sense, getting closer to the radii of the monetary system. And we know money traditionally has three functions: medium of exchange, unit of account, store of value. And I think some of these features can increase efficiency, can provide liquidity. We see a new area of DeFi and things like that. But I think it does raise the issue and the risk, and I put it's on that slide, of money fragmentation. And as you slice and dice these things, and I think even here, one can think of the different platforms differently. For example, I think, at least at this point, I think of crypto or unstable coins as being farther away from some of the features that I mentioned about moneyness. And it's more of a financial a financial asset. You need to think hard about consumer protection, transparency, think hard about what risks are involved there. Again, regulatory arbitrage of AML, CFT, and et cetera. So I think that's one bucket. As you're moving in the spectrum towards stablecoin, those are getting even closer to that money segment, and they have more of a they could, I think, be closer to that money area that can provide risk in terms of money fragmentation. And I think central banks are, on the one hand, should embrace innovation and technology, and yet we need to have a diligent eye about that potential of money fragmentation. I think central banks are well positioned to prevent this money fragmentation. We have to ensure that the payments become more uniform. Uniform doesn't mean the same, but compatible, interoperable, connected, reliable. They need to be resilient and trustworthy. That's a really important issue. And I think CBDC is one avenue that potentially can ultimately reduce this risk to financial stability if it comes from that segment. It can also provide, I mentioned earlier, programmable money, DVP. It can also be done. Central banks could do that through interoperable, faster payment systems that are working together. So I think the issue is there on the table. We at the Bank of Israel are also following all these and are I would say, putting our fingers in the mix in terms of familiarizing ourselves with the relevant technologies. But I think it's important to allow technology, but I think it's very important to make sure that the monetary system stays, and I'm borrowing words from others, trustworthy and resilient. And I think these are key to preserving the healthiness of the economy going forward.
Well, thank you, so much. Over this last week, we've heard from really everyone. From Chairman Gensler this morning to the heads of the IMF and BIS and central bankers around the world, like yourself, to obviously the heads and titans of industry, to community bankers, and words like trust and resilience are really words that just you hear an enormous amount of about, and you realize that as many things change, some things don't. But sir, thank you so very much for your time. We know it's late in Israel. Thank you so much for showing up and sharing your perspective with our students and our community here around the world.
Thank you very much, and see you later.
See you later.
Bye-bye.
So after 4 days of conversations with people and headliners around the world, we are at our last, our best, our headliner for the day. The Undersecretary of the Treasury Department has managed to squeeze us into her very, 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 very busy schedule. Nellie Leanne, thank you so much for joining us. I know just by reading the paper how busy you are, but it's just fantastic that you're here to be able to share your perspective with us. Thank you so much.
Well, thank you, Chris, for having me. Appreciate the invitation.
Okay, well, as I said, you are a busy person, really important. Yeah. And one of the things that's been on your plate has been an issue that we've talked a lot about this morning and really throughout the week. And it's this very interesting issue of stable coins. And you serve on the president's working group on financial markets, or the PWG, here in DC Talk. First, maybe can you just tell us a little bit about this group? Because here in Washington, people are familiar with it, but maybe some of our listeners in Europe and Silicon Valley may be a little bit less familiar with it.
Sure. Of course, Washington loves its acronyms, that's for sure. The PWG is the president's working group on financial markets, and the secretary serves on the PWG, as does the chairman of the Federal Reserve Board, the chairs of the Securities and Exchange Commission, who you had on today, Gary Gensler, and the CFTC. And it was formed actually in 1988 after the October stock market crash in the previous year. And it was set up by an presidential executive order to look at the issues that were raised in that stock market crash and to propose legislative changes, if any were thought to be necessary. And it has carried on and has looked at market development since then, and periodically meets and chooses to examine issues of the day. And most recently, Secretary Yellen convened the President's Working Group in July to look at the issue of stablecoins, which, as we all know, have grown quite rapidly in the past year.
Well, let's pick up on that. The PWG is really a very important group. It really is a catalyst, or at least is meant to be a kind of a catalyst for deep thinking and ultimately action in emerging areas of either concern or opportunity. Stablecoins have really risen dramatically in terms of the market cap, as you rightly noted. I think 130 billion, perhaps it could be more. Before getting into the sort of the risk per se, just analytically, how have you assessed the use case for these particular products, right?
Yeah.
Is there a spectrum? Are you sort of honing down on one particular? And, just looking from the use case perspective, what do you think about those and their implications for the financial system?
Right. So I'm speaking for myself today, just so I can speak a bit more freely about some of the topics. But, as we all know, there are estimates of how big stablecoin has gotten, right? 120, 130 billion. But other than that, there isn't a lot of information about the use cases. Most, generally, of course, we think it's mostly for trading, crypto to crypto assets, but there's growing and potential for its use as payments. So we, of course, scour all the data sources, but they're inconsistent, incomplete. As part of this process, we've reached out to stakeholders, a large, broad swath of them. We've actually had 6 roundtables, which are the issuers and the other providers in the stablecoin ecosystem, the financial institutions, the payment money transmitters, academics, others. So we've tried to reach out broadly and, to set up the discussion and to examine the use cases. So that's how we're approaching this at this point.
Yeah, that's an interesting and I think important observation. Something is decentralized. It means you have lots of different kinds of actors, lots of different kinds of relationships. One of the red flags of little surprise has been sort of that relating to financial crime, and we had the acting director of FinCEN on just yesterday, sort of talking about these issues, as well as the White House National Cyber Director. But from your perch, what are your initial observations, perhaps, as you're putting your report together about sort of the financial crime risks? Do you see these as a continuation of an old story, or are you viewing any risks tied to stablecoins as something new?
Sure. So, Chris, if I could just step back a little bit before just jumping into financial crimes and just think about the broad framing of stablecoins, I think we'll see how financial crimes fits in. So we are currently focusing on the stablecoins that are tied to a fiat currency, in this particular case, the US dollar. So it is a particular kind of stablecoin, not tied to, an algorithm or some other kind of asset. There clearly are potential benefits to stablecoin, and there are potential costs. And many of your speakers have talked about potential for greater efficiency, inclusiveness, costs. Of course, there are risks to end users, the economy, financial stability, national security. Those are the kinds of issues. The objectives for any regulatory framework, I think I kind of put them into 4 buckets. One is to protect consumers and investors. 2, to prevent financial crimes. 3, to ensure payment system resilience. Resilience is that operative word there. And then, of course, 4th, not pose significant risk to financial stability. So we're looking at this in that broader framework. So coming back to financial crimes and stablecoin, clearly with digital assets, there are money laundering and terrorist financing kinds of issues. It seems at this point that the risks of that for stablecoin aren't really that different from other digital assets. The difference could be that if stablecoins as a payments mechanism, where it is used widely by households and businesses, for example, as some firms are promoting new stablecoin systems, if it scales up quickly, one could imagine that it just becomes a bigger problem just in terms of volume, right? If it scales up and becomes liquid, that sort of attracts the illicit transactions that like to be in liquid markets. And then it's about whether you can enforce the current standards sufficiently, which is currently a problem across countries. I think there's currently a issue about enforcing some of the AML CFT standards on a consistent basis across countries. So I think we're looking at it in that perspective, not as a distinct risk, but nonetheless a risk, and will require a bit more attention, even more attention, I should say, on preventing financial crimes. And that's been an ongoing issue.
You know, it is interesting, right? But maybe I've been through one too many cycles of sort of new things in the world where I'm like, I'm starting to notice patterns, and I'm realizing how old I am now. But you know, one thing that I think is interesting, and you said it, and I'll get back to the risk part, but just as an aside, and personal aside, is that, you know, we're at this kind of interesting moment in the world where you have lots of inequality, and people are trying to, you know, we're asking questions about inclusion and what it means, and what is the relationship between technology and inclusion. And, you know, just totally as an aside, you know, I kind of always sort of say it's useful to know where the demand is coming from, because, you know, there are all these new kinds of projects. Sometimes you see people who feel that they've not had access to, you know, or the legacy sort of system hasn't always treated them as well, and they resort to, for better or worse, different kinds of technologies. And you know, is that a sign of the you know, if the technology is solving something, you know, what does that mean when you have more fragile and vulnerable communities, but getting something that they haven't been able to necessarily get before in the past?
Right.
And I only mention this because, you know, I use the example of Uber when I was like, you know, people have always sort of criticized sort of Uber, whether or not Uber is good or bad. I knew that I couldn't get a cab to Harlem. You know, if you don't understand that you can't get the cab to Harlem, then what is that demand, you know,
right,
coming from, kind of a question. When you think about stablecoins or any kind of technology, you know, there are these risks. You know, what are the stablecoin issuers doing? You know, with the funds and the assets, you know, sometimes there's an interest to achieve a higher return. How do you balance those kinds of risks while also thinking to yourself, well, are they doing something that our legacy system isn't? You know, like when you just as a policymaker, is that a you know, how do you go about balancing that?
Yeah. I think, as you say, as a policymaker, you want to preserve the potential benefits of any innovation. And stablecoin perhaps could be the future of more efficient payments. You could get perhaps more efficient payments through FedNow and some of the other mechanisms. So there's not necessarily stablecoin is the answer. I do think payments are too expensive right now. And so ways to encourage more efficiency, faster and lower cost, you know, we would support. And so you want to allow for that. At the same time, you aren't helping the system at all if what is called a stablecoin is actually not stable. And, you know, so you don't want to allow that kind of risk to build. And I think you were asking a bit about, you know, if the assets are not in the funds, are being invested in assets that aren't really as stable as you might need them to be in both normal periods and stress periods, then you've just kind of introduced a new risk into the system that could be costly. And, you know, while we don't know a lot about stablecoins in terms of lots of data, it seems to be one thing everyone seems to be sure about is that not all stablecoins really have stable value behind them. And, you know, it was reminiscent a bit of, say, money market funds, and many academics have written on this, and regulators have spoken about this kind of parallel. So I think those are trade-offs.
Yeah, just to sort of follow down that particular thread, like how would you view the financial stability risks, if using the money market fund analogy here, if a stable coin was to break the buck, like what would that mean in practice?
Yeah, so breaking the buck puts it under the category of like a prime money market fund. What that does is leads to forced or fire sales of the underlying assets, which can contribute to disruptions in credit provision to, businesses. It could also have a contagion element to it, that if one stable coin looks unstable and investors start to run, that they might, run from others. So that would be a financial stability piece of stablecoin. But there's other risks, as we mentioned. We want to ensure that the payment system is resilient. It's a new technology. It needs to meet the standards of existing payment providers, as well as ensuring that the new technology is resilient. And then stablecoins could scale up quickly if there's some kind of network effects, et cetera, that could raise different kinds of either concentration of power, economic power issues, or financial stability issues. So those are specific to stable coins. But there are broader, I don't want to overemphasize the financial stability risks of just stable coins. The rest of the crypto space has grown a lot, and even recently a lot more. And it's becoming more tied to the traditional financial sector. And so in that sense, if you have a growing market tied to the traditional sector with very volatile asset prices, and some increased use of leverage, one could start thinking about, does this look like a risk to financial stability? And so one thing the report could do is say, the Financial Stability Oversight Council should be looking at this issue, or Congress should be looking at this issue. And so there are, but the report is going to be focused mostly on stable coins, but it's hard to abstract from digital assets more broadly.
It really is. It really is interesting, right? I mean, as you know, it's kind of a bit of a spectrum, if one will, between
absolutely
pure crypto and sort of stable coins, and then you have the CBDCs. I mean, with the report, I know people would just kill me if I didn't ask. I mean, I guess number one, is there a reason why there was a specific focus on stable coins, right? Yeah. Given the fact that there is a lot of heterogeneity in the market. Mm-hmm. And then, is there a kind of a process timeline as to how you are thinking about
the report? It's a very fair question. It's not the first time we've been asked why stable coins. And given especially as I mentioned, the increasing risk to financial stability, perhaps from these other kinds of the broader spectrum, I think the focus we brought to this that we thought was especially interesting for looking at the regulatory framework is stable coins seem to be, a special interest. They seem to be foundational to the trading and lending in digital assets. They hold out the offer of stability, as we talked about, and the idea that they could scale very quickly raises, and if they become widely used for payments, then it raises issues about money and payments, and the importance of being stable in value. So it's a new product that's, combining money and payments at the same time. And it seemed very appropriate and important to look at whether the current regulatory framework can actually accommodate that. Does it work in that system? And so that was the focus. And it's not to say other parts are not important, but it's a first start and may raise different kinds of issues. And so we thought take a little at a time while you.
Yeah, no, it's quickly evolving.
Yeah.
You know, well, we've heard, at least over the last couple of days, you know, as I said, we've had our wonderful friends from the BIS who've helped to us this year with co-sponsoring this. In the past, we've had the IMF, and we've always had a lot of international friends, and just sort of thinking through these issues. And we've heard, as I'm sure you have as well, you know, conversations about CBDCs, central bank digital currencies. The head of Israel's central bank just now had mentioned that. You know, do you view these as complements, competitors, substitutes? You know, if one day the Fed was to move in the direction of sort of issuing a digital dollar, you know, what would this do for the management of something like stable coins?
Yeah. So let me talk a little bit about the last part of your question first. If there were a digital dollar, if there were a CBDC, you know, it could potentially make it easier to regulate stablecoins. One is might reduce the demand for stablecoins, you know, so that's just doesn't allow it to get big. One could imagine reserve assets could be CBDC or something like that, you know, so I mean, I'm just thinking, you know, in the, you know, broad scheme of things, there's always that potential. But I think we're not coming at this right now with the view that either there is or is not a digital dollar in our, you know, framework over the next few years. As you know, the Federal Reserve is going to be issuing a discussion paper on the future of money, and that's expected sometime soon. And it will be, you know, it will discuss the future of money, the potential for CBDC, and raise lots of questions for public discussion. I think that with a stablecoin paper, we can get much deeper into those conversations once the papers are out, and look forward to having those kinds of conversations. They're really important issues.
Yeah, you know, and this is from someone who hasn't, you know, put one of these kinds of papers together. So it's literally just a curiosity question in terms of the process for these things. When the Treasury Department or the Fed, in this particular instance, for their paper, so you're going and you're engaging the stakeholders, you're getting their input, you know, you're talking internally with your staff, you're appearing on, you know, with nerdy law professors on their FinTech Week programs, you know, so what is then the process, you know, when you're putting the working group paper together? You know, I assume that there's like a timeline or an aspiration as to when you want to put it out, and then what happens to it then once you've released it into the wild?
Yeah, so different papers, of course, you know, what happens depends, but in this case, we are aiming with all the regulators, with this SEC, CFTC, and in this case also the OCC and FDIC, and the Fed, working to provide a assessment of the current regulatory framework, the adequacy or inadequacies, and proposed paths forward. I think it is a document that can be used for conversations with Congress, conversations with FSOC, conversations with other regulators, including state regulators. So it's a opening, hopefully with a lot of thought behind the opening. It's not just raising questions, it's also raising some proposed paths forward. But my guess is, you know, you start these processes and you may end up close to where you started, but hopefully the broader engagement gets you to a better place. And I think it's important to sort of lay down that foundation and be clear about, you know, how you got there, and then start the conversation. So
The long journeys start with the first step. But thank you for that. I apologize for the sort of basic.
No, it's very, people wonder, what do you do when you write all these papers?
Like, what are you doing? So look, as I said, the BIS, our friends at the BIS, and shout out to Augustine Carson's, John Frost, Benoit Curé have just been pivotal partners with us through all this. So as our last question for this year's FinTech Week, I'll make it another international one. Okay. And when you think about the stablecoin question, and releasing the paper out into the wild, what does international coordination look like? Who do you talk to on those policy steps, and how do you, once you start to get that framework together, how then do you start to move that agenda beyond U.S. borders?
Yeah. So in the international space, we talk to everybody, and there's a lot of groups. Obviously, the BIS has their innovation hub with, Benoit and then Hu and Shin, and all overseen by Augustine. It's a terrific group, and sure they've added a lot to this week's events. I can't imagine. There's a lot of work at FSB, the Financial Stability Board, also under the auspices of BIS. In particular, there has been quite a bit of work on cross-border payments for the last couple of years. And I think one of the issues, this is clearly a global phenomena. Cross-border payments is actually one of the, promises of improved efficiencies. So there's quite a bit to do there. One is just increased harmonization. So, you want to avoid sort of regulatory arbitrage across countries. And, to the extent there's more common regulatory standards, more common supervisory standards, that's all to the good. So that's a process we look for, we do, and we engage in wholly, and is important. So.
Yeah, many of those names are indeed names I have over the last couple of years, and certainly over the last couple of weeks, have come to really know and enjoy enormously.
Yeah,
and it's been a pleasure talking to you as well. You're doing extraordinarily important work, and we thank you for your service. And we thank everyone in the background who's been watching us for these last 4 days. There have been a lot of talks, and really a lot of very important work. Thank you to everyone. We'll be trying to put some of this stuff out in an organized fashion. And we also just want to thank all of our participants. As I said, we've had the global community, the national U.S. government very heavily involved, as they have been every year. And we have an extraordinary amount of goodwill that's gone behind this every year. It's a bit of a pro bono project for me and for a lot of my colleagues over at Georgetown. So thank you all so very much for making this an extraordinary FinTech Week. Thank you so much, BIS. Thank you to our sponsors, Visa Economic Empowerment Institute, everyone who's just sort of come together to try to democratize this information and make it available to everyone. So thank you so much, and see you next year.